Okay. Guys on YouTube, can you confirm if it's audible? Audible. Okay. All right. Good morning, warriors. Feeling fresh? One small request. It's a marathon. I want everyone's phones going on silent for the day. Modi is coming. Station is starting. Nothing required. All phones go on silent. Today, my phone is also going on silent, although I have a lot of notifications coming in today. All right. Perfect. How many new faces? Who has not seen me before this today? A lot on online also. Fair enough. Great. Names and all not relevant. You would have seen it on the pamphlets and all. What I would start with is, probably welcome to war games. We are in a war right now. Yes or no? Starting when? Starting when? Started when you started the course. Started when you started the course. It's going to end when you. See? Forza si entera. Forza si entera. Complete the course. We are in the middle stage. Middle stage. Now only they're training us for getting into the war. Okay, so we are getting into the war. We are into inter stage right now. Let's complete the battle of inter. Today you have two missions. You have two missions. One to complete the subject. The other to get home and feel confident that you're going to pass. No, two missions for you. I am your general for the day. That is why I call you warriors. Yes or no? Let's work with that now understanding. All right? Yes? Great. Two rules of marathon for those who have attended fresh, who do not know who it works. We do not discuss any kind of concepts. I mean, when I say we do not discuss any kind of concepts, we don't elaborate on the concepts. We don't elaborate on the concepts. We will be discussing the provisions, right? The expectation is that you would have already learned the provisions from home and come, and we are only going to do a quick revision of the provisions just for me to give you a comfortableness that we can complete the subject within a period of 7 hours. In a period of 7 hours is what my target is. It's upon even better. அதுக்கு மேல போகாது. We'll try to complete in that notion. Yes, அதுக்கு மேல போகாது. We'll try to complete in that notion. For someone who does not understand what it is, you want me to repeat, let me know. I will repeat. I will definitely repeat. But if you want me to explain that, I'm sorry. Will not happen at this point of time. Will not happen at this point of time. When we have breaks, feel free to come back to me and reach out to me. Or otherwise, focus here. Or otherwise, what will happen? You can go back to your YouTube channels. We have a YouTube channel called Sri Sankara CA classes. We have a free fast track loaded for the whole batch. Yes, we did a fast track last 15 days back. About 15 days back, we did a fast track classes. In that classes, we discussed all the concepts very thoroughly, along with all the provisions with their logics also. Yes, if you don't understand the concept, you're free enough to go to that chapter and discuss, check it there. You will find all the answers there. You'll find all the answers there. Here, we will be discussing only what is the. And that understanding, it is your job to tell me what the provisions are. Writing the exam. Yes, so I will ask you the question, you will have to tell me the provision. At the same time, if I forget something, you have to tell me what I forgot. Yes, because my understanding is very simple. I will not look at the book. இருக்குது screen மேல is only for show up. blank காமிக்க கூடாது சொல்லிட்டு வேற வச்சிருக்கேன் அவ்வளவுதான். The screen will not Question. Sir? Let's start. Some badega India only, nothing. Because they're diverting all that to railway station today, nothing. Let's hope nothing happens otherwise. For some reason, there is some, what do you call it, lucky charm only for me. The day I start the class, first half an hour definitely will go wrong only. And suddenly, the class will boom suddenly and everything. Hoping that it happens the same way. I think the inauguration is at 4 o'clock, is it? So 4 கிட்டக்க இருக்கு. அதுக்குள்ள ஏதோ ஒரு chunk of portion முடிச்சிடலாம். Let's try to complete a chunk of portion by then. Yes. Let's start. We've already wasted half an hour. For the benefit of the ones who are watching online and all, I will try to trim the video and upload the fresh video also after I'm done. Okay, so that you don't have to waste all this nonsense. Right? We'll do it maybe by today or tomorrow. We'll complete all the trimming also and we'll send it back to you. All right? Great. Where was I? Yeah. So we'll be only discussing the provisions. We will not be discussing the concepts behind the provisions. You can discuss it or you can understand all that when you're going into the fast track mode. Yes, you can check the fast track modes for your understanding of the provisions. We will only be discussing the provisions right now. Yes. Second thing, I will be asking you the questions. You will be discussing the answers with me. So you have to remember the answers and you have to discuss with me. That is the whole point of the marathon. Yes. We do not have more than 5 seconds per provision. I will ask you the provision, the answer automatically comes. That's how the rule is. You do not change your material, people. Okay, for the benefit of the ones who are watching it for the first, the link of the book is there in the YouTube channel also. But yes, not the time to change your books. If you have already got used to your faculty material, some other institute material or some other ICI material, please stick to that. Please stick to that. This is a very wrong time to change your materials. You will not be able to complete from my material. If I'm teaching from my material, I'll be discussing from my material, the same flow of my material. But otherwise, for your sense, provisions are not going to change. Provisions are not going to change. So you'll stick to your own respective materials and you'll discuss it basis that. Clear? The extent you feel like my material has some summary notes which your material might not have, you can feel free to go and use it. But otherwise, please do not change your materials. It's a humble request from my side. Don't take it at the last minute and then start struggling with it because then it become a problem for you for this attempt. Clear? Planning for next attempt, your choice. No? Yes, we are into May 23 right now. So all the amendments of May 23 will be discussed. I understand there are some people from the last November batch. Whenever there is a May amendment coming in, I will take a pause and I'll explain you what the amendments are. But please don't worry, we have hardly some 3 amendments. So we'll discuss all the 3 amendments as we go forward also. Clear? Yes, the screen will not roll, people. For the ones watching YouTube, for the ones watching here, the screen will not roll. I will roll it to the extent I don't remember the provision. Other chapter will get over, then the screen will roll. Okay. So Rahul, the screen is not moving. You are only talking. Yes, I am only talking. You are also talking with me. That's all the logic is. Clear? Yes, don't focus on the screen. Screen is not important for you. You are sitting with your own respective materials and answering from your own respective. Any doubts? That understanding, let's start this start the class. We are going until 7 hours. Possibly before that also. We will have sufficient breaks as we go forward. We'll have sufficient breaks. It is probably the first break at 9:30 or the last chapter going on continuously, whichever is later or earlier. Later. I will not skip a chapter in the middle and tell you to go for a break. We will complete the chapter and then go for a break. Okay, so first break is at 9:30, second break is at 1 o'clock, third break not there. One break I'll give you before TDS. If at all I feel you are all sleeping. The option kuda illa. To focus the pani agna vera vali illa. Yes, and the only way the focus will happen is if you are answering me the provisions. Here I will only be remembering, or I will only be what do you call it? Repeating the provisions you tell me for the benefit of the online students, but anyone sitting here will have to repeat the provisions. You are free to use your books. My recommendation, start it from your head. It will be a lot easier, but if you are not remembering it, don't sit silent. I see one ugly face on my friend who's not answering me. You can understand where your attempt is going. Clear? I want every face blabbering to me, whether you know it or not. Whether you know it or not, if you don't know, use your book. If you know, then you remember from your book. Clear? Clear? Yes, anyone sitting here will focus like that. Anyone on the online market, please have your books in front of you. Imagine you're sitting in front of the class. You are in the exam hall sitting with 50 other people struggling to pass, and you are the only one going to pass. Keep that thought in mind and then answer it online also. At your home, your family should get worried what is happening at home. Okay? They should get worried as to what you're doing at home, and they should have that focus. Okay, pa, in 6 months he did not study, but today he's studying to the best of his ability. Okay, and the notion irukno. Yes, tomorrow your mom and dad should come and tell to some other person, pass aglanalo correct effort potter adu porom. Okay, that is what is the understanding. Clear? Yes. On that understanding, if you go into my book, you will have a set of how many chapters? You will have a set of 1 to almost about 24 chapters. You can straight forward ignore 24th chapter. Agada. Very good. You can straightforward ignore 24th chapter. We are going into the first chapter called as basics. We are going to the first chapter called as basics. Starting with the first chapter called basics, I will ask you the question, you will tell me the answers. Yes? Yes. Starting with the first provision of basics of Income Tax Act, we are into the basics where income tax comes and says that income tax will be levied by article number 265. Article number 265 gives the powers to whom to levy taxes? Constitution. Article number 265 gives the powers, it gives the powers to the authority of the law. Where is this article 265? It is in Constitution of. Yeah. Income tax is defined under union list, state list, or central list. It is defined under union list. It is defined under union list. We have two kinds of taxes. One tax is called as direct tax, one called as direct tax, which is levied directly on the person. Direct tax. Which is levied indirectly on the person. Direct tax. Which is levied on the goods and services. Direct tax. Which is levied on the income. Which can shift burden. Direct taxes, which cannot shift burden. Very good. When you come into income taxes, you have Income Tax Act and income tax laws. Laws is bigger. Laws is bigger. When it comes to laws, you have multiple items inside it. One item is called as Income Tax Act, Income Tax Rules, Finance Act. Finance Act for your exam is 2022. Finance Act for your exam is 2022. You are doing assessment year 20. You are doing assessment year 23-24. You are doing assessment year 23-24. Finance Act applicable to you is Finance Act 2022. Finance Act 2022. Then you have rules. Then you have circulars, notifications, and case laws. Case laws out of syllabus. Case laws is out of syllabus. Coming into Income Tax Act. Income Tax Act starts from 1st April 1960 to 1st April 1962, because we are in assessment year model. We are in assessment year model. It applies to the whole of India, including Jammu and Kashmir also. Including Jammu and Kashmir also. Then you have Finance Act. We told you Finance Act is Finance Act 2023. 2. Finance Act 2022. Hey, my job to tell you the wrong answer. Your job to pass the exam. Yes or no? It is Finance Act 2022. You have circulars and notifications. In circulars, circulars is binding on department only. Notifications is binding on assessee and department. Which one gives clarifications? Which one gives clarifications? Circulars give clarifications. Circulars give clarifications. Notification gives a class of persons. Notification gives a class of persons. They're notifying something to you. They are notifying something to you. Circulars can be used by the assessee. Yes or no? Yes, only if it is beneficial to the assessee. Only if it is beneficial to the assessee. Then we have certain definitions. Exam Puerto Rico, these definitions are not important. Going into the definition for assessee. Assessee definition comes and says that assessee means any person who is liable to pay tax. Also includes any person who is going to assess his income. Also includes person assessing his losses. Also includes person assessing his refund. Yes. Apart from that, we also include any other person for whom you are assessable in the form of clubbing. And then we also include some items which are assessee in default. Assessee like TDS. Then we also said that if you're liable to pay taxes, we are also including any other sum also, like penalty, interest, late filing fees, all those kind of items also. Yes, this is what the provisions are when it comes to assessee. Then we had something called as assessment. Assessment basically means any kind of assessment happening on a person. By whom? Assessing officer. By an assessing officer. Then we had something called as capital receipt and revenue receipt. You simply have to understand the distinction. What happens regularly? Revenue receipt. What happens one time? What you sell itself to generate revenue? Revenue. What you use for generating revenue? Capital. Which one is always taxable? Revenue. Which one is taxable only if defined? Capital. Where should it be defined? Income definition. Should be defined in income definition. Whenever we speak about income, income basically means revenue minus allowable expense. Revenue minus allowable expense. If the expense is not allowable, it is not considered. It's not considered. Will you tax illegal income? Yes. You will also tax illegal income. Yes or no? Yes or no? Income can be in the form of cash or in kind also. Income can be in the form of cash or in kind. Gift you receive is capital revenue. Gift you receive is capital revenue. Capital revenue. Always capital. Hey, daily a gift varum. Anda naladam. Yes, gifts will always be capital in nature. You received a money because you did not honor your fixed assets contract. Capital. You have an agency. This is the only bread and butter for you. Agency established, gone. Capital. You have multiple agencies. One agency gone. Revenue receipts. Clear? Yes, this is what the definition is of capital and revenue receipts. Then we had what is for charging of income tax act. Income tax simply comes and says that what will be chargeable is it will be charged on your total income of the person earned in the previous year, will be taxed in assessment year at the rates in force. At the rates in force. What do you mean by previous year? Previous year is the year in which you earn your income. Previous year will always be for 12 months. No, it can be for lesser than 12 months. Also, it can be for as low as 1 day. It can be as low as 1 day. Assessment year will always be for 12 months. Yes, assessment year will always be for 12 months. It will be the year in which you are going to assess your taxes. The year in which you are going to assess your taxes. When it comes to previous year and assessment year, generally previous year will be the earlier year, assessment year will be the current year. But there is some exceptions where previous year and assessment year will become the same. Will become the same. The rules are like that. You are Mr. Vijay Mallya. You are Mr. Vijay Mallya engaging with Nirav Modi, engaging into F1 racing. AOP BOI. AOP BOI. Created during the year, closed in the year. Created during the year, closed in the year. F1 racing incurred a loss, so F1 racing closed. AOP BOI closed in the current year. Because you have incurred losses, you are planning to exit India. You are planning to exit India. Because you are going to plan to exit India, you first have to shut down the business in India. So first you will sell all your assets. You will sell all your assets. Sale, transfer, charge or extinguishment of your assets with an intention to avoid taxes. Since you have sold all your assets, you are now going to shut down your business. Any kind of business or profession discontinued in the current year. Since you are now going to leave, you are no intention of coming back. Individuals leaving India with no intention of coming back. You are planning to leave, not able to leave, so you will call your friend. You will call your friend Doraemon. Doraemon comes from Japan, brings a ship, collects you and leaves. Non-resident shipping company coming to India, leaving India. Non-resident shipping company coming to India and leaving India. Clear? Then we had the last definition of total income. Total income comes and says that was any kind of income from 5 heads of income. Any kind of 5 heads of income will be taxed and become gross total income. In that you will reduce something called as Chapter 6A. You will also reduce something called as 10AA. You will also reduce something called as 10AA. You will arrive at your total income. On the total income is what you will pay. The total income is what you will pay. It out. The chapter number 1. This is chapter number 1. Coming to the chapter number 2, which talks about the rates and force. The most important chapter from exam perspective. We are now into chapter number 2, called as rates and income tax. Comes and says when it is rates and forces, you have to check what kind of person you are. You have to check what kind of person you are. If you are an individual, HUF, AOP, BOI, AJP. Individual HUF, AOP, BOI, AJP. Your basic exemption limit starts from 2.5 lakhs. From 2.5 lakhs, it will be nil. After 2.5 to 5 lakhs, it will be 5%. 5 lakhs to 10 lakhs, it will be 20%. After 10 lakhs, it will be 30%. But if you opt for 115 BSc, it will be 2.5 lakhs, 0, 5 lakhs, 5, 7.5, 10, 10 lakhs, 15, 12.5, 20, 15, 25, above 15. Above 15, 13%. If you are a resident individual not opting for 115 BSc and more than 60 years at any time in the previous year, your 2.5 lakhs will become 3 lakhs. If you are a resident individual aged 80 years not opting for 115 BSc, your basic exemption limit will move to 5 lakhs. If you are a non-resident, your basic exemption limit will be 0.5 lakhs. Your basic exemption will be 2.5. These are what the provisions are. Income tax gives the clarification, comes and says if you were born on 1st April of for your exam it is 1960. 3. For your exam, it is 1st April 1963. If you were born on 1st April 1963, it is assumed you completed 60 years on 31st March 2023, and therefore you will be eligible for 3 lakhs. If you were born on 1st April 1943, you will become 80 years. You will become 80 years. These are what the provisions are. Then we need to check whether you are rich, poor, or middle class. Rich, poor, or middle class. If you are poor, you are eligible for rebate. Who are you eligible for rebate? If you are a resident individual having a total income up to 5 lakhs, you will get a rebate up to a maximum of. Can you claim rebate under 115 BSc? Yes, sir. Can you claim rebate under 115 BSc? Yes, you are still poor both the regimes. You are still poor in both the regimes. There is only one income which is not eligible for rebate, which is 112A. 112A. If you are not a poor person, you are now a rich person. If you are into rich scenario, you are now liable for surcharge. Surcharge starts from a basic exemption limit of no exemption limit. Surcharge starts with 50 lakhs of total income. If you go beyond 50 lakhs, surcharge will become 10%. If you go beyond 1 crore, surcharge will become 15%. If you go beyond 2 crores, surcharge will become 25%. If you go beyond 5 crores, surcharge will become 37%. This surcharge will also be liable under 115 BSc. But yes, the provisions come and say that if you are liable for a surcharge of 25 and 37, do check if you have some special income. Do check if you have some special income. First amendment for your attempt, the special incomes have been changed. The special incomes have been changed. Earlier, you had special incomes of STCG under 111A, LTCG under 112A, and dividend income. Now you also have LTCG under 112. You also have LTCG under 112. First amendment for your current attempt, which comes and says LTCG under 112 will also be considered as a specified income. Provisions come and say, boss, if you have some specified incomes, and your total income goes beyond 2 crores, split your income. Split your incomes. Take your normal incomes, take your specified income. Take your normal incomes and take your specified incomes. Specified income will always be surcharged at 15. Normal income will surcharge with a minimum of 15, will go up to 25 or 37. Will go up to 25 or 37. Basic the individual case. Rahul, my total income is 3 crores. Total income is 3 crores, in which my specified income is 2.5 crores. My specified income is 2.5 crores. My normal income is 50 lakhs. Total income being 3 crores. Split. Check for 2.5 separately, 0.5 separately. 2.5 special income will be taxed at a surcharge of 15. Special income, non-special income 50 lakhs will be taxed at 15%. Please don't go down to 10 and please don't go down to 10 or 15 beyond less than 15. Please don't go down to 10 or 0. Minimum 15 to be charged. One of the most important things from exam perspective will definitely be tested. Please understand, if the total income goes beyond 2 crores, you bare minimum have to take a surcharge of 15. Never go down to 10 or 0. Any doubts? No doubts? Clear? This is what the provisions are when it comes to surcharges. If you are liable for surcharge, you are also eligible for marginal. Provisions come and say, if your income is found out to be at an income where the income is very close to the slab, your income is found where the income is very close to the slab, where the surcharge is changing. Mandatory condition, surcharge should change. If that is the scenario, you will opt for marginal relief, in which case what you need to do is you need to compute tax as per the normal income and then compute tax on the nearest slab. If you have income of 2.2 crores, you will not 2.2 crores, 2 crore 2 lakhs. If you have 2 crore 2 lakhs, then you will compute tax on 2 crore 2 lakhs. You will compute tax on 2 crores. In 2 crore 2 lakhs, you will levy surcharge of 25. In 2 crores, you will levy surcharge of 15%. Compare both the taxes. Excluding education cess up to surcharge alone. Compute your taxes. Check the increase. Compare with the increase in income. Let's say that the increase in tax is 5 lakh rupees, whereas the increase in income is 2 lakh rupees. You will pay 5 lakhs for earning 2 lakhs. Yes or no? No. In which case you will go to government and come and say, I will offer the 2 lakh rupees but take back the 3 lakhs. This 3 lakhs is nothing but your marginal relief, will be reduced from your tax of 2 crore 2 lakhs, and then you will add cess, get the final number. Or alternatively, what you can do is you can compute tax on 2 crores, add the 2 crores with 2 lakhs which you offered. at the 2 lakhs which you offered, add cess on that, you will get the answer. This is what the provisions are. Always to be checked when the income is very close to the slab. Always to be checked when the income is very close to the slab. In exam, they will not clarify. You need to check that. Will marginal leaf will come on 115 BSc? Also come on 115 BSc as well. Yes, with this we have now something called a special tax rate. Special tax rates come and say that boss, you have certain special tax rates. First special tax rate is LTCG under 112. 112 will be taxed at 20%. 112A will be taxed at 10% in excess of 1 lakh rupee. 111A will be taxed at 15%. Normal STCG will be taxed at normal slab. Winnings will be taxed at 30%. Unexplained income will be taxed at 60 plus flat to 25. 60 plus flat 25 surcharge plus 4% cess. Plus 4% cess. Rahul, all these items all are eligible for rebate, yes or no? All the items are eligible for rebate. Only 112A not eligible for rebate. Rahul, I have a basic exemption limit. I have a basic exemption limit not utilized by my normal income. Not utilized by my normal income. You can use this income. You can use this income to set off your basic exemption limit only if you are a resident individual, but you will get this benefit only for capital gains. Get this benefit only for capital gains. You cannot use your basic exemption limit for the purpose of your unexplained income and winnings. These two items mandatory to be taxed. Two items mandatory to be taxed. But yes, if you are a non-resident, anyway no benefit will come to you. You directly have to pay tax on those items. Can you claim a rebate for a non-resident? No rebates for a non-resident. Here, yes, with this we are done with the tax rates of an individual, HUF, AOP, BOI and AJP. Moving to the next tax rate for a firm. Moving to the next tax rate for a firm. The tax rate for a firm is 30%. Surcharge is 12% in excess of 1 lakh rupee. 12% in excess of 1 lakh rupee. Yes. I'm sorry, 1 crore rupee. 12% in excess of 1 crore rupee. Then you go into companies. Company have two kinds of companies. One is called as domestic company. One is called as foreign company. Foreign company will always be taxed at 40%. Surcharge will be 2% and 5%. 2% if it goes beyond 1 crore. 5% if it goes beyond 10 crores. If you are into domestic company, check for your turnover of previous year 2021. Previous year of 2021. Preceding previous year. Preceding previous year. Check for the turnover of 2021. If it goes less than 400 crores, you are eligible for 25%. If it goes more than 400 crores, you are eligible for 30%. Surcharge will be 0, 7 and 12. 0 for up to 1 crore, 7 for after 1 crore, 12 for above 10 crores. This is what the provisions are when it comes to rates of taxes. Chapter number 2 also over for you. Since we are in chapter number 2, we have something called unexplained income. Quickly understanding what my unexplained income means in very one simple line. If the exam comes and says that there is an income or an expenditure or an asset, if there is an income or an expenditure or an asset where the question comes and says that you have tried to offer the explanation but the assessing officer is not convinced, or you did not even offer the explanation and assessing officer is not convinced. In this case, whatever income, asset or expenditure you have will be added as your unexplained income. Will be added as your unexplained income. Will be taxed at the rate of 60 plus 25 plus 4%. Plus 25 plus 4% will not be added in case you are explaining the source. You are explaining the source and the assessing officer is convinced of the source. Explaining officer is convinced of the source. Rahul, I have an expenditure of 5 crores. I have an expenditure of 5 crores. I explained source for 4 crores. Did not explain for 1 crore. My unexplained income will become 1 crore. My unexplained income will become 1 crore. Rahul, question comes and says that the 5 crores was fully used for business. 5 crores was fully used for business, in which 4 crores I explained, 1 crore I did not explain. What will you do? You will come and say, boss, 4 crores anyway explained, so no problem. Claim the expense. Claim the 1 crore which you did not explain. You will add it as an income, not get benefit of deduction also. Not get benefit of deduction also. Expenditure will be disallowed. Expenditure will be disallowed. Only the expenditure will be added to the income and will be directly taxed. Will be directly taxed. You cannot claim the expenditure as a deduction. Cannot claim the expenditure as a deduction. Since you are completing with rates of taxes, after whatever answer you get, you add something called a set at the rate of 4%. On what? On what? On your basic plus surcharge minus marginal leaf minus rebate. Basic plus surcharge minus marginal leaf minus rebate. Rahul, can there be a scenario where I have rebate and surcharge both? Can there be a scenario where I have rebate and surcharge both? Yes. And you have unexplained income. When you have unexplained income, you will have surcharge also, you will have rebate. Now, can there be a scenario where I have rebate and marginal relief together? No, that is not possible. You will have a surcharge and a rebate together, cannot have a marginal relief with a rebate. Marginal relief will only start from 1 crore or 50 lakhs or 2 crores or 5 crores, can never come down to 5 lakhs, can never come down to need outs. With this done, what we are completing is rates of taxes. We're done with rates of taxes. Moving to the next chapter called as residential status and scope of total income. We are into the next chapter called as residential status and scope of total income. I will not be discussing anything from my book, but directly going into the chart. We are into the first residential status called as an individual. Individual, you have to start from the chart. First and the most important condition in residential status of individual is to check for the stay of 182 days or more in the previous year. If you satisfy the condition, come to the right side. Don't satisfy the condition, come to the left side. If you are coming to the right side, you are resident. If you are coming to the left side, now check for additional conditions. You are either an Indian citizen who is a crew member of a foreign ship, or you are leaving India for employment. In that scenario, condition number 2, not to be checked directly, non-resident. If you are an Indian citizen or a person of Indian origin, in that case, what you need to do, you need to check whether you are outside India, visiting India. Outside India and visiting India. If you are outside India, visiting India, check for your Indian income. If your Indian income is more than 15 lakhs, your Indian income is more than 15 lakhs, check whether in the current year you stayed for 120 days in the current year and 365 in the last 4 years. If you satisfy, you will directly become R and OR. Don't satisfy, you will directly become NR. Rahul, I did not have an Indian income more than 15 lakhs. Ignore condition number 2, directly non-resident. No, Rahul, I am an Indian citizen who is in India leaving outside. Or I am an Indian citizen not coming for visit but coming for stay. In that case, you will merge it with the third chart which talks about foreign citizen. In that scenario, you will merge both the charts. Check for the stay to be 60 days in the current year, 365 in the last 4 years. Satisfy the condition, you are resident. Don't satisfy the condition, you are non-resident. If you are a resident because of this and resident because of the right side of the chart, merge together and check for non-resident. If you are a non-resident for 9 out of last 10 years or stay for less than 730 days in the last 7 years, in that case you will become an R and OR. Illinois, you will become an ROR. Wherever you had a non-resident, if you are a non-resident, you will bring them together. Check if you are an Indian citizen and with an Indian income of more than 15 lakhs, you do not have a tax in any other country. You will be liable as a deemed resident in India and your status will become R and OR. Your status will become R and OR. Rahul, in exam, if the question gives you 2 options, one option says deemed resident, one option says R and OR, choose deemed resident. Choose deemed resident, MCQ Puerto Rico. Some solve panamudu, you will have to say you are a deemed resident as well as an. Both you have to say. MCQ Puerto Rico, if both the answers are there, you will give deemed residency as an answer. But please understand, deemed residency only comes into picture if you are a non-resident because of the above chart. If you are already becoming a resident because of the above chart, this provisions will not come into picture. Do not look at the question and directly see it's not liable, therefore it is deemed resident. First answer the above chart. If it is not satisfying, then come and check for this condition. Clear? Your stay in India will also consider the date of departure and the date of arrival. Exception is only one if you are a crew member. If you are a crew member who is going for a continuous discharge, the date on which you join the ship will be considered as outside India. The date on which you sign off of the ship will also be considered as outside India. The whole period between your date of joining the ship till the date on which you exit the ship will be considered as outside India for the purpose of calculating your residential status. Whenever you are calculating residential status, person of Indian origin means that kind of person whose self, parents or grandparents are born in undivided India. Indian income for the purpose of RS means income of an R and OR. Compute the total income of an R and OR, that will be considered as your Indian. If you complete individual, now next comes your HUF. HUF provisions come and say that if your control and management is wholly or partly in India, you will become a resident. If you are wholly outside India, you will become non-resident. If you end up becoming a resident of an HUF, in that case, you need to check for Karta. Karta's check will happen for the two conditions. If Karta was a non-resident in 9 out of 10 years of the last 10 years, in that case, HUF will become RNOR. If Karta was staying for less than 730 days in the last 7 years, HUF will become RNOR. Karta does not satisfy both the conditions, HUF will become ROR. HUF will become. If HUF was directly a non-resident, will you check for these conditions? Check for the. If you are a firm, AOP, BOI, AJP, check for your control and management. If the control and management is wholly or partly outside India, it is wholly or partly in India, it is a resident. Wholly outside India, it is a non-resident. Will you split into ROR and RNOR? No, no splits happening for ROR and RNOR. If you are a company now needs to check for what kind of company you are. If you are an Indian company, you are a resident. If you are any other company, check for your POEM. Check for your POEM. If your POEM ends up being in India, you are a resident. If your POEM ends up being outside India, you are a non-resident. In exam, how do you check for POEM? Check where the shareholders are. Check where the shareholders are. Questions will come and say that the board meetings are happening outside India. In that case, POEM is outside India. Question comes and says, boss, there are 20 shareholders, 12 shareholders are in India. POEM becomes India. POEM becomes India because 12 shareholders are in India out of 20, which means majority are here in India. Major decisions will happen in India. In that case, you will become a resident. In that case, you will become a resident. Here, yes, this marks the end of your RS. We are moving to the next part of the chapter called as scope of total income. Income tax comes and says that when you have a scope of total income, check whether you are an ROR, RNOR, or NR. If you are an NR, you need to check for 4 kinds of income. Income received in India, income deemed to receive in India, income accruing and arising in India, income deemed to accrue or arise in India. If you are an RNOR, 4 income plus 1 more income, 4 income plus 1 more income. The 4 income of NR plus 1 more income is income deemed to accrue or arise outside India from a business controlled from India, profession set up in India. Profession set up in India. I see some blank faces. Look at your book and answer. Okay, we are into the RNOR case, and last case is your ROR. ROR comes and says you need to tax your global income. Please understand what is taxed is income and not receipt. So therefore, if you are taking an income outside India and then remitting it to India, remittance will not be taxable. Income will become taxable. Income earning capacity will be taxable. Income remittance capacity will not be taxable. If you have already taxed something on accrual basis, you will not tax it on receipt basis. If you have taxed it on receipt basis, you will not tax it on. This is what the provisions are. And then we have something called as what is income deemed to accrue or arise in India. Going to the heads of income, the first head of income is called as salary. If you are into salaries, income tax comes and says any kind of salary received by a person who's rendering service in India will be taxed in India. Second, they come and say any kind of salary received by a government person rendering services outside India will be taxed in India, but you will get all kinds of allowances and perquisites as exempt. Any kind of allowance or perquisite given to a government employee working in a foreign embassy, will become fully exempt from tax. After salary comes HP, income tax comes and says if the house is in India, it is taxed in India. Then it comes to PGBP. PGBP comes and says check whether you are a agent. Check whether you have an agent. If the agent is dependent, business connection is established, you are taxed in India. If you do not have an agent who is dependent on you, he is an independent agent, income is not taxable in India because business connection is not established in India. But yes, they come and say if you have a significant economic presence, how do you establish a significant economic presence? Your current year revenue from India should be more than 2 crores. Current year revenue should be more than 2 crores, or your current year number of users should be more than 3 lakhs. Your number of users should be more than 3 lakhs. In that scenario, you will become a significant economic presence in India and will be deemed to accrue or arise in India. But you have certain exceptions. Exception number 1 comes and says operations are not carried out in India. Exception number 2 comes and says if you are collecting any kind of news and views from India for circulating outside India. Condition number 3 comes and says if you are purchasing goods for the purpose of export, then condition number 4 comes and says if you are a non-resident coming to India for shooting cinematographing films. Condition number 5 comes and says if you are going to display uncut and unassorted diamonds. If you are going to display uncut and unassorted diamonds, then in that case also it will not be taxable in. If this gets over your PGBP, starts with your capital gains. Provisions come and say if the shares were in India or the capital asset was in India, it will be deemed to accrue or arise in. Yeah, last is your IFOS income. IFOS, they come and say any kind of dividend given by an Indian company will be deemed to accrue or arise in India. Any kind of gift received by a non-resident from a resident will be deemed to accrue or arise in India. And they come and say you have three kinds of income. One is called as interest, FTS, and royalty. Interest, FTS, and royalty. They come and say, boss, if any of these three incomes were received from government, it will be taxable in India. If it is received from a resident, it is generally taxable in India unless the resident is using it for any purpose outside India. Any purpose outside India. If you are receiving it from a non-resident, it is generally not taxable, but will become taxable if the non-resident is going to use it for business when it comes to interest, any reason when it comes to FTS and royalty. Any reason when it comes to FTS and royalty. Rahul, if you are going to use the loan for any other purpose other than business in India, then it will not be taxable if it is paid by a non-resident. Then it will not be taxable if it is paid by a non-resident. Be careful on that. Be careful on that. But when it comes to FTS and royalty, whether it is used for business or it is used for any other source, it will become taxable in India, even if it is paid by a. Clear? Yes. Moving to the next chapter, the biggest chapter called as. Salaries. Any doubts till now? We are moving to the next chapter called as salaries, starting with the provisions of the salaries. Salaries basically come and say that there should be an employer-employee relationship. You should receive the money on account of such relationship. Salary will be taxable on due or receipt, whichever is earlier. But there should be certainty. If you are going to receive a loan, it will not be taxable. But the interest on that loan will become taxable. The loan will become taxable as yes or no? Yes. Then they come and say, boss, any kind of salary received by an MP or MLA will be taxable under. Well, any kind of salary received from a partnership firm by a partner will be taxable under TGBP. Whenever you're taxing salaries, you're also taxing any kind of termination or modification compensation which you have received, whether during employment or post-retirement or before employment also. With you starting with salaries, you need to start with the format. I will keep the format live. We will discuss from this format. The page will not roll. Okay. Starting from the first format called as basic. Basic, always taxable. Next item is your DA. DNS allowance will be two types. In terms, not in terms. In terms will be taxable. Not in terms will be taxable. Commission will be two types. One will be fixed commission. One will be turnover commission. Fixed commission, taxable. Turnover commission, taxable. We will discuss. After we move to commission, you have now something called as allowance. You have something called as bonus. Bonus will be taxable on receipt basis. After you complete bonus, now you jump into something called as allowances. First allowance in my book is called as leave salary. Provisions are coming and saying if you are receiving the leave salary during employment, it is fully taxable. If you are receiving leave salary on retirement, it will be checked whether you are government or non-government. If you are government employee, then non-government employee, least of the four will be allowed as exemption. First item, actual. Second item, 3 lakh rupees. Third item, average salary for the last 10 months. Salary here means basic, DA forming part, turnover commission for the last 10 months averaged out. Last provision comes and says, take your leave credit unutilized, divided by 30 to get the number of months, multiplied by average salary. Salary here means basic, DA forming part, turnover commission for the last 10 months. Whenever you're discussing about leave salary, 3 lakh rupees given to you per lifetime. It's per lifetime. You can maximum claim 3 lakhs for the whole year, for the whole lifetime. After you complete leave encashment, you have something called as house rent allowance. Provision comes and says whenever you have any kind of house rent allowance, least of the three will be allowed as exemption. Point number 1, actual. Point number 2, 50% of salary if it is Chennai, Delhi, Mumbai, Kolkata. 40% of salary if it is others. Next one is rent paid minus 10% of salary. Salary here means basic plus DA forming part, turnover commission for respective months. For the respective months. After you complete HRA, you have something called as special allowances. Income tax comes and says if you receive any kind of transport allowance, it will be exempt up to 3,200 per month for disabled people. For disabled people. Next comes your child education allowance, exempt up to 100 per month per child. 2 children for education in India. Child hostel allowance 300 per month per child. 2 children education India. Then you have any other allowances. Check all your allowances. If it is pertaining to business, it will be exempt to the extent it is used for business. Balance will become taxable. Balance, anything else you receive will be fully taxable. Telephone allowance, taxable. Lunch allowance, taxable. Food allowance, yes, these are all taxable for you. After you complete your allowances, now you move into something called as retirement benefits. Income tax comes and says the first retirement benefit is gratuity. Gratuity will be 2 types: received during employment, post-retirement. During employment, post-retirement. Check for government employee, non-government employee. Government employee, exempt. Non-government employee, check whether you are into POGA or non-POGA. If you are into POGA, list of three. First one is actual. Second one is 20 lakhs per lifetime. 20 lakhs per lifetime. Next one is 15 by 26 into last drawn salary. Into number of completed years or rounded thereof. Salary here means basic plus DA full. Not forming part, full. Basic plus DA full for the last month. If you are not covered under POGA, you will check for list of 3. First one, actual. Second one, 20 lakhs per lifetime. Third one, 1/2 into average salary into number of completed years. No round off. Average salary means basic plus DA forming part plus turnover commission for the last 10 months averaged out. Whenever you are checking for number of completed years, you will not check for round offs. Round offs will be ignored. After you complete gratuity, you have something called as pension. Again, check for 2 kinds of pension. You have uncommuted pension and commuted pension. Commuted pension, check whether you are government employee, non-government employee. Government employee, exempt. Non-government employee, check whether you are receiving gratuity, not receiving gratuity. If you are receiving gratuity, 1/3 of total pension is exempt. If you are not receiving gratuity, 1/2 of pension is exempt. Total pension means commuted pension divided by the percentage. If you receive uncommuted pension, it becomes fully taxable. After you complete pension, you have something called as VRS, out of syllabus. Retrenchment compensation, out of syllabus. Next, you have something called as contribution to funds. Contribution of funds starts with PF. First one in that is statutory provident fund. Employer contribution, exempt. Employee contribution allowed for 80C. Interest on employer contribution, exempt. Interest on employee contribution, check for 2.5 lakhs. If your contribution goes beyond 2.5 lakhs, interest on that becomes taxable. If your contribution is less than 2.5 lakhs, interest becomes exempt. Anything you withdraw from statutory provident fund, exempt. Next is public provident fund. Income tax comes and says that employer contribution is not applicable. Employee contribution 80C. Interest on employer, not applicable. Interest on employee, exempt. Withdrawals, exempt. Withdrawals also exempt. Then you have something called as URPF. URPF, employer contribution, exempt. Employee contribution, ignored. Interest on employer, exempt. Interest on employee, exempt. Withdrawals will now become taxable. In withdrawals, if you withdraw employer contribution, salaries. If you withdraw employee contribution, ignore. Interest on employer, salaries. Interest on employee, IFOS. Interest on employee, IFOS. Coming to the most important from exam, you have something called as RPF. You have something called as RPF. Coming to employer contribution, condition number 1 to check for 7.5 lakhs. Check for 7.5 lakhs. If your contribution goes beyond 7.5 lakhs, it will become taxable. If it goes less than 7.5 lakhs, you will exempt up to 12% of salary. If your employee contribution is given, you will be allowed 80C up to a maximum of 1,50,000. Up to a maximum of 1,50,000. If you are receiving interest on employer contribution, any interest which is received on the contribution above 7.5 lakhs, taxable. Any contribution received less than 7.5 lakhs, exempt up to 9.5% per annum. 9.5% per annum. If you are into interest on employee contribution, check for 2.5 lakhs. Beyond 2.5 lakhs, interest will become taxable. Less than 2.5 lakhs, interest will become exempt up to 9.5%. If you are going to withdraw your RPF, check whether you are withdrawing within 5 years or after 5 years. If you are withdrawing after 5 years, exempt. If you are withdrawing within 5 years, taxable same as URPF. Taxable same as URPF, except for certain conditions. Condition number 1, if you are withdrawing on account of illness. Second one, withdrawing because you have been removed from the company. Third, business itself has shut down. Fourth one, if you are taking your money and transferring it to another RPF or other NPS, other RPF or NR. Yes. Then the provisions come and say, boss, if the interest is going to be taxable for RPF, the interest on the interest is also taxable under RPF. The interest on interest is also taxable under RPF. How do we compute this? We check for whether you have to prepare a table. You have to prepare a table, 4-sided table. Top left will be average of the fund, which means opening balance of the full fund plus closing balance of the full fund divided by 2. Right side will be your total interest from the fund. Then bottom left will be opening average balance of the taxable funds. Abdina, opening balance of the taxable fund plus closing balance of the taxable fund divided by 2. Right side will be your computed interest. Do cross multiplication. My board is not working, people. I'm sorry about it. I cannot help it. Anyway, yes. So you will do that same format. You will prepare a 4th column. In that 4th column, top left will be your average of the whole fund. Right side will be the interest of the whole fund. Bottom left will be average of the taxable fund. Bottom right will be the computed interest. After you complete RPF and all, you have something called as NPS. NPS, basically they're coming and saying whatever employer contributes to the NPS will be taxable as salaries. You can claim it under 80 CCD2. With this, we are done with what is called as retirement benefits. You will move to something called as perks. In that, the first perk given to you is leave travel concession. Income tax comes and says when it comes to leave travel concession, you are allowed for 2 trips out of 4 calendar years. But if you do not utilize your 2 trips in the 4 calendar years, you can carry forward 1 trip to the next calendar year and utilize it in the first year. Who can travel? You can travel along with your spouse. Children restricted to 2. But if the second birth was multiple, you are allowed all the 3. And you can carry your dependent siblings. You can carry your dependent parents and dependent siblings. Whenever you are traveling, you are allowed your exemption of the travel expenses, not allowed expenses of accommodation or stay. What can you claim? If you are traveling by air, you will be allowed economy class. If you are traveling by railways, you will be allowed first class AC. Vande Bharat first class AC. Allowed, not allowed? Allowed. Allowed. Vande Bharat first class AC also allowed to you. Today only they're launching. No, tomorrow go for leave travels. Yes. After that, you have if you're not traveling by railways, if you're not traveling by flight, You are also traveling by bus. If you're traveling by bus, you will be allowed first class AC. First class AC will also be allowed there also. Be allowed there. Done. After you completed leave travel, you have other perks. In other perks, starting with the first item called as medicals. In medicals, they come and say, boss, check whether the medicals are happening in India or outside India. If you're happening in India, what will you do? Check whether it is in employer's hospital. Check whether it is in government hospital. Check whether it is in. Check whether it is for specified disease. Check whether it is for specified disease. Second amendment for the current year, whether it is for COVID. Whether it is for COVID. In these scenarios, it will become exempt from taxes. If not, it will become taxable. If not, it will become taxable. Whom can you claim the expenses for? You can claim the expenses for self, spouse, children, dependent parents, dependent siblings. Children's no restriction. Children's no restrictions. Whether they are dependent or independent, you are allowed. Whether it is more than 2 also, you are allowed. Parents dependent mandatory, siblings dependent mandatory. Siblings dependent. Clear? Clear? After medicals, you had something called as concessional loan. You have something called as concessional loan. Income tax comes and says whenever you give any kind of concessional loan, the SBI rate of interest will be the benchmark. SBI interest rate will be the benchmark. SBI interest rate minus the actual interest rate will become your perquisite. Will be multiplied by the loan outstanding as on the last day of the month, last day of the month will be taxable as perk. Will not be taxable if you are receiving the loan for an illness or if the loan amount is less than 20,000 rupees. If it is less than 20,000 rupees. If it is not for concessional loan, you are receiving something called as RFA. Receiving something called as RFA. In RFA, you need to check whether you're receiving house or furniture. If you are receiving house, split into 2. Check whether it is government, non-government. If it is government, license fee is taxable. If it is non-government, check whether it is owned or hired. If it is owned by employer, check for population. From your exam perspective, only 15% of salary. If it is hired, check for higher charges or 15%, whichever is lower. Salary here means basic plus DA, forming part plus all bonus, all commission, all taxable allowances, all bonus, all commission, all taxable allowances. Salary will be checked for respective months. Salary will be checked for respective months. If you're done with salaries, now you have something called as furniture. In furniture, they came and said, check whether the furniture is owned by the employer, hired by the employer. If it is owned by the employer, 10% of the cost. If it is hired by the employer, higher charges. If it is hired by the employer, higher charges. If you are receiving hotel accommodation, you need to tax actual higher charges or 24% of salary, whichever is less. Salary here means same as RFA. Same as RFA. After you complete hotel accommodation, now you have something called as gift. Now you have something called as gift. In gift, you receive 2 kinds of gift. Cash and kind. If you receive cash, taxable. If you receive kind, up to 5,000, not taxable. Above 5,000, everything is taxable. Everything is taxable. If you receive any kind of food coupons, then exempt up to 50 per meal. Not allowed exemption for alcohol. Allowed exemption for tea, coffee and beverages, no limit. Allowed exemption for any kind of offshoring services. Any kind of offshoring services. If you receive lunch in office also, it is exempt up to 50 per. Clear? Yes. After you have this, you have something called as the use of movable assets. You have something called as use of movable assets. When it comes to use of movable assets, check whether it is computers, motor car, other assets. If it is computers, fully exempt. If it is motor car, bring it down. Bring it down. Check whether it is fully personal, fully official, part personal, part official. If it is fully official, exempt. If it is fully personal, check whether the car is owned or hired. If the car is owned, 10% of the cost. If the car is hired, actual higher charges. Any kind of repairs and maintenance, fully taxable. Any kind of driver salary, fully taxable. Reduce any amount recovered from the employee. If you are going to part use for official and part use for personal, check whether the car is owned by the employer or owned by the employee. check whether repairs and maintenance is owned by the employer or owned by the employee. If the car is owned by the employer and repairs and maintenance are given by the employer, it is 1,800 per month for more than 1,600 cc, 2,400 per month for more than 1,600 cc, add 900 per month for driver. Add 900 per month for driver. If the car is owned by the employer but the repairs and maintenance is taken care by the employee, add 600 per month for 1,600 cc, 900 per month for above 1,600 cc, add 900 for driver charges. If the car is owned by the employee but the repairs and maintenance is given by the employer, tax the whole repairs and maintenance. Tax the whole repairs and maintenance. From that claim, 1,800 for 1,600 cc, 2,400 for more than 1,600 cc. If you are given driver, add a driver salary. Add driver salary. If repairs is also taken care by employee, car is also owned by the employee, there is no perk for you. There is no perk for. After this, we have something called as transfer of mobile assets. Transfer of mobile assets, again check whether it is computers, car or others. If it is computer, it is cost minus 50% depreciation WDV model for every completed year, ignoring part thereof. Ignoring part thereof. This will become your WDV. Reduce whatever is the amount you recovered from the employee. That will become your taxable perk. That will become your taxable perk. If it is motor car, it is cost minus 20% depreciation WDV for every completed year, ignoring round-offs. Ignoring round-offs. If it is any other asset, it is cost minus 10% depreciation SLM method. 10% depreciation SLM method for every completed year of usage, ignoring round-offs. Ignoring round-offs. Then you have something called as education facilities. Income tax comes and says education facilities should be checked whether it is for employee, for children or for others. If it is for employee, then it is exempt. If it is for children, you need to check whether it is an employer institution. Check whether it is an employer institution. If it is an employer institution, it is fully exempt if it is 1,000 rupees of cost of education per month per child. If the cost of education goes beyond 1,000 per month per child, it is fully taxable. If it is any other person, cost of similar education fully taxable. If you have a transportation facility given, check whether transportation facility is given to railways or airways. Railways or airways. If it is given to railways or airways, it is fully exempt. If it is given to any other person, it is fully taxable. If you are receiving any other perk, normally fully taxable, reducing the amount which is used for official purpose. Reducing the amount used for official purpose. But some perquisites are exempt from tax. First perk is medical reimbursement of insurance. Medical reimbursement of insurance. Second is your telephone allowance. Anything else? Personal accident insurance. And the last item is your tax on non-monetary perquisites. Tax on non-monetary perquisites, because this is going to become disallowed under PGBP. For employer. With this completes your gross salary. In your gross salary, you will include any kind of. You have something called as ESOP also. I was planning to do it in capital gains anyway. If you have any ESOP, then in that case, what you need to do is you need to tax what is your FMB of the asset. Tax the FMB of the shares. If it is listed, then you will tax the average of the opening and closing. If it is unlisted, you will take a valuation officer. Whatever is the FMB of the shares will be taxed as perquisite, minus whatever is the amount which is received from your employee. Will become your taxable ESOP. Since we are in ESOP, let's also clarify that whatever amount you tax as ESOP will be added to the cost of the acquisition for the purpose of capital. Clear? Yes, any other things? Go through, check. Hey, go through from your head, not from your book, useless people. All covered? All covered? Don't worry, people. If there is something forgot, assume that it is not relevant for exam. Have that confidence on yourself. Have that confidence on yourself. ஞாபகம் எக்ஸாம்ல எழுதுவோம். ஞாபகம் இல்லைன்னா exempt அவ்வளவுதான். Don't leave and come. Don't leave and come. Leave பண்ணா ஆன்சர் வராது, மார்க் வராது, மார்க் வரலனா attempt வராது. Correct? Yes or no? Yes or no? If you don't know the answer to something, there is only two answers. Either it is out of syllabus or it is exempt. If it is out of syllabus, it is exempt. If it is exempt, it is clear? Yes, have that kind of confidence on yourself, people. Any doubts? With this completing your gross salary, you have something called as specified employees. In simple terms, specified employees, everything is taxable. In terms, specified employees, everything is taxable because they are not going to have any kind of employee who's having salary less than 5,000 rupees. And the question in the exam, 5,000 per month. 5,000 per month into 12 will become minus 50,000 mandro. Correct? Yes, you are not going to be taxed for those. You are not going to be taxed for those. That questions will not come for exam. So therefore, any kind of specified employees and all ignore for pro exam. Whatever perquisites you have will become fully taxable. Will become fully taxable. You will arrive at something called as gross salary. From your gross salary, first item to mandatory exclude is called as your standard deduction of your 50,000 rupees. Standard deduction of 50,000 rupees. In exam, if the question comes and says that the salary is computed, it means standard deduction granted. If the question comes and says that the salary is given on a monthly basis, standard deduction to be allowed. Standard deduction to be allowed. If the question comes and says this number is income from salaries, it means it is computed. Since it is computed. Yes or no? Yes or no? In this cases, you will not allow standard deduction. But yes, please do understand, if the question gives you the income from salaries and comes and asks you to compute tax as per 115 BAC, you will have to add the 50,000. Have to add the 50,000 because it is already claimed as deduction. You will have to add that 50,000 and then offer it. Unless and until the question comes and says that the income from salaries is as per 115 BAC. If the question says that the income from salaries is 115 BAC, then you will not add anything. If it says that the income from salaries is as per old regime, and then they're asking you to compute taxes per new regime, you will add the 50,000. With this, you will understand your standard deduction. Moving to the next item called as your entertainment allowance will be allowed only for government employees, least of the three. First item is actual. Second item, 5,000 basic. 5,000 fixed. 5,000 fixed. Third item is your 1/5 of the basic pay. 1/5 of the basic pay for the relevant month. For the relevant months. Then comes your professional taxes. Professional taxes simply come and say that, boss, if the professional tax is paid by the employee, reduce it directly. If the professional tax is paid by the employer, add it to the gross salary and then reduce it as deduction. Then reduce it as deduction. With this will arrive at your answer called as income from salaries. This will arrive at your answer called as income from salaries. You have a concept called as relief under 89, has never been tested in exam. Hypothetically speaking, if at all it comes in exam, the provisions are like this. If you are receiving any kind of arrears of salary today, compute the tax today, including that arrears, excluding the arrears. Compute the tax in that respective year, including the arrears, excluding the arrears. Check whether you are paying more tax in the current year compared to the earlier year. If you are paying more tax in the current year compared to the earlier year, claim that excess as relief. Claim that excess as relief. What and all am I speaking? Go and read your book, you will find. Clear? With this, we are done with what is called as. When did we start? We started at 7:30. We are in 8:30. Completed salaries also. Salaries also in a good pace. We are going into moving to the next chapter called as IFHP. Going to the next chapter called as IFHP. After IFHP, we'll jump to capital gains. Then we'll do break. Then we'll come back to PGB. Okay, we'll move IFHP. IFHP starts with the provisions come and say that if you are having a house property in which the assessee is the owner, it will be taxable under the head. IFHP excludes any kind of house property which is used for the purpose of business. Excludes any kind of house property which is let out for the purpose of business. Excludes any kind of land alone. Excludes any kind of land alone because that will be taxable under IFOS. IFOS or PGBP. IFOS or PGBP. I am using the land, not selling the land. I am using the land, not selling the land. If I am using the land, it will be taxable under PGBP or IFOS. Be taxable under PGBP or IFOS. Focus on your books, people. Focus on your books. We are into the provisions of HP where they come and say assessee should be the owner of the property. If the income is from subletting of the property, it will be taxable under PGBP or IFOS. If it is from subletting, it is PGBP or IFOS. But the provisions come and say there is a concept called deemed ownership. Income tax comes and says if the transfer is happening from the owner to his spouse for inadequate consideration, the original owner will be deemed as the owner. The original owner will be deemed as the owner except if it is the case of divorce. Except if it is a case of divorce, in better English, agreement to live apart. Agreement to live apart. If you are not transferring it to your spouse, you are transferring it to your minor child, but not transferring it to your minor married daughter. If you are transferring it to your minor married daughter, clubbing provisions will come into picture. Taxation will happen in the hands of in-laws. Will happen in the hands of in-laws after allowing an exemption of 1,500 rupees. After allowing an exemption of 1,500 rupees. Done. Yes. And then you have something called as any kind of house in which you are living for a continuous period of 12 years. In that case, also the tenant will now become the deemed owner. Tenant will become the deemed owner. If you have a house property, you have to split your house property into two. Check whether it is an SOP property or an LOP property. If it is an LOP property, it is directly taxable. If it is SOP property, check whether you have more than 2 house properties or less than 2 house properties. If you have less than 2 house properties, both the house properties are SOP. If you have more than 2 house properties, any 2 house properties at the option of the assessee will be taxed as SOP, balance will be taxed as DLOP. Balance will be taxed as DLOP. If you are into the business of selling out of houses, and you have a stock in trade of house, for the first 2 years from the end of the financial year in which the house is completed, I will treat all the properties as not taxable. After 2 years, these properties will become DLOP. After 2 years, the properties will become DLOP. Again, coming back to the format. The format starts with municipal value or fair rent, whichever is higher, compared with the standard rent, whichever is lower, compared with your actual rent for the whole year, ignoring vacancy. Actual rent for the whole year, ignoring vacancy, will be compared with your standard rent, whichever is higher. That will become your gross annual value. But yes, if there is a vacancy loss and you are treated as a good citizen because your actual rent for the whole year ends up being higher than your expected rent, you can claim vacancy loss. What is the condition? You should have actual rent for the whole year higher than your expected rent. In that case, you can claim your vacancy loss. If your actual rent ends up being lower than your expected rent, no vacancy loss. You will arrive at your GAV. In that GAV, you will reduce municipal taxes paid only by the owner. You will arrive at something called as NAV. In that NAV, you will reduce 30% of NAV. Flat. 30% of NAV flat. Will you give any repair expenses? Any insurance expenses? Any repair expenses? Nothing will be allowed as a deduction. Everything will be subsumed under the 30% of NAV. And then you will reduce something called as interest on loan. When it comes to interest on loan, split into 2. SOP, LOP. If it is LOP, everything is allowed as deduction. If it is SOP, check for 3 conditions. Condition number 1, loan should be taken after 1999. Condition number 2, loan should be only taken for acquisition or construction. Condition number 3, house should be obtained or constructed within a period of 5 years from the date on which you took the loan. If you satisfy the condition for that house, you will get maximum 2 lakhs. Don't satisfy the condition for that house, you will get 30,000. But all put together, you can only claim 2 lakhs per year per assessee. This is what the conditions are. If it is interest on loan, they come and say any kind of loan taken for repaying the old loan, interest will be allowed. Any kind of loan taken for paying municipal taxes, not allowed. Any kind of interest on interest, not allowed. Any kind of penalty paid for that interest, not allowed. Any kind of interest paid outside India, allowed, provided you pay TDS, obviously. If you are into interest on loan, you also have a special concept called as pre-construction interest. Income tax comes and says that, boss, if your house was not completed when you took the loan, you can only claim interest from the date on which the house is completed. So you need to compute the pre-construction period. Pre-construction period will start on the date on which you take the loan. Till the last day of the preceding previous year. preceding previous year. In your exam, your previous year is 22-23. So if the house is completed in 22-23, you will take the loan up to 31st March 2022. 2022. This is what your pre-construction period will be. Compute the interest on that pre-construction period. Allow it over a period of 5 years, starting from the date on which the house is completed. Starting from the date on which the house is completed. This interest will simply be added to the current year interest before you check for the 2 lakhs or 30,000. Before you check for the 2 lakhs or 30,000, this is not over and above 2 lakhs or 30,000. This is inclusive of that 2 lakhs or 30,000. This is your pre-construction period. Then we have a special concept called as unrealized rent and arrears of rent. Income tax comes and says that if you have received rent of earlier years today, it will be taxed today, even if you are not the owner, but you will be allowed 30% standard deduction. If you have not paid rent, if you have not received rent in the earlier years, you will be allowed a bad debt in that respective year, subject to 4 conditions. Condition number 1, tenant should be bona fide. Condition number 2, you tried to collect the rent. Condition number 3, you asked him to vacate the property or you tried him to vacate the property. Condition number 4, if he vacated the property, he should not take any other property. If you satisfy all the 4 conditions, the unrealized rent will be reduced from your actual rent while computing your GAV. It will directly be reduced from your actual while computing your GAV. In the year in which you receive this unrealized rent, it will be taxable after allowing 30% standard deduction. Now comes your special concepts. First one comes and says that if you have taken a house and part of the year you lived in SOP, part of the year you lived in LOP. In that case, it will be deemed that the house is always LOP. In which case you will compute the standard, you will compute the municipal value for the whole year, fair rent for the whole year, standard rent for the whole year. Actual rent will be only considered for the respective months. You will not extrapolate it to the whole year. You will check it for the respective months. You will compare that expected rent for the whole year with the actual rent of the respective months, whichever is higher. You will arrive at your GAV. When you are allowing your interest on loan, you will allow the full interest on loan, assuming that the full property was LOP for the full year. Rahul, you have one property. Part of the property you are using for SOP, part of the property you are using for LOP. Income tax comes and says split all the common items basis your common floor area. So what are the items will be split? Municipal value will be split. Fair rent will be split. Standard rent will be split. Actual rent will not be split. Municipal taxes will be split. Then you will have your 30% of NAV will be for only LOP, and then interest on loan split. Interest on loan will also be split. For the SOP portion, you will allow 2 lakhs or 30,000. For LOP portion, you will allow full. Rahul, I have a property. I own half, someone else owns half. This is called co-ownership. Income tax comes and says, boss, same provisions up to NAV level split. Up to NAV level compute. After NAV is split. Basis your profit sharing ratio. After NAV, you will split basis your profit sharing ratio, and then each owner will be allowed 2 lakhs or 30,000 on that same house. So it is 2 lakhs per owner and not per house. Not 2 lakhs per house, it is 2 lakhs per. Then they come and say, boss, if you have a house where you have also given amenities, this is called as composite rent. Income tax comes and says that, boss, if you are able to split the composite rent into house and others, house will be taxable under HP, others will be taxable under PGBP or IFOS. But if you are not able to split it, then everything will be taxable under PGBP or IFOS. This is what is the provisions for LOP part of the level. If you are into SOP part of the level, income tax simply comes and says, boss, nothing will be considered. The only thing will be considered is your interest on loan. So therefore, you will directly arrive at your loss from HP. If you have a loss from HP, it can be set off against income from HP first. If you are not able to set off against your income from HP, you will set off against any other head of income up to a maximum of 2 lakh rupees. If you are not able to set off against any other head of income, you will carry forward and set off against HP alone for a period of 8 years. Return filing on time Not mandatory. Return filing on time, not mandatory. Clear? Moving to the next part of the syllabus, we are into the next chapter called as capital gains. Hey, you want to do PGBP first? முடிஞ்சிரும் 9:30 குள்ள முடிஞ்சிரும் கண்டிப்பா முடிஞ்சிரும் ட்ரை பண்ணலாமா ஃப்ளோ பிரேக் பண்ண கூடாது அவ்வளவுதான் let's do business we are into the chapter called as PGBP in PGBP we are going to start with the provisions of PGBP where they come and say boss any kind of profits and gains will be taxable under the head PGBP when you're starting with PGBP you have first item called as speculative loss. Income tax comes and says boss if you have any kind of speculative loss it can only be set off against your speculative income. If you are not able to set off against your speculative income please carry forward for a period of 4 years. Return filing on time mandatory. Return filing on time mandatory. What do you consider speculative cases? Those cases where you are not receiving the delivery of the item. You are not receiving the delivery of the item except for one case where you are agricultural commodities you will be non-speculative always whether you pay commodity transaction or don't pay commodity transaction it will always be non-speculative. Balance cases you have to mandatory ensure that you do not receive the delivery. If you receive the delivery it is non-speculative. If you don't receive the delivery it is speculative. If you're starting with PGBP you need to remember 4 words. First word is called as addition, disallowance, allowance, reduction. Yes or no? Yes. Addition meaning those kind of items which are not there but you are adding it. Disallowance means those kind of expenses which you have claimed and you are removing it. Allowance means those kind of items which are not there and you are allowing it. Reduction means those items which are there but you are removing it. There are items which are there but you are removing it. Remove all the 4 items, your PGBP comes into picture. You start from a net profit, add disallowances, add additions, remove reductions, remove allowances, you will get your PGBP. Simple as that. Yes, starting with the PGBP, the first section is called as 30 and 31, talks about your repairs and maintenance and rent and taxes of your land and machinery and your building. If you pay any kind of taxes on your plant and machinery and your buildings, it will be allowed as a deduction subject to 43B. If you are paying any kind of rent, it will be allowed as a deduction. If you are paying any kind of repairs, it will be allowed as a deduction only if it is revenue. If it is capital, add to the cost of the asset. Add it to the cost of the asset. This is what the provisions are. If you are using the property part for office, part for personal, disallow the personal. After you complete 30 and 31, now you have something called as 32, talks about depreciation. Income tax comes and says if you want to claim depreciation you should have a asset should be your ownership. The asset should be first put to use. But if you are having passive use assets like fire extinguishers, it will be depreciated on the date on which it is ready to use. You will not be allowed depreciation on land and goodwill. And then income tax comes and says, boss, when you have a depreciation, check whether the additions is for more than 180 days or less than 80 days. If you are putting to use for more than 180 days in the first year, it will be allowed for full depreciation. Putting to use for less than 180 days, it will be allowed for half depreciation. In simple terms, if the asset is after Gandhi Jayanti, it is full depreciation. Before Gandhi Jayanti, it is half depreciation. This is what the before Gandhi Jayanti, it is full depreciation. After Gandhi Jayanti, it is half depreciation. If you are going to claim half depreciation in the current year, from the next year, full depreciation will start because it is a part of your opening WDV. Whenever it comes to depreciation, you only have one method in Income Tax Act, which is your WDV method. But if you are into power sector entity, you also get SLM method as a choice. Whenever you want to claim the depreciation, check for your block of the assets. First block is building order rate is 10%, furniture rate is 10%, plant and machinery rate is 15%, vehicle rate is 15%, rent and all is not coming for example. Anyway, what is it going on? What were you going on? Plant and machinery is 15%. Plant and machinery is 15%. Motor vehicles is also 15%. Motor vehicles is also 15%. And then you have something called as intangible assets, 25%. Intangible assets is 25%. Give me 1 second. Let me check if something is. அப்படியா ஓ ஸ்ட்ரீம் போயிட்டு இருக்கு சரி ஓகே plant and machinery is 15%, intangibles is 25%, and any kind of books is 40%. Any kind of books is 40%. If you are going to claim depreciation, you also have something called as additional depreciation. Income tax comes and says if you are into manufacturing sector, if you are into manufacturing sector, you will be eligible for an additional depreciation only on your new plant and machinery. Only on your new plant and machinery. New plant and machinery means those kind of items which does not include second hand machinery installed in office, 100% deduction claim, motor vehicles, all these items will not be eligible for new plant and machinery. For balance items, you can claim depreciation of additional depreciation at the rate of 20% if it is put to use before Gandhi Jayanti. If it is put to use after Gandhi Jayanti, it is 10% current year, 10% current year and 10% what the provisions are. Then they come and say, boss, you have to follow a format. In the format, you start from opening WDV, you make your additions. How do you calculate your cost of the asset? You start from purchase price, add any kind of transportation charges, add any kind of installation charges, add any kind of ITC, not eligible. Block credits will be added. Then you will add any kind of trial run expenses, any kind of interest taken on the loan up to the date on which the asset is first put to use. Up to the date on which the asset is first put to use will be also added. You will reduce something called as government grants. Reduce something called as sale value of the trial run expenses. You will arrive at something called as the cost of the asset. But yes, if you have paid any kind of expenses more than 10,000 rupees in non-permissible modes to single person in a single day, it will be ignored for the purpose of the cost. No disallowance happening because you never claimed it as a deduction. Be ignored for the purpose of the cost. This is what the provisions are. Then they put some special scenarios. Special scenarios come and say that if you have used the asset for scientific research, it is 0. If you have brought the asset from outside personal to your business, if it is building, you will allow accumulated depreciation notional level. If it is something which you have not brought, if it is something other than a building, you will directly bring the cost of the asset. If you have taken any kind of loan on it, interest up to the rate on which the put to use will be added to the cost. If you have any kind of ITC not eligible will be added to the cost. If you have any kind of government grants will be reduced from the cost. If you have completed your additions, you will now have something called as sale value. Whatever is the sale value of the assets which you have sold in the current year will be reduced directly from the block. At this point of time, if the sale value overpowers your opening plus additions, in that case you will stop depreciation today and move to capital gains. But if you have sold the whole block itself, then also you will move to capital gains. The only scenario this will be applicable is you have not sold the whole block and the sale value is lower than your opening plus additions. In that case, you will continue depreciation after reducing the sale value. Whatever you arrive is called as your gross block. In that gross block, you will charge depreciation more than 180 and opening WDV at the rate of full depreciation, less than 180 at the rate of half depreciation, not even put to use depreciation, and then arrive at your closing WDV. Whenever you are arriving at your closing WDV, income tax comes and says only reduce that depreciation which you actually allowed. If you had used an asset both for personal and official, you would have disallowed personal. Therefore, when you reduce depreciation also, you will only reduce official depreciation, will not reduce personal. Depreciation. You will arrive at something called as your closing block. After you arrive at your closing block and you complete your PGBP, if you end up in a loss, first priority will be given to unabsorbed depreciation. To the extent the loss pertains to depreciation will be considered as unabsorbed depreciation. Balance will be moved to others. If you have any kind of unabsorbed depreciation, you will set off against any head other than salaries. If you're not able to set off, you will carry forward and set off against any head other than salaries for a maximum period of infinite years. Return filing on time, not mandatory. Return filing on time, not mandatory. Then the provisions are coming and saying about section 35. Provisions are coming and saying about section 35. Income tax talks about scientific research. Income tax talks about scientific research. Simple provision. They say whatever scientific research you have, everything allowed as a deduction. Everything allowed as a deduction except for land. Except for land, no goodwill. Except for land. Any kind of scientific research paid on land will not be allowed as a deduction. Any other scientific research, whether you have incurred in-house or you have donated, will be fully allowed as a deduction. Will be fully allowed as a deduction. After you complete section 35, you have a sale of section 35. You have a sale of section 35. Income tax comes and says, if you are planning to sell your assets of scientific research, you're planning to sell your assets of scientific research, you have two options. Either you can transfer it to your normal business and sell, or you can directly sell. If you transfer it to your business and then sell, when you transfer it to the business, the cost will be taken as zero. Cost will be taken as zero in the block, and then when you sell, you take care as per your block concept. But if you are directly selling, whatever is the deduction which you claimed earlier, or the sale value, whichever is lower, will be added to the EGBP. Yes or no? Similar concept is there in balancing charge when you opt for SLM method. Income tax comes and says, if the power sector undertaking is opting for SLM method, in that case, check for each asset. If you are planning to sell the asset at a loss, whatever is the loss which you get will be allowed as a deduction in the form of terminal depreciation. If you are planning to sell the asset at a profit, in that case, to the extent of the cost of the asset, it will be added as income. Balance, anything above will be added to EG. After you complete your scientific research, you now have something called as investment allowances. Income tax comes and says, I am identifying some businesses for you. Some businesses for your exam purposes. One is your hotel of 2-star and above, hospital with 100 beds and above, warehousing facility given for agricultural produce or sugar, does not cover edible oil. All these cases are given for your exam purposes. If you have any kind of specified business like this, whatever capital expenditure you incur on these businesses will be fully allowed as a deduction in the year of incurrence. If you have purchased the asset before the business started, you can claim it in the year in which the business has started. To the extent of capitalization. But you cannot claim a deduction on your land. Goodwill and all is not coming for example. Okay, you cannot claim a deduction on your land. When it comes to scientific research, the provisions come and say that if you have incurred any kind of expenditure where the payment is made more than 10,000 to one person in one day by non-permissible modes, no deduction. Will be. This is what your section 35 comes and says. If you are into section 35 and you plan to sell the 35 asset, if you plan to sell the 35 AD asset, you need to check whether the asset is being sold within 8 years or after 8 years. If you're planning to sell within 8 years, everything becomes exempt. I'm sorry. If you're planning to sell after 8 years, everything. If you're planning to sell after 8 years, everything becomes. But if you're planning to sell within 8 years, what will happen is you will need to add the sale value of the asset. As an income in your books. But if you're planning to transfer it within 8 years to your business, what will you do is you will take the notional depreciation which you would have allowed as a deduction in your normal business. That alone will not be taxed. Balance, everything will become taxable as income, and that number will also be added to the cost of the asset. Clear? Yes. After 35 AD comes a 35D, talks about your preliminary expenses. In exam, you have only individuals and firms. So from your preliminary expenses perspective, it is maximum deduction of 5% of the cost of the project. 5% of the cost of the project or the actual expenses, whichever is lower, will be allowed as a deduction over a period of 5 years. Then after 35 AD, you have something called as VRS scheme. When it comes to VRS scheme, it is allowed as a reduction over a period of 5 years. If you have a family pension scheme, for inter-exam, it is fully allowed. Any kind of family pension payments in inter-syllabus is fully disallowed disallowed it is only allowed for companies. So if you read something called as family pension in exam, simply take it and allow it. Allow it. After that, you have something called as zero coupon bonds. Zero coupon bonds, like whatever is your loss from a zero coupon bonds will be amortized over the number of months. Amortized over a number of months. If that month has less than 15 days, it will be ignored. If the month has more than 15 days, you will consider. Then you have something called as interest on borrowed capital. Interest on borrowed capital comes and says check whether the check whether the loan is taken for capital asset or business. If it is taken for business, it is allowed subject to 43B. If it is taken for capital nature, check whether the asset is put to use or not put to use. If the asset is put to use, you will capitalize. If the asset is not put to use, you will capitalize. If the asset is put to use, you will allow as a deduction subject to 43B. Subject to 43B. Then you have something called as employer's contribution to pension scheme. Like I clarified to you, any kind of employer contribution, you can maximum only pay 20% of that as NPS, 20% of that as NPS, 20% of the salary. Salary here means basic plus DA forming part. Salary here means basic plus DA forming part. Whatever you pay as salary will be allowed as a deduction for the employer, will be taxed as salary for employee, will be claimed as a deduction under 80 CCD. Then you have the most important provision from exam called as contribution to funds. Contribution to fund. Income tax comes and says, boss, if it is an employer contribution, if it is an employer contribution, if the employer makes a contribution to an approved fund, it is allowed as a deduction, subject to 43B. Subject to 43B. But if the employer is making a contribution to your non-approved funds, then in that case, not allowed as a deduction when you make the payment to the fund, allowed as a deduction when you make the payment to the employee. If it is an employee contribution, then employee contribution, you need to ensure that the payment is happening within the due date of the respective act. Due date of the respective act. If you make the payment within the due date of the respective act, it will be ignored. If you don't make the payment within the due date of the respective act, it will be treated as an income for your books, will be permanently added as an income. But if it is an employer contribution, then in that case you have a time limit up to the due date of filing of return of income. If you make the payment by the due date of filing of return of income, you will get the deduction. If you don't make the payment, it will be disallowed, but allowed in the year of payment. Then you have something called as bad debts. Income tax comes and says that whenever you have an expense in the nature of bad debts, you need to satisfy certain condition of accounts. Condition number 1, you should have offered income. Condition number 2, the money should not be recoverable. Condition number 3, you should have written off the debt. In these scenarios, the bad debts will be allowed as a deduction for you. The moment the bad debt is allowed as deduction for you in the current year, in the year in which you get back the money, it will be taxable. But if the assessing officer chose to not allow the full bad debts in the year of expense, in that case, whenever you recover, you can claim that as a deduction. So if you had a bad debt of 100 rupees, but assessing officer only allowed 60, next year you got 70 rupees. Next year you were supposed to get 70 rupees. You got 70 rupees. In that case, how much did the assessing officer not allowed earlier? 40. So you will now only offer to tax 30. Because 40 already offered last year or earlier years. Now balance left off is only 32. Any doubts? After you complete the bad debts, you have some miscellaneous things. Miscellaneous things comes and say any kind of insurance premium which you pay will be fully allowed as a deduction, provided it is for your business. And then they come and say any kind of bonus or commission which you have paid to the employees will be allowed as a deduction, provided it is not an appropriation of profit. Coming to the most important thing called as section 37, talks about general expenses. Income tax comes and says you have to satisfy certain conditions for your general expenses. First of all, it should be revenue in nature. Second of all, it should be incurred in the current year. Third, it should be incurred by the owner. Fourth, it should be incurred for the business. One, should be not penal in nature. In that scenarios, it will be disallowed. Some examples are CSR expenditure, allowed. Donation paid to political parties, disallowed. Donation paid to charitable organization, disallowed. Any kind of freebies given to medical officers, disallowed. This is an amendment for the current year. Any kind of freebies and all which you pay to medical officers will be treated as an illegal case. Will be disallowed. Any bribe paid to police officers, disallowed. Interest paid to MSME, disallowed. Any penalty paid under a contract of business, allowed. Any penalty paid to government, disallowed. Any penalty paid for GST, disallowed. Any penalty paid for income tax, any interest paid on GST, allowed. Any interest paid on income tax, what the provisions are. Clear? 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 Yes, this is what the provisions are from section 37. Moving from section 37, we have something called a section 40. Section 40 starts with TDS. That's what TDS. Income tax comes and says, boss, whenever you have a TDS, you need to check whether the payment is happening to a resident or a non-resident. Whenever you are following TDS, you need to ensure that the TDS is deducted within the due date, within 31st March. And the TDS is deducted within 31st March. Whatever is the deducted TDS should be deposited before the due date of filing the return. If you ensure these two conditions are satisfied, the expense will be allowed as a reduction. If not satisfied, 30% will be disallowed in a non-resident, 100% will be disallowed in a 30% will be disallowed in a resident, 100% will be disallowed in a non-resident, will be allowed in the year in which the TDS is deposited. Will be allowed in the year in which the TDS is deposited. What the but they come and say that, boss, if at all you had disallowed your TDS, at all you had disallowed your TDS, and the other person has ensured that he has paid the tax. The other person has ensured that he has paid the tax. The day on which he files the return and proves that he has paid the tax, you can claim the reduction that year also. Claim the reduction that year. Clear? Yes. After section 40A comes 40A2, which talks about your taxes. They come and say, boss, any kind of income tax which you pay, along with any kind of surcharge, cess, interest, late filing fee, whatever you pay under income tax will be fully allowed. But any kind of taxes which you pay under any other act will be allowed except for penalty. Balance items you can ignore. Into the next item called as 48.2 talks about your payment to relatives. Talks about your payment to relatives. From this perspective, you need to understand what your relatives are. Relatives means left side of the IFOS. Left side of the IFOS. Abdina enna artham? Assessee, spouse, parents, siblings, descendants, ascendants. Yes, parents, siblings, spouse, descendants. All these people are your left side of the people. In this scenario, income tax comes and says, boss, if you're going to incur an expenditure for these kind of people, you're going to incur an expenditure for these kind of people, please ensure it is at market value. Please ensure it is market value. If the assessing officer finds some expenses unreasonable, then in that case, it will be disallowed. This only applies to the left side of the business, does not apply to the right side of the business. If you are going to make a payment to your siblings, spouse's siblings, if you're going to make a payment to your spouse's siblings, it will be allowed. It will be fully allowed. If you are going to make an unreasonable income, reasonable income will be allowed. Unreasonable expense will be disallowed. Unreasonable income has no criteria. Reasonable income has criteria. Unreasonable expense has a clear. Yes. After completing 48.2, you now move into 48.3. This is the provision which comes and says, if you have made more than a cash payment to a single person in a single day, more than 10,000 rupees, in that case, the expense will be disallowed. But if you have not made the payment in the current year, you have accrued the payment in the current year and made the payment in the subsequent years, in that case, it will be treated as income in the subsequent years. It will be treated as income in the subsequent years. Certain exceptions given to you. First exception, they come and say that if you are a transport operator, you can claim a deduction of 35,000. You can claim a number of 35,000. If you have made the payment to your employee who's been situated some other place where there is no banking facility, allowed. If you are going to make the payment to your farmers for agricultural produce, allowed. If you are going to make the payment on a bank holiday, disallowed. Bank holidays disallowed because you still have an online payment mode. These are what you need to remember. Any kind of payments happening through a bill of exchange, allowed. Any kind of credit offsetting in books, allowed. You make a payment, you receive a payment, knock off also. All these are allowed as a deduction. What are your permissible modes? It is account pay check, account pay draft, electronic clearing system, debit card, credit card, NEFT, RTGS, IMPS, UPI, Bharat Pay, Team Pay, Some Pay, all pay. Yes, all these are allowed as a deduction. After you complete 48.3, you move into 40A. 40A7 and all is not coming. 43A. 43A, this provision comes and says that if you have any kind of assets which you have purchased from outside India, if you have purchased a capital asset from outside India and you have not made the payment till date, any kind of foreign exchange loss or gain which you have should be capitalized. If you have a foreign exchange loss, you will add it to the asset. If you have a foreign exchange gain, you will reduce it from the asset. Rahul, I did not take an asset on credit. I took a loan. In that case, whenever you repay the loan, whatever is the repayment or a foreign exchange gain or loss will be added to the cost of the simple and straightforward provision. straightforward provision. After 43A comes 43B. Next most important provision from exam perspective. Income tax comes and says that, boss, there are certain items for which I will allow the payment only on payment basis. Items are tax, employer's contribution to funds, bonus or commission, interest on loan paid to banks or NBFCs. Last item, leave encashment, use of railway assets. Leave encashment and use of railway assets. All these payments have to be done within the due date of filing the return of income. If you make the payment by the due date of filing of return of income, it will be allowed as a deduction. If you don't make the payment within the due date of filing of return of income, it will be disallowed and allowed in the year of actual payment. Rahul, I had an interest. I converted into loan. The amendment for the current year comes and says, if you convert it into loan or a debenture, wherever you have treated it, you will only get the deduction when you repay the loan or the debenture. In earlier cases, we used to learn only loan. Now we have debentures also. Provisions are still the same. After you complete that, you have something called as waiver of loan. Income tax comes and says that when you have a waiver of loan, check whether the loan waiver is happening for a working capital or it is happening for a fixed asset. If it is happening for a working capital, you will add it to the income. If it is happening for an asset, you can ignore it and go. If it is interest, you will add it to an income. If it is principal, you will ignore it and go. This is only for current year. Next year things are changing. Not relevant for your exam. Okay. Next item, we are moving into something called as statutory provisions. In statutory provisions, first item is for your firms. Income tax comes and says that whenever you are going to make a payment of remuneration to your partners, it will be taxable under the head PGBP. Where you pay share of profit, it is exempt from tax. If you pay any kind of interest, it is allowed up to a maximum of 12% of the capital. If the firm pays more than 12%, it will be disallowed in the hands of the firm and exempted in the hands of partner. If it pays less than 12%, it will be allowed as expense in the hands of firm, treated as income in the hands of partners. Next item is your remunerations. Income tax comes and says any kind of remuneration paid to partners will have to go through a book profit model. Book profit in simple terms means PGBP ignoring the salary. After claiming unabsorbed depreciation. After reducing your unabsorbed depreciation. So PGBP after claiming your unabsorbed depreciation but ignoring your partner's salary will be considered as your book profit. First 3 lakhs of the book profit will be allowed as a deduction up to 90% of the book profit or 1,50,000, whichever is higher. Balance book profits will be 60% of the book profits. Compute your whole remuneration, compare it with the actual remuneration, whichever is lower will be allowed as a deduction from your book profits to arrive at your PGBP. What the provisions are when it comes to your firms. Moving to the next part of the provisions for your administrative provisions. The first provision talks about a maintenance of books of accounts. Income tax comes and says, boss, if you are into business or into profession, tell me whether you have a gross receipts of more than 1,50,000 in all of the last 3 years. Or you're expecting 1,50,000 in the current year. In this scenarios, you mandatory have to maintain books of accounts, which I tell you. I will tell you books of accounts in the form of journal, cash book, daily case registers for medical people, carbon copies, bill purchases, bill receipts, daily case registered for medical people, daily inventory logbook for medical people. These are the cases. Rahul, I do not have a gross receipts of more than 1,50,000 in any of the 3 years. Or missed out in 1 year, you still have to maintain books of accounts, but I will not prescribe it to you. If you are into business, check whether you are a individual or HUF or others. Check if you are an individual HUF or your others. If you are an individual or HUF, you need to check whether your PGBP goes more than 2,50,000 or your turnover goes more than 25 lakhs. If you are into others, you need to check whether your PGBP goes more than 1,20,000 or 10 lakhs. For any of the last 3 years, or you're expecting this limit to be crossed in the current year. In this scenarios, you will have to maintain books of accounts as per your convenience. You don't satisfy the conditions, no need to maintain books of accounts. After you maintain books of accounts, you need to get them audited. How do you get them audited? You need to check whether you are into business or profession. If you are into profession, you need to get them audited if it goes beyond 50 lakhs. If you are into business, you need to get them audited. If you need to check whether you are making your cash receipts and cash payments by more than 95% or less than 95%. If your cash receipts or cash expenditures are less than 5% of your total expenditure or total receipts, your turnover will become 10 crores. If your cash receipts or cash payments exceeds more than 5% of your receipts or payments, it will become 1 crore. But yes, they are coming and clarifying that if in subsequent cases where you're opting for presumptive and you choose to opt out of presumptive, you mandatory have to maintain books of accounts. You mandatory have to maintain books of accounts. If you are going to maintain books of accounts and get them audited, you will have a due date of return filing of 31st October. You will have a due date of return filing of 31st October, in which case your tax audit has to be submitted on 30th September, 1 month before. 1 month. Moving into your presumptive model, you have 3 kinds of presumptive models. First one starts with 44 AD, talks about business. Income tax comes and says if your turnover is less than 2 crores, you have to opt for presumptive. If you're opting for presumptive, you will check whether your payment of revenue is happening by permissible modes and the payment is received within the due date of return filing. If it is satisfied those 2 conditions, your rate will become 6% of the turnover. You don't satisfy the conditions, the rate will become 8% of the turnover. The moment you do these 2 items, your whole PGBP is assumed to be computed. You will not allow any further additions or deletions or deductions or reductions. Everything will be ignored. Everything will be assumed as considered, including your unabsorbed depreciation. In this scenario, your due date of filing of return will become 31st July, and your advance tax last installment will be only last quarter. Rahul, I was in presumptive, but I want to opt out of presumptive. You can opt out of presumptive provided you maintain books of accounts and you get them audited. But if you have opted for presumptive and you opt out of presumptive, next to 5 years, no presumptive. For you. Clear? Yes. After you go to 44 AD, you now move into 44 ADA. Income tax comes and says that if you are into a profession, where the gross receipts is less than 50 lakhs or up to 50 lakhs, in that scenario, you need to offer 50% of your gross receipts as your PGBP income, in which scenario your other expenses will not be considered, your deductions will not be considered, no adjustments to be made under PGBP. Your due date of return filing will become 31st July. You don't have to maintain books, you don't have to get them audited, but if you opt out of presumptive, you have to maintain books and get them audited. Last provision is 44 AE. Income tax comes and says that if you are into transport operations, check whether you are having less than 10 vehicles at any time in the previous year. If you have less than 10 vehicles at any time in the previous year, in that case, you are eligible for presumptive. You need to split your vehicles into heavy good vehicles and others. It's not light good vehicles, it's others. Heavy good vehicles means those kind of vehicles where the ton capacity is more than 12 tons. 12 tons is the capacity, in which case you will do 1,000 per ton per month or part thereof for the period you had the asset. If you have other than heavy good vehicle, you will tax 7,500 per month or part thereof for every month you had the asset. Rahul, I bought the asset in April, but I put to use in July. I will put presumptive from April. It is from the date on which you bought the asset and not from the date on which you use. Clear? Yes, this is what marks the end of your PGBP. We have time till 9:30. So we are completing the next small leg of the chapter called as agriculture income. I told you, it is 9:30 or the chapter, whichever is. I'm a man of my word. Yes. Moving into the chapter called as agriculture income. Income tax comes and says that, boss, if you have any kind of agriculture, focus. If you have any kind of agricultural income, it is partial integration. If you have any kind of agriculture income, please stop using the word exempt. Start using the word partial integration. Start using the word partial integration. If you have any kind of agricultural income, you are now liable for partial integration. How do you become an agricultural income case? You will have to check whether you are doing operations on a land. You're doing operations on a land, or you're doing any kind of operations which are required to make that produce to become saleable. Yes, or you are having a building which is on the land, or you have a building which is on the land, or you're selling the land itself, or you're selling the land itself. The land which you're talking about should be a rural agricultural land. A rural agricultural land. What do you mean by rural agricultural land? Land which is not an urban agricultural land. What do you mean by an urban agricultural land? Land in which you are going to check the population with the municipality limit. If you are into the municipality limit, population should exceed 10,000. If you are within 2 kilometers of the municipality limit, it should exceed 10,000. If you are within 6 kilometers of the limit, population should exceed 1 lakh. If you are beyond 6 kilometers but up to 8 kilometers, population should exceed lakhs. If you are beyond 8 kilometers, everything is rural. Everything is rural. Whenever you are considering this, always check the shortest distance on an aerial format. On an aerial format will become your agricultural income. Here is where they have one exception, where they came and clarified that if you are going into income of nursery, where you have put some seedlings or saplings in a nursery, that will become exempt even if it is not on operations of land. And at this point of time, you need to understand what happens with your income. If you have a composite income, where you are having income from agriculture and income from PGBP also, you need to check what kind of income you have. If you have an income from tea, you will tax 40%. You will tax 40% and not tax 60%. If you are into rubber, 35 and 65, 35 plus 75, 100 varum. 35 plus 65. If you are into coffee, check whether you have 2 words or 4 words. If you have 2 words, it is 25, 75. If you have 4 words, it is 40. And if you have any other kind of income, you will start doing process costing. Where the business and the land will be separated. When you are trying to sell the products from the land, it will be sold at FMV of the produce. And for the factory, it will become cost. Keeping this in mind, you will compute the income for agriculture separately, compute the income for business separately, and you will tax it. If you are going to tax it, you need to start following the model of partial integration. Income tax comes and says, check whether who are you first. If you are an assessee with a slab rate, then wait. If you are an assessee with not a slab rate, partial integration does not apply. Agriculture income becomes exempt. If you are a person who is following slab rate, in that case, check whether your agriculture income goes beyond 5,000. If the agriculture income goes beyond 5,000, partial integration is ignored. Agriculture income becomes exempt. If your agriculture income is more than 5,000, check whether your other income is going beyond the basic exemption limit. If it is less than basic exemption limit, partial integration will not apply. Income exempt. If your other income is more than the basic exemption limit, add your agriculture income and check if the slab is changing. If the slab changes, partial integration applies. If the slab does not change, partial integration does not. If you have an agriculture income, you have an other income, your other income is more than the basic exemption limit, and your other income plus agriculture income changes your slab, you will follow the model called as partial integration. Step number 1 is to compute tax on your normal income plus agriculture income. Step number 2 is to compute tax on your basic exemption limit plus your agriculture income. Step number 3, you will reduce step 1 minus step 2. This is your final answer. Step 1 will be done after cess. Step 2 will be done after cess. Step 3 will be step 1 minus step 2, no more cess. Yes. இதுக்கு மேல capital gains ஆரம்பிக்கணும், டைம் ஆகும். அதனால let's go for a breakfast break. I think we are at good speed. The speed ku pona, I think அப்படிதான் தோணுது. லஞ்சுக்கு முன்னாடியே முடிஞ்சிற மாதிரி இருக்கும். Yes, I think the pace is going good. I think the pace is going good. Maybe we'll complete before lunch also. In case that happens. In case that happens, have a mock test paper in Sankara. I will be circulating that paper and you will be writing a test. என்னத்துக்கு marathon வந்திருக்கீங்க? If if we complete, I do not expect anyone to sit here more than 6 o'clock. Okay, so if we complete by 3, the mock test paper will be handed over to you and you will be given that to write. You can choose to write IDT also, your choice. You write only DT also, your choice. Okay, but you will be completing those papers and you will be giving it. Okay, if we complete on time, if you don't complete on time, which means we go beyond 5, I will have that mock test paper circulated back to you. Along with the answer keys. You'll solve the paper, you will write the answers, you will give it back to me saying, Rahul, I scored this much. Okay, I expect this out of everyone who's planning to pass. Disclaimers. I expect this out of everyone who's planning to pass. To fail the test also, I don't mind. Ideally, you should not. Ivlo close vandittu fail agiradhu kashtam. Even if you fail the test, that's okay. I always tell my friends that, boss, whenever you start an attempt, the first paper is always a failure. Therefore, always ensure that the first paper happens in the form of mocks. Don't keep your first paper as your exam paper. Because first paper is supposed to be a failure paper. You keep it as your exam paper. And you know, comedy, you'll think, Rahul, exam paper means first time I failed, the second time I'll pass. No, attempt is shaped, I don't. It resets every attempt. So next attempt, again, first time you try, again, first time is a failure only. Okay, so ensure that you have done it. If you've already done mock test papers till now, great. This is your second mock test paper. And the third mock test is happening by ICI. Third mock test is happening by ICI. You will answer that also. 3 mock test papers, 100% exemption coming. If you don't answer these many also, 2 papers minimum. 2 papers per subject or per tax. Per subject. Ella subject to minimum 2. If you're planning to only score exemption in tax and fail in others, your choice. Per subject, 2 mock papers. Complete 2 mock papers. Third paper, definite exemption only. Definite. Plan accordingly. Yes. Let's go for a breakfast break and come back. 10 o'clock. 10 o'clock. Yes. Start at 10. Let's start. Okay. I do understand speed கொஞ்சம் அஸ்தியா இருக்கு. I do understand the speed is going a little bigger, so maybe we'll reduce on the speed, but the point is very simple. See, the speed is what I'm going at. If you are able to understand the kind of speed you have to follow for your preparations also, right? If in my speed you can cover it in 4 hours, then that means you can grab the word, right? But yes, since it's marathon and I'm running YouTube, maybe I'll go a little slower for the benefit of everyone else. Try to go a little slower, but yes, again, strictly speaking, when there comes an amendments and all, I will take my time. I'll explain all those things because that's what the most important thing from some perspective. Anything which is already there in the syllabus and not changing for much often, I don't have to spend so much time, right? Having said that, let's start with the chapter called as capital gains. Let's start with the chapter called as capital gains. In the chapter called as capital gains, which comes and clarifies that any kind of transfer which you do of a capital asset will be taxable under the head capital gains in the previous year in which the transfer takes place. The previous year in which the transfer takes place, this is what the provisions of capital gains come and say, for which we need to first understand what do you mean by a capital asset. In simple terms, income tax comes and says any asset which you have is a capital asset. The only thing which is not a capital asset is the stock in trade item. The stock in trade item, if you hold something as a stock in trade, it will not be called as a capital asset. Balance every item will be called as a simple term. Yes. Second thing, they're coming and saying, boss, you have to tax what is in a transfer. What is in a transfer? So we need to understand what the definition of transfer is. From exam perspective, it is not relevant, but just to understand, transfer means any kind of sale, exchange, extinguishment, relinquishment, conversions, then compulsory acquisitions, and any kind of redemption of zero coupon bonds. All these items will be called as your transfers. Separately given, I don't think that's separately given. It's a part of the extinguishment. Part of the extinguishment is what you call as a transfer. What you call as a transfer, and then they come and say, boss, tax to be something on transfer, tax to be collected in the year in which the transfer which takes place. Yes, but the problem is there are some exceptions to it. We'll discuss as we go forward with the provisions. But right now, this is what the capital it is. There is another exception to capital asset where they come and clarify that what I'm going to tax is all immovable properties. What I'm going to tax is all immovable properties. But what I'm not going to tax is your movable personal effects. Movable personal effects will not be taxed for you. Balance everything will be taxable. So meaning if it is a movable personal effect, it is not taxable. But if it is an immovable property, it is taxable. But in movable personal effect also there is an exception. There is an exception where they come and clarify that any kind of BA pass DG items will not be considered as a personal movable effect and therefore will become taxable. What do you mean by BA pass DJ? B for bullion, A for archaeological collections, P for paintings, A for work of art, S for shares and securities, S for sculptures, D for drawings, J for. These are the items which are always taxable, whether it is capital asset or not, and the balance items are not taxable. The balance items are not taxable provided they are movable assets. Provided they are movable assets. If it's immovable assets, then there is no problem. There is no problem. It will be taxed, except where it is an agricultural asset, meaning it is a rural agricultural land. If it's a rural agricultural land, in that case, it will become exempt from taxes. Partial integration. In that case, it will be liable for partial. Otherwise, it will be taxable. Otherwise, it will be taxable. What the definition of a capital asset is. With the definition of capital asset, we need to understand the classification of capital. We have two classification of capital assets. One is called as short term, one is called as. How do you check it? Basis your period of holding. Period of holding is what is the basis. In the period of holding, they are come and clarified that boss, you need to check for 12 months, 24 months, 36 months. In 12 months are covered listed securities and shares, then tulips, equity oriented funds, zero coupon bonds. In 24 months listed are unlisted securities, land and building. In 36 months listed are any other items. Any other items, slump sale, jewelry, debentures, etc., etc. Yes, these are all listed in your 36. With this understanding, we need to also understand what do you mean by a period of holding. Period of holding starts from the date on which you acquire the asset till the date on which you sell the assets. But there are certain exceptions given to it. Exception number 1 comes and clarifies that if you have taken an asset on gift, the period of holding will start from the period of holding of previous. Period of holding will start from period of holding of previous owner. Cost of acquisition will also start from the previous owner. Indexation will start from your choice. Your choice. My understanding, it starts from current owner. My understanding, it starts from current owner. Manjulasha case of Pana, it starts from previous owner. Yes, my understanding, it starts from current owner. So you will start with the cost of acquisition of the previous owner, period of holding will start from previous owner, and indexation will start from current. This is the first exception. In this, the only exception which is given is for ESOP. Exception is given is for ESOP. Like I told you, ESOP will become taxable in the head of salary, and so therefore whatever is the cost will become taxable under capital gains. Become taxable under capital gains. Therefore, they came and said period of holding will also start from the date on which the ESOP is acquired. ESOP is acquired. Clear? Yes, yes, yes. The provision for gifts. This is the provision for gifts. After gifts, you have balance items. Balance items simply come and say if you have any kind of transfer from holding to subsidiary, any kind of transfer from subsidiary to holding, any kind of amalgamation, demergers, etc., etc., any kind of conversion of shares into stock or stock into share, share into debentures, preference shares into equity shares, equity to preference, etc., etc. All these items will also not be taxable, in which cases the cost of acquisition will be the cost of the previous asset, period of holding will be the period of holding of previous asset, indexation will start from previous asset. Asset is still the same, owner da change agudhu. If the asset is still with the same owner, the indexation starts from the ownership, it doesn't start from the asset. The only one thing which you should remember is your reverse mortgage. Some tax comes and says if you do any kind of transfer under a reverse mortgage, it will become exempt from taxes. Any amount which is received by the senior citizen will become exempt from taxes. But if the asset is sold by the bank on behalf of the senior citizen, in that case the capital gains will be taxable for the senior citizen, become taxable for the senior citizen, and whatever money you have taken as loan will be recovered from the bank, but no deduction of that will be granted to you. No deduction will be granted to you. This is called as your period of holding. This is called as a period of. After the period of holding classification, understand what kind of formats we have. In income tax, we have two kinds of format, one for your short term, one for your. In short term, we start with full value of consideration, reduce cost of transfer, arrive at net consideration, reduce cost of acquisition, reduce cost of improvement, arrive at gross short term capital gains, in which you will reduce assumptions if at all any. If you go into long term again starts with full value of consideration, reduce cost of transfer, arrive at net consideration, reduce index to cost of acquisition, reduce index to cost of improvement, arrive at gross long term capital gains, allow for exemptions, get the final. Starting with the first item called as full value of consideration, income tax comes and says any asset which you sell, whatever is the value will be called as the full value of consideration. If you are not able to determine the full value of consideration, it will be FMV of the asset. It will be the FMV of the asset. But if it is an immovable property, you need to check the stamp duty value. You will compare the stamp duty value with the actual consideration, whichever is higher. That will become your full value of consideration, with one exception that if the stamp duty value is within 110% of the consideration, you will ignore the stamp duty value and assume your consideration. So no, this is what is 50C. This is what is 50C. In this provision, they also come clarify that if you have been given two stamp duties, one is on the date of agreement and on the date of registration, you will normally consider the date of registration, but you are permitted to use the date of agreement provided you satisfy two conditions. Condition number one, you should take advance money. Condition number two, the advance money should be taken by permissible. These two conditions satisfied, you can also take the stamp duty value as on the date of agreement. If you are not satisfied with the stamp duty value, you can also refer yourself to your valuation officer. If the valuation officer determines the value lesser than the stamp duty value, you will assume valuation officer. If the valuation officer determines the value more than the stamp duty value, you will ignore the value and take your stamp duty value. These are the provisions for your P. In this, they also come and clarify that if STT has been paid on your shares, that will be ignored. Doubts? No? This is your full value of consideration. Next item is your cost of transfer. Any kind of expenses which you have incurred for your transfer purposes will be allowed as an exception, except for STT. Then you move into something called as net consideration. In your net consideration, you need to reduce something called as cost of acquisition. Income tax comes and says any asset which you have, cost of acquisition is the purchase price which you paid. the purchase price which you paid. Some exceptions are given to you. One exception comes and says that, boss, if you purchase the asset before 1st April 2001, before 1st April 2001, you will take the cost of acquisition actual or FMB as on 1st April 2001, whichever is higher. But if the asset which you purchased is the stamp is the immovable property, you will take the FMB or SDV on 2001, whichever is lower. Compare with the actual cost, whichever is. After that, they came and said, boss, any other assets which you have purchased and you had paid gift tax, section IFOS. In that case, whatever is the income, that will also be added to your cost of acquisition. If you have paid any STT on your cost of transfers, that will be ignored. Again, STT paid on your acquisitions are also. So these are your provisions when it comes to cost of acquisition. Apart from that, they also have some things like goodwill and all. They came and said, boss, if it's a self-generated goodwill, value will be. So if it's a purchased goodwill, it is all these normal things. Yes. And I told you already that if it's a transaction which is not regarded as transfer, cost of acquisition will be cost to the previous. What your cost of acquisition? Like if you have to move and make your cost of acquisition into indexed cost of acquisition, you need to multiply your cost of acquisition with the CII in the year of transfer divided by CII in the year of first held by current owner. If you opt for Manjulasha, you can do CII in the first held by previous owner. Exam purposes, it is recommended you do CII in the year of current. For your current year, in the amendment case, your CII of the current year is 331. Apart from that, you also need to remember the CII of 2001, which is 2 are the months which you need to remember from. Now, what are the cases where you will not be eligible for indexation? We will discuss as we go. Yes, after you complete your cost of acquisition, you have something called as cost of improvement. Cost of improvement comes and says any kind of enhancement which you do to your capital asset will be called as your cost of improvement, with certain exceptions. If you have done your improvement before 2001, ignore that. Here, with this completes your cost of improvement. Moving to your gross long-term or short-term capital gains, and then comes your exception. Discuss your exemptions in some time. Before that, let's discuss the exceptions of transfer takes place. Because the transfer exception, the provisions are coming and saying normally the taxability happens in the year in which the transfer takes place, but there are certain exceptions. Starting with insurance, income tax comes and says if at all there is any insurance compensation which you receive for your asset, the capital gains will be computed in the year and the asset is destroyed, but the tax will be paid in the year in which the compensation is received. Yes, in which case indexation will stop on the date on which the asset is. The first exception is called as insurance compensation. Second exception is called as conversion of capital asset into stock in trade. Income tax is coming and saying if you're converting your capital asset into stock in trade, the FMV on the date of conversion will be treated as the full value of consideration for the capital asset, and that will become the cost for the stock in trade. In this case, the tax will be computed in the year in which the conversion takes place, but the tax will be paid in the year in which the asset is sold. This reverse scenario talks about conversion of stock in trade into capital asset. Income tax comes and says when you convert your stock in trade into capital asset, same provisions. The fair market value on the date of conversion will become the sale value for stock in trade, will become the cost for the capital asset. But the problem is in this case, deferment will not happen. Conversion of stock in trade will be taxable in the year of conversion. Sale of capital asset will be taxable in the year of sale. Rahul, how do I remember this? Understand the second leg should be capital gain. Sorry, the first leg should be capital gains. If the first leg is the capital gains will get deferred. PGBP will not get deferred. So if the first computation is going to happen for a capital gains, then that will get deferred with the stock in trade. But if the first tax is going to happen for the stock in trade, that will be taxed in the year of conversion, and capital asset will be taxable in the year of clear? Yes, these are the provisions when it comes to conversion of capital asset into stock in trade. Next item talks about your compulsory acquisition. Income tax comes and says that, boss, if your assets has been compulsorily acquired by the government, the tax will be computed in the year in which the asset is compulsorily acquired, but the tax will be paid in the year in which the first installment of the compensation is received. In this scenario, if you go and you make a further appeal and you get a enhanced compensation, income tax comes and says, check whether the enhanced compensation is come by way of an interim order or by way of a final order. If it is coming by way of an interim order, you will tax it when the final order is received. But if it is received by way of a final order, you will tax it in the year in which you receive it. Tax it in the year in which you receive it. What will be the computation for your enhanced compensation? You will simply take the compensation received minus the legal expenses. Minus the legal expenses, that will become your taxability number. What is the nature of this capital gains? The nature will be copy paste of your original gains. There will be copy paste of your gains. If you have got an enhanced compensation and you receive an interest on that enhanced compensation, this interest will be taxable under the head IFOS. You will allow an exemption of 50%. Will you allow any other expenses? Only allow an exemption of 50% of that compensation. No other expenses will be allowed as a. With your compensation, compulsory acquisition getting over, specified agreement is not a part of syllabus, so you can ignore it. Moving to the next one called as your special scenarios. These are the special scenarios which you know better than I do. Okay, the special scenarios are like this. You received a bonus share from the company. The cost of the bonus share will be 0. But if you receive the bonus shares before 2001, will take the FMV. Why? Because that is more beneficial. Because that is more beneficial to the. You received right shares. You have two options. Either you can take the right or you can renounce the right. If you take the right, the cost of the asset will be the price which you paid to the company. If you renounce the right, you will be given a profit. What is that profit? The renunciation price. So you will tax the whole renunciation price. You have no expenses against it, so everything becomes taxable. But if you are the person who's taking the right, now you have paid two costs, one to the original shareholder, one to the company. So what did you pay to the original shareholder? Renunciation price. What did you pay to the company? Share price. So what is the cost of the acquisition? Renunciation price plus the, what is the period of holding? The date on which you take the share till the date on which you sell the, Then they come and say, boss, if you have done any forfeiture of advance money, check whether the forfeiture is happening before 2014 or after 2014. If it is happening before 2014, you will reduce it from the cost of the acquisition before computing your indexation. If you are going to remove it, if you are going to forfeit it after 2014, you will directly tax it under IFOS in the year of forfeiture. Directly in the year of forfeiture, meaning in an exam, if the question comes and says that the forfeiture is done in 2015, you will ignore the information. Because the information would have already been taxed in 2015. It is not relevant for done. After your forfeiture gets over, now move to your exemptions. In your exemptions, from exam perspective, you need to remember three exemptions. 54, 54F, 54. Starting with the EC. You need to transfer your land and building. You need to acquire some NHAI bonds or REC bonds. Asset to be transferred is a long-term capital asset. You can claim an exemption of the capital gains subject to a maximum of 3 lakhs for the whole year and the respective assets. Meaning, if you have taken 2 capital gains in the current year, full year you can only claim 50 lakhs. If you have already claimed 50 lakhs on one asset, next year you cannot claim any more deduction. On that asset. You have to take the asset within a period of 6 months. If you are taking it within 6 months, CGA scheme does not apply to you, so you will have to purchase it within 6 months. Whatever asset you are purchasing, which is the bonds of NHAI and REC, should be held by you for a period of 5 years. If you choose to not hold it for a period of 5 years, the rule is like this. If the asset which you transferred and the asset which you acquired were the same, you will reduce it from the cost. The assets are different, you will tax them separately. In my question, you had transferred land and building. You had acquired bonds. Same asset, different asset. What will you do? The exemption of land and building will be taxed separately. The sale of the bonds will be taxed. Here. Now moving to the next two exemptions called as 54 and 54F. Income tax comes and says in both the scenarios you need to acquire a house. In 54 you will transfer the house. In 54F you will transfer any asset other than the house. So 54 you need to transfer the house and get a house. 54F you need to transfer any other asset and get a house. In these two scenarios, the income tax is coming and saying, boss, I am giving you time until 1 year before or 2 years after to purchase the new house. or if you are constructing the house, completed within 3 years. Completed within a year. What will be the exemptions granted? If you are in 54, meaning house to house, you can get an exemption if you deposit your capital gains. Deposit your capital gains. With the exception that if your capital gains is less than 2 crore rupees, you can buy two houses. Buy two houses once in a lifetime offer. Once in a lifetime offer, you will get two houses once lifetime. If you are in 54F, you will have to deposit the net consideration. Deposit the net consideration and not the capital gains. If you deposit the net consideration, you will get the capital gains. Meaning, if you deposit anything lesser than net consideration, you will have to do proportion. Proportion. How will you do proportion? You will do capital gains to be claimed as exemption into amount deposited divided by the net consideration. Divided by the. This will become your exemption. What the rules come in. If you have purchased an house property, please hold the house property for a period of years. If you don't hold the property for a period of 3 years, now comes the problem. Income tax comes and says 54, you transferred house, you got a house. Same asset, different asset. What will you do? The exemption which you claimed earlier will be reduced from the cost of the acquisition of the new asset. Be reduced from the cost of the acquisition. If you had transferred any other property and got a house property, the exemption which you claimed earlier will be taxed separately, and the cost of the new house will be taxed. Both the cases, since the period is very long, you have been given an option to opt for CGAS scheme, where you can deposit the money into capital gains account savings scheme within the due date of return filing. If you deposit within the due date of return filing, I will assume you are eligible for exemption, provided you use the money only for the house. For the house. If you choose to violate the condition, in the year in which you violate the condition, I will tax it. The additional conditions come and say that, boss, if you are in 54F, where are you? Where you purchased any other house, when you sold any other thing and you purchased a house, you will be given the exemption of 54F only if you do not hold more than two houses. And two houses. How do you hold more than two houses? You should already hold only one house, and this should be the second house which you are buying. Should be the second house which you are buying. If you already have two houses and you are now getting into the third house, no exemption. No such condition in 54. No such condition in 54. You sell one house, you get another house. No problem for you. Clear? What the exemptions are when it comes to 54 and 54F. At the same time, they are also coming and clarifying that, boss, exempt cases like these will start from the date on which the money is received. Meaning, if you are into compulsory acquisition, you will get the money only on first installment. So exemption will also start from the first installment. In those cases, it will not start from the date of sale of the house. Not start from the date of sale of the house, it will start from the first sale. Right? Meaning you have CGS time limit to deposit from that date. Clear? Are your exemptions to 54, 54F and 54. Now in exam we have 54B and D. Yes. Don't worry. Look at the question. Look at the question. See what is being transferred. See what is being acquired. What is being transferred. What is being acquired. If the question comes and says that you are transferring a capital asset and for some reason you are buying another asset, which is not a NHCI bond or a house property, assume it is one of those exemptions and give it off. Assume it is one of those exemptions, give it off. Rules will be the same. Capital gains will have to be deposited. CGS schemes are available for you. What you deposit and what you transfer, if the same asset, then you will reduce from the cost. If it is not the same asset, you will. What you need to remember from examples. Here, yes. Check what is happening in the question. If the question comes and says that you're transferring a capital asset and you're buying a second capital asset, it can be anything. Let's say, for example, if they come and say that you have sold a land and you have bought a land. Sold a land and bought a land. Is there any in 54? Is there in 54F? Is there in 54 EC? Then assume it is one of these things. Assume it is one of these things. The capital gains which you are depositing will be allowed as an. They come and say, no, boss, there is an industrial undertaking. I'm transferring an industrial undertaking. I'm buying an industrial undertaking. Same rules. Other than that, nothing has to be remembered. Has never been tested in exam except once. Some 3 years back it came. For the smart people, got full marks. They just put everything as exemption. Here. But then do also remember that it should be linked. Suddenly the question comes and says that you have sold a capital asset and you deposit in 5 years tax saving scheme. 5 years tax saving scheme. Is that a capital asset? What is it? 80C. Then 80C. So please understand what asset are you buying. If you are buying a capital asset, then it's an exemption. If it is an investment model, then it is 80. 80. If you're taking the money and just donating, then it is clear. Sir, what the provisions are. After that, we come into the end of this chapter where they come and say, boss, what are the types of capital gains you have? What are the types of capital gains you have? Income tax comes and says that you have three kinds of capital gains. One is called as 112, 112A, 111A, 1A, and then short-term others, and then short-term others. Starting with 112, income tax simply comes and says that any asset which is not covered under 112A, any asset which is not covered under 112A will be covered under 112, provided it is long-term. Provided it is long-term. Tax rate will be 3%. Rebate is applicable. Can you set this off against a basic exemption limit? You can also set it off against your basic exemption. Here, yes. Can you claim Chapter 6A on this? Chapter 6A is permitted. Chapter 6 is only permitted on your slab rate. Yes. After your 112, you go into 112A. You go into 112A. Income tax comes and says we cover three kinds of assets. We cover three kinds of assets. The assets are listed equity shares, listed equity oriented funds, and units of business trust. Units of business trust. If you have paid STT on all these cases, you will be covered under 112A. Be covered under 112A. You don't pay STT, you will be covered under 112. Be covered under 112. In these scenarios, you will be taxed at the rate of 10% in excess of 1 lakh rupee. Rebate is not eligible, and surcharges maximum 15. Charges maximum 15. Chapter 6A. Chapter 6A not applicable. Same logic for short term. Same logic for short term. Income tax comes and says if these assets were short term in nature, it will be 111A. Tax rate will be 15%. Rebate is allowed. Chapter 6A not allowed. Surcharges maximum 15%. Surcharges maximum 15%. Basic exemption limit set off only for residents. Only for residents. 112 maximum surcharges. This year's amendment 15. This year's amendment 15. When it comes to 112A, they have given you a special mode of cost of acquisition. They come and say that, boss, if you had purchased this asset before February 2018, I'm giving you a special mode of mechanism where I will come and tell you that tell me whether it is a share or it is a fund. Share or a fund. And then tell me whether it is listed or unlisted. When in January 2018. January 2018. If the asset was listed on January 2018, you will take the highest price quoting on that day as the FMB. Take highest price quoting on that day as the FMB. Compare this with your actual consideration, whichever is lower. That will be compared with your actual cost, whichever is. This will become your new cost. Become your new cost. If the shares were unlisted, you will compute the indexation of the asset on January 2018. That will become your FMB, will be compared with your consideration, whichever is lower, will be compared with your cost, whichever is higher. That will become your new cost. If the asset was a mutual fund and it was unlisted, the NAV on the date of 2018 versus your consideration, whichever is less, will be compared with your cost, whichever is higher. That will become your new. This will only apply if it is a long term, will not apply if it is short term, because obviously the asset will be purchased after February 2018, in which case the asset cost will be actual. The asset cost will be actual. Here are the provisions. The provisions come and say you need to take FMB as on January 2018 versus actual consideration today, whichever is. यार मिल गया One second, guys. I'll be back. Give me 1 second. Yeah, sorry guys. I will have to edit the whole video, only give it another option. I'll try to edit it by tonight. Anyway, where were we? We were into the cost of acquisition. The model is very simple. The model comes and says you need to do the FMB or the actual consideration, whichever is work, compare with the actual cost, whichever is compared to the actual cost, whichever is higher. This is what the provisions are when it comes to the cost of acquisition, limited for the purpose of 112A, limited for the purpose of 112A, where the acquisition is happening before Feb 2000. Acquisition is happening before Feb 2000. What the provisions are when it comes to 11. This marks the end of your capital gain. This marks the end of your capital gains. Any doubts till now? Doubts till now? No. We have 2 more chapters in capital gains just in my book. One is called as distribution to owners and one is called as business reorganization. Just for my convenience, start with reorganization. The provisions come and say that we have 3 kinds of reorganization. One is called as amalgamation, demerger, stump sale. Amalgamation, demerger and stump sale. Income tax comes and says that boss, whenever there is an amalgamation taking place, amalgamation is not regarded as transfer. Amalgamation is not regarded as transfer. In an amalgamation, 2 kinds of assets are transferred. One is the shares of the shareholder. Second is the assets from the amalgamating company to the amalgamated company. Amalgamating company to the amalgamated company. For the amalgamated company, the cost of acquisition will become the amalgamating company's cost. Period of holding will start from the amalgamating company's period. Indexation will start from amalgamated company. When it comes to shares, if you are leaving your old shares and getting a new share, it is not regarded as transfer, but the new share or cost is cost to the previous owner. Period of holding is previous share, and indexation will start from previous share, same owner, previous share. So it will start from the previous share. Coming to demerger comes and says that you have one company. That one company has been split into multiple companies. Any kind of demerger is also not regarded as a transfer. Any kind of transfer of capital asset from your original company to your demerging company will be not regarded as transfer. Cost of acquisition for the new company will be cost to the previous company, and period of holding from the new company will be period of holding of the previous company. Indexation will start from new company. Indexation will start from clear. Yes, but whenever you get a share, who gets the share? Shareholder has got the share. Initial share which he had has now been split into multiple shares. Yes. So what will happen? The new share cost will be the cost of the original share proportionated into the amount of assets given up. Proportionate into amount of assets given up. What in NR to Rahul? Let's say for example the cost was 100 rupees. Cost was 100 rupees. The net worth of the company was 100 crores. If they had given 40 crores to the new company shares would become 40. How? 100 is the cost into 40 transfer divided by 100 is the total net worth. So 40 will become the new cost of the new company. What will become the old company? It will become the original cost minus this cost which has been transferred. So therefore it will become 60. In simple terms, whatever is the cost of the share will be proportionated between the old company and the new company basis the cost of the assets. This is the cost of the assets or net worth of the building, net worth of the business, net worth of the here. Last and the most important from exam perspective is called as your slum sale. Income tax comes and says slum sale is taxable under capital gains, where period of holding will start from the date on which the unit is created. Start from the date on which the unit is created till the date on which the asset is transferred. But when it comes to slum sale, the assets will always be treated as short term. Assets will always be treated as short term. The gains will resultant be short term capital. How do you do it? You do full value of consideration will be the actual consideration or the fair market value of the assets which is received, whichever is fair market value of the assets which is given off. Fair market value of the assets which is given off, whichever is higher. Less your cost of transfer will arrive at your net consideration. In that net consideration, you will arrive the cost of acquisition, which is nothing but the net worth of the business. But the net worth of the business. Net worth meaning assets minus liabilities. In assets, you need to split your assets. If it is a fixed asset, you will give the WDV as per income tax. But if it is in goodwill, self-generated, zero. Purchase means purchase price. Purchase means purchase price. If you have any other assets, take the actual cost. Take the actual cost. If there is any revaluation happening on the assets, ignore the revaluation. Ignore the revaluation. When it comes to liability side, take the liabilities as is. Take the liabilities as is. Assets minus liability will become your net worth. That will be treated as your cost of acquisition, resulting in your short-term capital gains. Resulting in your short-term capital gains or your long-term capital gains. Have short-term capital gains or your long-term capital gains, both. The only thing which will not be eligible is indexation on it. The only thing which will not be eligible is indexation. I told you that the assets will be treated as short-term. I told you the assets will be treated as short-term. I never told you that the gains will become short-term. I told you the assets will be treated as short-term, which means you will not be eligible for indexation, but the gains will be resulted in a short-term or long-term. The gains will be resulted in a short-term or long-term basis the period of holding starting from the date on which the business unit was created. Moving to the next chapter called as distribution to. This chapter basically covers all your items which you are giving as a company. You're giving as a company. The first item you'll give as a company is dividends. Move to IFRS. So IFRS. Next item which you'll give to the company is buyback. What will you do? Buyback. Income tax comes and says that, boss, whenever there is a buyback happening from the company to its shareholders, the income will be taxable in the hands of company. Income will be taxable in the hands of company, exempt in the hands of shareholders. How do you tax it? You will take the buyback income which you have. You take the buyback income which you have of the shareholder. The shareholder will be taxable at the rate of 20% as LT into 12% of surcharge because it is a company plus 4% of this. Effectively, it will be 23.296. Effectively, it will be 23.296. So any kind of buyback income which you have will be taxable at 20 plus 12 plus 4%. Plus 4% says only if it is a share. It is a share. If it is a debenture or any other securities, it will be taxable as per normal capital gains in the hands of shareholders. The hands of shareholders, debenture holders, whatever it is. The hands of shareholders or also for you. Yes, the last item is your liquidation. Last item is your liquidation. Income tax comes and says whenever there is a liquidation happening in the company, to the extent the company has accumulated profits, that will be treated as dividends in the hands of shareholders. It has dividends in the hands of shareholders. So what you need to do is whatever the amount you receive, who receives? Shareholder. Whatever the amount shareholders receive will be split into two. To the extent of the profits will be taxed as IFOS. To the extent of others, it will be taxed as capital gains. So what will you do is when you're computing the capital gains, your full value of consideration will be the full amount received minus the amount transferred to dividends. Minus the amount transferred to dividends. That will be called as your full value of total money received plus the fair market value of the assets which you have transferred minus the amount which is taxable as deemed dividend. That will become your new full value of consideration. In that you will reduce your cost of acquisition of the shares. Marvin, there is some parent sitting. Minus your cost of acquisition of the shares. Period of holding will start from the shares. Period of holding will start from the shares, and you will compute your long term or short term. You will compute your long term or clear. This marks the end of your fourth head of income called as. Going to the last head of income called as straightforward head of income. Provisions are as simple as possible. Income tax comes and says that any kind of income which is not taxable under other heads of income will be taxable under IFOS. Some examples are dividends, then any kind of interest which you receive on deposits. If it is an interest on enhanced compensation, you are exempted up to 50%. If you are interest on post office savings, you are exempted up to 3,500. If it is interest on savings, taxable. Interest on FD, taxable. If you have any kind of advance for future, check whether it is after 2014. If it is after 2014, it is IFOS. If it is a salary of MPs and MLAs, it is IFOS. If it is a composite rent received on a house property which is not separable, these are all the. And then you have something called as family pension. Family pension comes and says any amount received under a family pension, 1/3 of it or 15,000, whichever is less, will be allowed as an deduction. And any kind of casual incomes which you have will also be taxable under the head IFOS with the tax rate of 30%. Two items from exam perspective most important is your interest on deposit. Income tax is a deposit to government, that's all. Yes, two items which are there from exam perspective is your premium on issue of shares and gift. When it comes to premium on issue of shares, income tax simply comes and says that you should first be a private company or a closely held company. Private company or a closely held company should give shares to a resident shareholder. And the share should be given at a premium. If to satisfy these three conditions, I will check for what is the amount which is received by the company. If the amount which is received by the company is greater than the fair market value of the shares, whatever excess you receive will be deemed as income in the hands of company. Illana, it will not be deemed as. How does it work, Rahul? Let's say, for example, that my share face value is 10 rupees and my premium is 12 rupees. My premium is 12 rupees. Therefore, what I collected is 22. If the FMV is, let's say, 18, the income which will be taxable for me is 22 minus 18, 4 rupees. Rahul, my face value is 22, my premium is 10, my actual. Let's say my face value is 10, I have done no premium. Amount received is 10, face value is 8. Amount taxable is 0. Why? Because there is no premium. No? Rahul, my face value is 10, my premium is 12, my amount received is 22, but my fair market value is 25. Amount will become 0. Why? Because you have anyway collected less than the fair market value. Rahul, my face value is 10, my premium is minus 2. Abdina? Amount received is 8, face value is 4. Again, not applicable because there is no premium happening. Clear? These are the provisions when it comes to a premium on issue of shares. You should be a closely held company, should issue shares at a premium, should give it to resident shareholders. If you satisfy the condition, the premium along with the face value, if the amount collected is more than the fair market value, it will become taxable. Coming to the last leg of IFOS chapter, we are into gift. Income tax comes and says, boss, first identify your asset. We have three kinds of asset. First asset is called as money. Second asset is called as specified movable asset. Third item is called as movable property. If you are receiving money, if you receive more than 50,000 during the year by yourself, by yourself from any number of people. From any number of people, if you receive more than 50,000 in the current year, that will be fully taxable. Fully taxable. It is not 50,000 limit. It is fully. If you are receiving a mobile asset, you need to check whether it is specified or non-specified. Specified meaning BA pass, BJ, B for bullions, A for archaeological collections, P for paintings, A for any work of art, S for chairs, S for sculptures, D for drawings, J for satisfy any of these conditions, you will be liable for tax. If you're not satisfying any of these conditions, it becomes fully. You receive any mobile phones, iPhones, gift, car, refrigerator, TV, all exempt. All are exempt from taxes. If you receive any kind of these items, you need to check what is the fair market value of the assets. Check what is the fair market value of the. If the fair market value of the assets minus the consideration which you paid, if at all you paid, meaning the gift element, if the gift element of all specified movable assets during the year received by you is more than 50,000 rupees, everything will become taxable. When I say everything, the gift element will become taxable. Please understand, multiple assets, all assets to be taken. Multiple assets, all assets to be. Yes, coming to your last one, which is your immobile property. Income tax comes and says split whether it is a nil consideration or inadequate consideration. If it is nil consideration, you will check for your stamp duty value. You will check for your stamp duty value. If the stamp duty value is more than 50,000 rupees, the asset becomes taxable. If you are into inadequate consideration, first check for one condition. The condition is that the stamp duty value should be within 110% of the consideration. Stamp duty should be within 110% of the. If the stamp duty understands to be within 110% of the consideration, income tax says there is no gift happening. There's no gift happening. The amount will become exempt. Now the stamp duty value exceeds 110% of consideration. Now you will check for the gift element. Check for the gift element. The gift element meaning stamp duty value minus the consideration. If it ends up being more than 50,000 per asset, it will become taxable. If not, it will not be taxable. Please understand, when it comes to money, all monies are taxable. When it comes to specified mobile, all specified mobiles are taxable. When it comes to immobile property, per asset will be checked for 50,000. That is the most important thing to remember. Please keep that in mind. It's each property here when it comes to immobiles, whereas when it comes to the other two cases, it is all properties. All property. Any doubts? This provision getting over, what happens is tax comes and says, I'm giving you certain exceptions. They come and say, boss, if you satisfy these exceptions, even if you were supposed to be taxed, I will not tax you. He used the short form called as dirt min clot. Use it as dirt min clot. D stands for death. Any money received on death will be exempt. I stands for inheritance. R stands for, coming to the definition of relatives, you need to check whether you are an individual or a. If you are an individual, you'll start from spouse, parents, siblings, grandparents, lenient ascendants, your kids, lenient descendants, Coming to the spouse side, spouse soda siblings, spouse soda parents, spouse soda lenient ascendants. Coming to your parents side, your parents siblings also. And everyone we discuss their spouses. Are also. What are not covered is your siblings or kids. What are not covered is your spouse or siblings or kids. What are also not covered is your spouse or parents or siblings. Anyone's kids are not covered except for your kids. Anyone's kids are not, obviously your parents can either kid, but okay. Yes, anyone's kids are not covered except for your kids, and your parents, your spouse's parents or siblings are also. What are covered is your spouse or your parents or Clear? Yes. Income tax also comes and says that, boss, if at all you end up taxing something as gift tax, if at all you act to something as tax, the amount which you taxed as gift tax can be added to the cost of acquisition of the. In which case the period of holding will start from. Today. It will not be the period of previous owner. With the R moving off, we now into T. T stands for trust. Any kind of money received from a trust or given to a trust will become exempt. Then M stands for marriage. Income tax comes and says that, boss, any gift you receive on account of marriage is not taxable. Gift should be received by you. If it is not your marriage, it is taxable. If it is your marriage anniversary also, it is so taxable. After dirt, min, I comes. I stands for individual's private trust. Individual's private trust. Then comes N. N stands for non-profit organizations. Comes C. C stands for current year's amendment called as COVID. Current year amendments called as COVID. Income tax comes and says, if at all you receive any kind of COVID receipts, which is by an individual from any person for medical expenditure actually incurred by him, that becomes fully exempt. That becomes fully exempt. If you are receiving it by as a family member of the deceased person, in that case it will become exempt. If it is from the employer, fully. But if it is from any other person, subject to an overall limit of 10 lakh rupees. Subject to an overall limit of 10 lakh rupees, provided that all this should happen within 12 months. That and all is not coming. All is not coming. Yes. So you need to understand that if you are receiving any kind of COVID receipts, that is also exempt from tax, except when it is on death case. Except when it is on death case and all not coming in exam, except for MCQs maybe. In MCQs, if it comes, you just have to say that death case la employer kurta exempt, someone else gives, you will get a maximum of tax. That is what the rule comes in. Here, after C gets over, you have L. L stands for local authorities. O stands for others. T stands for transactions not regarded as transfer under capital gains. Capital gains, except for first item called as gift. For first item called as gift. Any kind of gift is taxable because then only it is taxable here. It is taxable. Clear? Yes. With this getting over, we have a chart in my book. Let's quickly understand what the chart looks like. Starting from an immovable property. We are going to revise the whole gift concept. From every chapter. Starting from the immovable properties, you need to understand whether you are the transferor or the transferee. You are the transferor or the transferee. If you are the transferor, you are going to either give it as a stock in trade or a capital asset. If you are going to transfer your stock in trade as a gift, it will go into PGBP. Where income tax comes and says if it is an immovable property, you need to transfer at SDV. Transfer it at SDV. If you transfer it at SDV, great. You transfer it lesser than SDV, everything becomes stamp duty value becomes your full value of consideration. If you are going to transfer it as a capital asset, income tax comes and asks you, are you transferring it at nil consideration or inadequate consideration? If you transfer it at nil consideration, it is a gift. In which case, capital gains will become not taxable. If you're transferring it for inadequate consideration, comes the provision of 50C, which comes and says that you need to transfer it at minimum of stamp duty value. If not at 110% of stamp duty value. 110% of consideration should be the stamp duty value. 110% of the consideration should be the stamp duty value. You satisfy the condition, great, consideration is actual consideration. You don't satisfy the condition, stamp duty will become your consideration. This is from the angle of your transferor. Coming to the side of your transferee, you need to again check whether it is held as a stock in trade or a capital asset. If you are going to hold it as a stock in trade, you will tax it under PGBP because it is a benefit or a perquisite. If you are going to receive it as a capital asset, now you need to come and check whether it is falling within the dirt min clot or not falling within the dirt min clot. If it is falling within the dirt min clot, are you going to tax it? In this case, what will you do? If the no consideration, then the cost of acquisition will become cost of acquisition of the previous. Period of holding will start from previous. Indexation will start from current. But if you are not going to tax it as IFOS and you are having a consideration, cost of acquisition will become the actual consideration. Period of holding will start from today. Indexation will start from today. Rahul, I am liable for dirt min clot. I am not liable for dirt min clot. Now income tax says this is taxable provided it goes beyond 50,000. If it does not go beyond 50,000, again IFOS will not tax, same provisions as what we discussed now. But if it is taxable as 50,000, then it becomes taxable under IFOS. Whatever you taxed will become added to the cost, which means your new cost will become the stamp duty value. Your period of holding will start from today. Your indexation will start from any of these scenarios. If it is an immovable property, transfer an immovable property, you are liable for TDS under section 194 IA. The moment your stamp duty value or actual consideration exceeds 50 lakh rupees in the rate of 1%. Who will collect this? Who will collect this? Recipient or seller? Recipient will collect it. TDS rather. The person who's paying will collect it. The person who's paying will collect it. So the recipient of the asset will collect it. The recipient of the asset will collect it. He will deduct this taxes and pay it on behalf of the seller. Deduct and pay it on the behalf of the clear. Yes. Coming to the other chart. The other chart talks about specified movable assets. Why am I talking only about specified movable assets? Because if it is non-specified movable assets, it is not taxable as capital gains also. It is not liable for gift tax also. So I am now into the provisions of specified movable assets. Income tax again comes and says check whether it is in the hands of transferor or in the hands of transferee. If it is in the hands of transferor, check whether it is a stock in trade or a capital asset. If it is in stock in trade, you will move to PGBP. But the problem in PGBP is no such provisions are there. So therefore, whatever you sell is the actual sale value. Whatever you sell is the actual sale value. Yes. But if you are into capital asset, income tax comes and says if you have an unlisted share, for that alone they have a special provision where they came and said unlisted share should be sold at a fair market value. In which case, if it is sold at lesser than fair market value, you will assume fair market value as your full value of consideration. Any other asset, take the actuals. Coming to the recipient side, again split into stock in trade or a capital asset. If you are telling it as a stock in trade, you will tax it under CBP. Coming to capital asset, provisions are same. What is the provision? Same. Ade Dirtman clot la varano 50,000 varano 110% 110% inga varadu. Ange 110% varum, inge 110% varadu. So you have to satisfy those conditions. If you satisfy the conditions, then it is not taxable. If it is nil consideration, it is cost to the previous owner. If it is inadequate consideration, it is actual cost. But if you're going to tax it as IFOS, then you will tax it as current IFOS cost. Current IFOS cost with the period of holding from today and indexation from here. Sure. Doubts? This marks the end of your here at 11. Here at 11. Ignoring all the breaks and everything, 7:30 we started. Somewhere around 7:30 we started, took an half an hour break in the middle also. Ignoring that, 7:30 to 11 is how much? 3 hours. Ignoring our break of half an hour, we are at 3 hours, completing our 70% of the syllabus. Covering our 70% of the syllabus, leaves off with only the 30%. In that, the biggest chapter is chapter 6A or TDS. The motto ignore panita, you are almost done. In how many hours? The income tax saga saw the pit in sitting on it, blaming yourself, blaming ICI. Nanda pass aga matigrene. The problem with most of the people, I will tell you, 1.5 days are not effectively utilized. Problem which most of the people do is in the 1.5 days, you're only revising. Anyone revising one time in your 1.5 days is definitely bound to fail. If you cannot complete the whole chapter subject with at least 3 times revision, you are bound to fail. 1.5 days is a boon for you. 1.5 days can do magics. Ask your CS and CMA people. They have no breaks. Next day they have exam. They only get half a day break. Half a day kuda solradhukku irukku. And 5 o'clock you will get over. You will come back home, you will sleep, you will eat. Adukulla time ayichu. Yes. Imagine the kind of boon you are getting. 1.5 days is a boon. Dark morning. Depends, ma. December it is evening exam. Na eldirken manik theriyum. You have December exams in evening and June exams in morning. It depends. Anyway, the point is what happens is you get that much kind. You don't get that much kind of luxury in other exams. You get the luxury only in exams. Yes. So you have to be extra happy about the fact that you're getting something. At the same time, effectively utilize it also. 1.5 days. 1.5 days. Plan it properly. Stop sums on the day of exam. Stop doing sums. Not your practice day. It is you're still sitting and solving sums on your day of exam. You're still not ready for this attempt. Maybe you're planning for next. Okay, no confidence varla sum solve pandradhukna, there is no point writing the exam. Aduk marks sollidalam. I will call it as good as a mock. The only difference is mock you did not pay. Here you're paying some 1,200 rupees. 1,500. Maritangla. 1,500 then exam fees. ICI has enough money already. You're not contributing to any welfare fund right now. Okay, so don't try to contribute too much to their welfare fund. For some reason, they are already very rich. Once you get over, you will become a member of this company. They will send you the financial statements. So kind of money which they're bringing out of students. The students who are sitting here, you are at least planning to write. There'll be some friend of yours who would have already decided Vana in the attempt. But that person would have already paid the fees also. So comedy free money for ICI. Pure free money for ICI. They are also like was already rich enough. The problem is after you qualify, you anyway have to pay membership fees. After you qualify, you anyway have to pay membership fees. Every year I am paying some 1,960 rupees without COP. எதுவுமே பண்றதுக்கு இல்ல, சும்மா ஒரு பேர் வைக்கிறதுக்கு. அந்த சிஏ டைட்டில் போடுறதுக்கு 1,960 வாங்கிட்டு இருக்காங்க. அந்த காண்டில் இருக்கேன் நான். அதுக்கு வேணால விட்டுறலாம் மாதிரி இருக்கு. பட் அதுக்கு கிளாஸ் எடுக்க முடியாது. So only for keeping the title of CA, I am paying 1,960. Imagine the number of members you have in India. Yes, students are 5 times more than that. Students are 5 times more than that. We are paying 1,960 per year. People are paying 1,500 per group, 2 attempts. I say a major revenue comes from that miscellaneous. They have this revenue from balance sheet. No, revenue from balance sheet is actually from members. And for them, suddenly other revenue itself is more than their other revenue from operations. Because of thanks to all only. So no. Plan your exams properly, people. 1.5 days can do wonders. If you can study like this, where you can complete the whole subject in 3 days, 3 hours. Complete the subject in 3 hours. Imagine the kind of change you can make to yourself. 3 hours for direct tax. Direct tax is smaller than this also. Adla padikkiradhu kuda illa. Place of supply mattum oru vaati padikkanum, time of supply oru vaati padikkanum. அவ்வளவுதானே. ஐடிசில என்னடா இருக்கு? அதான் என்னடா இருக்கு? The fact that you don't have to read ITC is that easy because you don't have to read only. ஏன்னா உங்களுக்கோ தெரியாது, எனக்கோ புரியாது. Which means you will ignore that 4 marks and go. Good enough, go. பரவாயில்ல, 92 வாங்கிட்டான், அது வரத போறோம். No. If you don't understand something and it has gone beyond your head, leave it and go. Leave it and go. Don't sit and spill on the spilled milk. Yes or no? அன்னைக்கு எனக்கு புரியாது. எனக்கு நான் பொறுத்த வரைக்கும் ஜிஎஸ்டி படிக்கும் போது பிளேஸ் ஆஃப் சப்ளை, டைம் ஆஃப் சப்ளை, எக்ஸாம்ஷன், அதை தவிர ஒரு கால்குலேட்டர் இருக்கணும் கையில. ஏன்னா எல்லா கொஸ்டின்ல 18% போட்டு தான் இருக்கணும். அவ்வளவுதான், முடிஞ்சு போச்சு. That's all is GST is what I learned. அது தவிர I did not learn any GST. ஏன்னா ஐடிசி எனக்கு புரியாது, சும்மா புரியாது, நானும் விட்டு போயிடுவேன். ஏன்னா அதுவும் வராது, நான் என்ன ட்ரை பண்ணாலும் வராது. ஜிஎஸ்டியா ஃபைனல் கேட்குறியா இன்டர் கேட்குறியா? இன்டர் ஜிஎஸ்டி இல்லைம்மா, எனக்கு சர்வீஸ் டாக்ஸ் ஃபைனல் என்டி எல்லாம் வராது. I scored an exemption is what I remember. Because finals it was even simpler. Finals ஒண்ணுமே இல்லை. They came and said, boss, inter syllabus we are not going to ask in finals. அதுவோ போச்சு. You only have extra provisions on the extra rightல இருக்கும். You have to pay penalty, interest, அதுக்கப்புறம் அந்த invoices ஓடது மொக்க questions will come. அது தவிர you have this customs and FTP, அங்க பாதியா போயிடும். You will easily score 25 marks in that itself. Anyway, point aside, the point is very simple. It's as simple as you can make it. Okay, my point is very simple. You're already at the stage right now where you don't have time to read. If today you're planning to start reading something fresh, keep it for the next attempt. Don't sit and waste time on it, is what my recommendation. Today is not the time for you to read. Today is the time for you to start pricing. What you know is what you know. What you don't know is either exempt or because it is out of your syllabus, no other options. It is out of your syllabus, no matter you try. Yes, so you trying to force yourself into understanding something will anyway not help. With that understanding, if you actually can read income tax in 3 hours, imagine how much faster you can complete IIT. Yes or no? And if you have done with both the subjects within a matter of half a day, imagine the next 1.5 days what magic you can do. No, one revision today on the day when you come back from the exam. Next day in the morning you do IDT. Second half you do again IDT only. IDT and now vana. Stuff again you do IDT. ராத்திரி தூங்குறதுக்கு முன்னாடி ஒரு வாட்டி சும்மா புக் தட்டு. And the next day morning what will you do again? Same DT. ஏன்னா DT தான் ஃபர்ஸ்ட் ஆன்சர் பண்ணோமா, வேற வழி இல்ல. இதான் ஃபர்ஸ்ட் ஆன்சர் பண்ணா வேற வழி இல்ல. டோன்ட் கோ அண்ட் ட்ரஸ்ட் IDT and go. லாஸ்ட் 3 அட்டெம்ப்ட்ஸ் வர்ஸ்டா போயிட்டு இருக்கு. லாஸ்ட் 3 அட்டெம்ப்டே வர்ஸ்டா போயிட்டு இருக்கு. IDT எல்லாம் everyone who thought no ராகுல் 40 மார்க்ஸ் தான தானா அடிச்சலாம் சொல்லிட்டு everyone failed in IDT only. Yes, imagine and plan it like that. No, you have already completed 3 revisions of DT, 2 revisions of IDT. You can easily score exemptions. I can 100% tell you are not aiming for 100. I can see the faces and itself imagine. See, அப்படி மாறி இருக்கு. இப்போ பாஸ் ஆகனாலே பெரிய விஷயம் மாதிரி இருக்கு. Yes, so I am definitely sure that you are not aiming for 100. Don't try, no then. If you're not aiming for 100, stop trying for it first of all. Just don't sit and start and keep reading till the very last minute. That is where you're losing most of it. Because for you to sacrifice on that 8 marks of ITC, you're actually spending time on your 92 marks. So no. Whereas you can actually spend more time on your 92 marks and cover that better. They will tell in Kung Fu, no? It is not about that 100 moves which you learned one time which is more impactful. It's about that one move which you learned 100 times which makes more of an impact to me. The 92 marks is what is strong for you. Work on the 92 marks. No, let's get it done. And the 92 எப்படி பண்ணாலும் அட்லீஸ்ட் 60 வந்துரும். Yes or no? அந்த 8 மார்க்ஸ் ஃபோக்கஸ் பண்ணிட்டு நீ படிச்சதே 30 மார்க்ஸ்னா எவ்வளவு வர போகுது? அந்த 30 வந்தாலே பெரிய விஷயம். Yes or no? It's all about effective reading. All about effective reading. Clear or not? Yes. Keeping that in mind, let's complete the balance syllabus of ours, which is your 40% of DT. Of your. Moving to the next part of your miscellaneous chapters, we are now getting into clubbing. Hey, we have completed dividends, sir. Achha, sorry. Dividends, straightforward provisions in dividends. Income tax comes and says dividends are taxable under the head IFOS. Any kind of expenses cannot be claimed as a reduction except for interest. Interest can be claimed as a reduction from your dividends, subject to a maximum of 20% of dividend income. 20% of your dividend income. Any kind of interest which is paid on account of your dividends can be claimed as a reduction subject to a maximum of 20% of your dividend income. All. The last thing which you need to remember is there is something called as deemed dividend under 222E, which comes and says that if you are a private company, who are you? You are a private company planning to give loans or advances to your shareholder who holds more than 10%. Whatever loans and advances you give to the shareholder will become taxable as deemed dividend only to the extent of the accumulated profits of the company. If the company has no accumulated profits, dividend will become not taxable. So the provisions come and say you should be a closely held company distributing loans or advances to your shareholder. Shareholder should hold more than 10% of the voting power. In that case, whatever loans and advances you give will become taxable as deemed dividend. You have an option number 2 where you can transfer these loans or advances to your concern. Income tax comes and says that if you are going to transfer these loans and advances to your concern, who's going to transfer? Company is going to transfer to the concern in which the shareholder holds more than 20%. In that case also it will become taxable. Full stop. Whose hands? Doesn't matter. It will become taxable. Question will not come and ask you in whose hands. Question will simply ask you whether it is taxable or not. You will say here what the provisions are when it comes to dividends. When we have dividends, we will be discussing about TDS and all when we move to TDS chapter. So done with the dividends chapter. Done with the dividends chapter as well. Moving to the next part of the syllabus called as clubbing of provisions. Moving to the next part of the syllabus called as clubbing of provisions. Income tax comes and says that, boss, if at all you have certain cases where you're trying to cheat the government, I will apply something called as clubbing of income on you. What I'm going to club is income. And not. What you're going to club is after giving all kinds of deductions. If the salary of a person is clubbed, you will give the clubbing after you allow 50,000 standard deduction. If you're going to club someone's HP income, you're going to club it after allowing 30% standard. Clear? Keeping that in mind, let's understand what the provisions are. The provisions are coming and saying that, boss, if you transfer any of your income, to someone else without transferring the asset, whatever income you transferred will be deemed as clubbed in your hands. This income which you are transferring can be revocable, irrevocable, doesn't matter. Since you are only transferring the, what is this case? You are basically getting an FD. FD oda interest matter you transferred. You do not transfer the FD, interest will become taxable in your hands even if it is irrevocable. Option number 2, you are coming and saying, no, Rahul, I will not transfer the interest, I will transfer the FD itself. Income tax comes and says, if you are transferring the FD, please ensure that the FD should be irrevocable transfer. That means you should not get back the asset until your lifetime or their lifetime. Your lifetime or their lifetime? Their lifetime. Your lifetime now settadhukku appuram enga vaanga. It is a lifetime of the recipient. Irrevocable transfers are those transfers which are not revocable until the lifetime of the recipient. Income tax comes and says, if you want to transfer your FD and don't want tax on it, please ensure you transfer it as irrevocable transfers. If you transfer it as revocable transfer, you continue to be taxed in the hands of original transferor. It will continue to be taxed in the hands of original transfer. Again, an exception, they come and say, boss, if you are planning to transfer irrevocable, but I find out that you are getting the benefit of it directly or indirectly. In that case also I will club it in your own hands. What is the example? The example is like you have an FD. You planned to give it to someone for irrevocable transfer, but you came and said that whenever you earn FD income, the income should come to my wife. This is the case of indirect benefit receiving in your hands. Even though it is an irrevocable transfer, this again will continue to be taxed in your hands. And what will be taxed is the whole of the income. It's not the proportionate also. If they plan to transfer only 10% also, 100% is taxable in your own. Clear? After you complete your irrevocable transfers comes your partnership cases. Income tax comes and says that, boss, if a husband and a wife, or let's say spouse, if the spouses plan to have a business together, the business can be in the form of sole proprietorship or partnership. Any cases, if the spouse plans to give you the money, and you take this money and deposit into your business in the form of capital, then in that case, whatever is the profits which you earn, will be proportionated between both husband and wife. In the ratio of their capital contribution on the first day of the year. And to that extent will be clubbed in the hands of the original person. Please understand, this only works in a sole proprietorship, will not work in a partnership model, because share of profits are exempt from tax. So this model only works in a sole proprietorship transfer. So if the wife is giving 1 lakh rupees and you are contributing 1 lakh rupees, total capital went inside is 2 lakh rupees, profit earned is 20,000 rupees. 10,000 will be taxed for husband, 10,000 will be taxed for, under the head, same PGBP. The income will continue to be the same income. Alternatively, if you come and say, boss, I have a business in which I have substantial interest. And I've engaged my spouse inside that business and I'm giving her a salary. Where she is not qualified enough for it. Then whatever salary she received will be taxable in the hands of the owner of the property. Taxable in the hands of the owner of the business. After allowing standard deduction. Whenever I'm checking for the substantial interest, I will not just check the substantial interest of myself, I will also check the substantial interest of me along with my relatives. Relatives here means left side of the family. Same as PGBP. So me along with my relatives, if I hold more than 20% in that concern, and in that concern my spouse is getting salary which she is not qualified enough for, that salary will become taxable in my hands after claiming the deductions, standard deductions. Clear? Next provisions come and say that if you are going to transfer your properties, either to your spouse or to your son's wife, son's wife, whatever asset you transfer will be taxed in the hands of the original transferor. Will be taxed in the hands of the original transferor. When you're transferring it to your spouse or your son's wife, and there is inadequate consideration. There is inadequate consideration. If you transfer this property to someone else for the benefit of the spouse or the son's wife, then also it will be taxable in. Hence, the only exception given here is house property cases. The exception given here is house property cases because their deemed ownership is coming into picture. So to that extent, they have come and said, boss, those cases alone, it will not be taxed in the hands of clubbing, but will be taxed in the hands of deemed, with the exception of that minor married daughter, which means minor married daughter will come into clubbing of. Next, they are coming and saying, boss, if there is a cross transfer happening, meaning I am giving my asset to my brother's wife, and my brother is giving an asset to my wife. In that case also, to the extent there is a common income, that incomes will be taxable in the hands of the brother and the assessee. Balance income, whichever is there, will continue to be taxed in the respective wives' hand. And this is called as a cross. And the last provision is talking about minus. Tax provision for minus. Income tax comes and says, if at all any income is earned by the minor, it will always be taxed in the hands of the parent whose income is higher. If you are going to club the income, you will be allowed an exemption of 1,500 per month per child. Correct? Per month, per annum is 1,500 per child. 500 per child per annum. It is not per month, people. It is per. Clear? And the last provision which was when it comes to clubbing of income, minor they come and say there are two exceptions. Exception number one is that if it is a handicapped child. Exception number two is that the money which was earned was out of the skill of the child. And then they come and say, boss, whenever you're talking about clubbing of income, what you tax is the actual first source of income and do not tax the accretion. If you go and deposit an FD and you get an interest out of it, interest becomes taxable. But if the interest is also earning interest, that interest will not be taxable except if it is a. I told you, when it comes to minor, do a simple logic. Take all the income of minor and tax it off. Whether it is accretion or first level, it doesn't matter. And then check which of those incomes are out of handicapped or out of special skills. That alone you remove off. So if at all the question comes and says that there is a minor who has gone for a singing competition and won 50 lakhs. That 50 lakhs will be taxable in the hands of minor. This 50 lakhs was deposited in a savings account and they earned 1 lakh rupees as interest. This will be taxable in the hands of parent whose income is higher, because while the income of 50 lakhs was out of special skill, the deposit was not out of special skill, so that will become taxable. Same scenario in another case. If the wife had gone for a singing competition and won, 50 lakhs will be taxable in the hands of wife. Interest on that will be taxable in the hands of wife. Tomorrow, if wife gives this 50 lakhs to you, you deposit in your sole proprietorship and you earn profit out of it. The profit will be taxable in the hands of wife. Clear? Yes? Great. Marks the end of your clubbing. First income taxable, subsequent all incomes taxable in the respective person's hand. $700 will be clubbed, 50 will be taxable in the person whose hand. Done. Moving to the next chapter called as set off. The whole chapter of set off is subsumed into this table. We will just read the table and the answer will automatically come through. Yes, we are going into set off of losses. The rules of set off of losses is always start from loss. Always start from the loss, never start from the income. So we're going to start from the loss perspective. So we will start from every head of income and start from the loss perspective. First head of income is, do you have a loss from salaries? Moving to the next head of income called as house property. If you have a loss from the house property, you will first set off against house property. If you're not able to set off against house property, you will set off against any other income up to 2 lakh rupees. When you're doing this, first priority will always be given to salaries. First priority will always be given to salaries. If you're not able to set off in the current year also, you will carry forward for a period of 8 years. Return filing on time, not mandatory. If you have completed HP, you will now move to business. In business, the first loss is speculative loss. If you have a speculative loss, you will set off only against speculative income in the current year as well as the future years. If it is not happening, carry forward for 4 years. Return filing on time, mandatory. If it is not a speculative income, you will move into specified business loss. You'll move into specified business loss. If you have a specified business loss, 35 AD, hotel 2-star, hospital 100 beds, warehousing facility and all those cases. If you have any kind of losses from those kind of businesses, you will set off against specified business income. If you're not able to set off, you will carry forward and set off against specified business income. If you are not able to carry forward, if you carry forward, you can carry forward for infinite years. Return filing on time, mandatory. If you have any other losses of PGBP, you will set off against PGBP income. Can you set off against speculative income? Always look from the loss perspective. Always look from the loss perspective. PGBP loss can be set off against speculative income. PGBP loss can also be set off against specified business income. Losses of PGBP can be set off against any head of PGBP. If you're not able to set off, you will set off against any head other than salaries. If you're not able to do it, you will carry forward and set off against PGBP. Hey, future year, can you set off against specified business income? Future year, can you set off against specified business income? Specified business is also part of business only. It's also part of PGBP only. So there also you can set off. If you are carrying forward, you can carry forward for 8 years. Return filing on time, mandatory. Return filing on time, mandatory. If you are into business, you also have one more losses called as unabsorbed depreciation. Unabsorbed depreciation can current year be set off against any head other than salaries. If you're not able to set off, you will carry forward and set off against any head other than salaries. Return filing on time, period of carry forward, finite years. Moving to capital gains. First capital gains is long-term capital gains. Long-term capital gains can be set off only against long-term capital gains. Long-term capital losses can be set off only against long-term capital gains. If you're not able to set off against long-term capital gains, you will carry forward and set off against long-term capital gains. Period of carry forward. Return filing on time, mandatory. If you are into short-term capital loss, you can set off against short-term and long-term capital gains. You are not able to set off. Can you carry forward? Yes. Carry forward and set off against both short-term and long-term capital gains. Period of carry forward. Return filing on time. Rahul, I have a loss from 112A. I have a loss from 112A. I have an income from 112. I have an income from 112. 112A is taxed at 10% in excess of 1 lakh, but 112 is taxed at 20%. Lower loss getting set off against higher income. Allowed, not allowed? Allowed, not allowed? Allowed. This is an exception. This is an exception. Capital gains, Puerto Rico, long-term capital loss can be set off against any long-term capital gains. Set off against any long-term capital. Clear? Yes. Moving out to our capital gains, we are now into IFOS. IFOS comes and says you have two kinds of IFOS losses. First IFOS loss is any kind of casual, any kind of loss from owning and maintaining horse races. Loss from owning and maintaining horse races. If you have a loss from owning and maintaining horse races, you will set off only against income from owning and maintaining horse races. If you're not able to set off, you will carry forward and set off only against income from owning and maintaining horse races for a period of Return filing on time. Return filing on time, mandatory. Any other sources loss which you have will not come in exam. Not come in exam, but if at all it comes in exam, the provisions are that you can set off against any head. You can set off against any head, but you cannot carry forward. You cannot carry forward. Apart from this, if you have a casual winning loss, you will. Casual winning losses will be ignored. Will be ignored. Technically, you cannot have a loss itself. Technically, you cannot have a loss itself because expenses are not allowed as a deduction. Technically, you cannot have a loss itself. Any kind of losses from casual winnings will be ignored. Can you set off your PGBP loss against unexplained income? Can you set off your PGBP loss against unexplained income? No. Any kind of special tax rate incomes of winnings and casual incomes are not eligible for set-offs. Not eligible for set-offs. These will be flat tax. These will be flat tax. Plus, they will not be eligible for basic exemption also. Not be eligible for basic exemption. So you need to always tax winnings mandatory. You also need to tax mandatory unexplained incomes. These cannot be. Rahul, I have a loss from profit of loss from share of partnership firm. Loss from profit share of partnership firm. What will you do? You will ignore. Why? If the profit is exempt, the loss is also. The loss is also. This is what the rules are. Yes, you have an agriculture income loss. Ignore. Partial integration only helps you save taxes. Doesn't ask you to pay more taxes. Doesn't ask you to pay more taxes. So partial integration will not apply. You will move to any loss from exempt sources are ignored from taxation. Clear? Yes. We have come to this position. Let's understand what are our exemptions also. Understand what are our exemptions also. It is somewhere in the second last chapter of my book. Somewhere in the second last chapter of my book. Quickly remembering from my head, the first exemption is any kind of share of income from HUF, share of profit of partnership firm. These are all exempt from taxes. Then they come and say that, boss, if you have a NRE account, what do you have? Non-resident external account. If you have any NRE account, any interest earned from these NRE account will also be exempt from tax. Will also be exempt from tax. And then they come and say, boss, if you have had any kind of disaster and all, if you have any kind of disaster and all, and government gives you money for that disaster, it will become exempt. If a private organization gives you the money, taxable. Private organizations will give you money, it is taxable. Rahul, I have received Bharat Paramveer Chakra award. Exempt. All these weird names and all you see, all. Rahul, 6.5% gold bond deposit interest. I don't know, I just made it up. Okay, I just made it up, some nonsense number. 7.95% gold bond interest, all exempt. All exempt. Nothing to be worried about. Okay. And the last exemption for you is that they come and say about Sikkim cases. They come and say about Sikkim cases. The last attempt. Next attempt it is not there. Last attempt for your Sikkim cases comes and says next attempt. No, sorry. Next to next attempt it is not there. One more attempt you have, ma. One more attempt you have. Make a choice. For two more attempts. This attempt and next attempt. Provisions come and say if there is any kind of Sikkim person, whatever income he earns from Sikkim will become exempt, and whatever passive income he earns, like interest or dividends or something like that, that will also become exempt. But if you are a Sikkim woman, who ends up marrying a non-Sikkim male, you will be treated as a non-Sikkim person going forward, and therefore your exemption will be taken away from you. Only for the next two attempts. After that, the provision itself is not there. Clear? Yes, these are your provisions for your exemption. Completing our set of chapter, we are now moving to the next chapter called as chapter 6A. Yes, guys. Is the speed okay now? Should I reduce further? We're into the chapter called as chapter 6. எனக்கு ஏதோ லஞ்சுக்கு முடிஞ்சிர மாதிரி இருக்கு. We'll do one thing. When we get into 115 BAC, we will read the whole book once again. No பிரச்சனை. When we do 115 BAC, we will read the whole book again. Okay, this time you will tell me. After, we will cut down YouTube and then we'll do separately here. Write the marks. Yes, yes. When we enter 115 BSc, we will start with the whole chapter again. The whole subject will be started over again. We will discuss all the provisions again and then we will clarify which one comes for 115 BSc and which one does not come for ஒரு நாளே second revision. Yes, moving into the chapter called as chapter 6A. Moving to the chapter called as chapter 6A. This is the deduction which you get out of your gross total income. This is the deduction which you get out of your gross total income with the condition that you can only get this deduction on your slab rate incomes. You can only get it on slab rate incomes. You cannot get it on your special incomes, which are your capital gains, your winnings, or your explaining. You will only get it on your slab rate incomes. In that understanding, let's start with this chapter. The chapter starts with section 80C. Section 80C comes and says you can get a maximum benefit of 1.5 lakhs for the whole year, with the most important provision being life insurance premium. Income tax comes and says if you are getting a life insurance premium, check whether the premium, if policy was taken before 2012, after 2012. If you took the policy before 2012, you are eligible for 20% of the premium eligible is 20% of the sum assured. If you are taking it after 2012, you are eligible for 10% of your sum assured. But if you end up being a handicapped person, you will be eligible for 15% of your sum assured after 2013. After 2013. These are what the provisions are when it comes to life insurance. Then they come and say if the employee has contributed to the PF, except for URPF, that is also allowed as a deduction. If the employee has paid some tuition fees for their children, then also it is allowed as an deduction. Apart from that, any other investments which you see like 5-year tax saver deposits, any kind of Samriddhi schemes, this scheme, that scheme, all that schemes are all investments under 80C. Investments under 80C. And then they come and say if you have repaid your housing loan, you have repaid your housing loan, principal component of repayment of your housing loan will also be allowed as a deduction under section 80. These are what the yes. Then moving to the next one called as 80CCC, talks about pension fund. Talks about pension fund. 80CCC talks about pension fund, where they come and say whatever pension fund you make a contribution will be allowed as a deduction. Then we move into 80CCD, talks about pension scheme. That was pension fund. This is pension scheme. In pension scheme, you have three kinds of things. You have three kinds of things. One is called as employer contribution. One is called as employee contribution. One is called as self-contribution. One is called as self-contribution. If an employer is contributing, he can contribute up to 20% of the salary or 10% of the salary. %, and 14%. 10% for normal cases, 14% for government cases. 14% for government cases. If you are into employer's contribution, 10% of the salary will be allowed as a deduction. Salary here means basic plus DA forming part. Basic plus DA forming part. If you are into government sector, it is 14% of the salary. If you are an employee, if you self-contribute, same 10% of the salary. But if you are not a salaried person, you will be allowed 20% of the adjusted GTI. 20% of the adjusted GTI, not coming for exam. Employee portho varaikku 10% of the salary. But yes, you also have been given an additional benefit to say that if you self-contribute, 50,000 can be claimed additionally. 50,000 can be claimed additionally, and this is over and above your 1.5 lakhs. Over and above your 1.5 lakhs. The provision comes and says if you are in 80C, 80CCC, and 80CCD, all the three put together, you cannot claim more than 1.5 lakhs. But if you are doing employee contribution, 50,000 can be claimed. And if you are doing employer contribution can be. So employee contribution not allowed. Employee contribution will go a part of 1,50,000. 50,000 extra contribution can be claimed. Employer order 10% can be claimed. Clear? Yes. After you complete 80 triple C, you have 80 CD. You have 80 D. In moving to 80D, it talks about medical insurance. Income tax comes and says, whenever you're doing medical insurance, please split yourself into two buckets. Split yourself into two buckets. One bucket will say me, my spouse, and my children. My children. Second bucket will say parents. Children dependency not required or required. Required. Children dependency required. Parents dependency not required. Parents dependency not required. Moving back to 80C. Moving back to 80C. Life insurance premium. It is for self, spouse, children whether dependent or not. Children whether dependent or not. Parents not covered. Parents not covered. Moving to 80D comes and says you can take two buckets. One bucket is self, spouse, dependent children. Second bucket is parents whether dependent or not. When this provision, income tax comes and says, boss, both the buckets will get individual deductions. Both the buckets will get individual deductions. Each bucket will get 25,000. Each bucket will get 25,000 max. But if any one bucket has resident senior citizen, any bucket has the resident senior citizen, you will get a 50,000 bucket, which means 25 plus 25, 25 plus 50, 50 plus 50. Three options available for you. Three options available for you. What are the kind of deductions you can claim? You can claim your medical insurance. You can claim any kind of payment made to CGHS, Central Government Health Scheme. And you can claim any kind of preventive health checkup. And you can claim any kind of preventive health checkup. Rules are that if you are claiming your preventive health checkup, both the bucket together you cannot claim more than 5,000. Both the bucket together you cannot claim more than 5,000. And if you are not having a medical insurance, you end up becoming a senior citizen. I can also give you the benefit of medical expense. Meaning, if you are not a senior citizen, you will only take medical insurance. If you are a senior citizen, I have two options. If you have a medical insurance. If you don't have a medical insurance, medical expense. Rahul, can I claim both? No. Anyone? One, with the condition saying that, boss, if you are going to make any kind of payments for medical insurances or medical treatments, please ensure that the payment is not happening by. If the payment happens by cash, no deductions for you. No deductions. The payments happen by cash, no deductions for you, except for your preventive health checkup. Preventive health checkup deductions are permissible. Preventive health checkup deductions are permissible. And if they come and pay lump sum medical insurance, they end up paying lump sum medical insurance. Be careful on this. Sometimes asked. This is sometimes asked. Let's say, for example, you take a medical insurance on 1st April 2016. Take a medical insurance on 1st April 2016. The medical insurance which you paid is for 5 years. Medical insurance which you paid is for 5 years. What will you do? You will take the medical insurance divided by 5 years and claim it. Divided by 5 years and claim. Challenge happens when you take it during the year. Income tax comes in because when you're dividing it. Divided for the financial years which are present. Notice, no, if you're taking from 2/4/2016 for 5 years, you will take it for how many years? You'll take it up to 2/4/2021. Now tell me what financial years are involved. Are there 5 financial years or 6 financial? 6 financial. Because the last financial year became for 2 days. Last financial year became for 2 days. Income tax comes and says whenever you are trying to divide this, you will now divide it by 6 years. It means when you are claiming your lump sum insurance, take the financial year in picture and do it, not the period of the life insurance. Consider your financial years. For whatever financial year this life insurance was in force, you will have to divide it by that many years. A hint I'm giving to you, because if you're writing today's mock test paper, this is one question. Hint for you. It is there in this question paper. I will 100% tell you in that question paper, you will find it. There will be 5 years. You will mandatorily do it 5 years only. Because you don't remember. Careful on those lines. It is financial years. Therefore, it becomes 6 years. If you take it on 1st April, no problem. But if you take it on anywhere before or after 1st April, one more year will get added. So you'll have to divide it by that many years. Clear? Yes, careful on those. You completing your 80D, now we move to something called as 80DD along with 80U. 80DD along with 80U. Income tax comes and says, boss, if you are taking care of a handicapped person. You are taking care of a handicapped person, or you end up becoming a handicapped person, no matter what expenses you pay, a flat 75,000 or a flat 1,25,000 will be granted as a deduction to you. This flat 75,000 is irrespective of what amount you pay. A flat 75,000 or a flat 1,25,000 will be allowed to you. 75,000 when you are normally disabled, 1,25,000 when you are severely disabled. If you are claiming the disability deduction for self, you will not get it for 80DD. If you are claiming for 80DD, you will not get it for 80U. Any one of the two. After you complete 80DD, you have something called as 80DD. You have something called as 80DDB. Income tax comes and says that, boss, if you have taken any kind of medical expenses for a specified disease, if you have had any medical expenses for a specified disease, then you can claim a maximum of 40,000 or 1 lakh rupee. If 40,000 for a non-senior citizen, 1 lakh for a resident senior citizen can be claimed as a deduction for your medical treatments for a specified disease. What is specified? Income tax has not told you. For your inter exam. ICI will come and tell you if it is a specified disease, you take it as 80DD. While keeping in mind your salaries chapter. If the employer pays your medical expenses, it will become exempt because it's a specified disease. If you pay it yourself, you will move to 80DD. Clear? In exam, if the question comes and says there is a P&L, in which there is a medical expense. What will you do with this? First, check what the medical expense is for. If they say that the medical expense is for employees, then it is your P&L debit side has a medical expense for your employees. You will allow it as a deduction. It comes and says it is a medical expenses for the self. You will disallow under PGBP. Then come and check if you are a senior citizen. If you end up becoming a senior citizen, you can claim 80D. Claim 80D up to a maximum of 50,000 rupees. This came in your last attempt. So be careful about it. Okay, it came in your November attempt where they had a medical expenses in your P&L and somehow people missed out because they disallowed it for personal, but they forgot to claim chapter 6. You have to open your head and use everything together. Clear? Yes, next. Moving to the next one called as 80E. Income tax comes and says that if you have taken a loan for your education purposes of self, spouse, or children, or dependent guardian, dependent adopted children. In that cases and all, whatever interest which you pay on that loan will be allowed as a deduction over a period of 8 years. Principal repayment will not be allowed, but tuition fees can be claimed under 80C. Please be careful. Interest will be allowed under 80E. Loan will not be allowed. Tuition fees will be allowed under 80. Moving to the next one called as 80EE and EE. 80EE and EE. Income tax comes and says if you have taken a loan for a house, interest on that house will first be allowed under HP. If you are not able to claim it under HP, you will come and check for chapter 6A. Income tax comes and says this, boss, if you had taken the loan during previous year 16-17, you will be eligible for 80E, in which you can claim a deduction of 50,000 rupees, provided the stamp duty value of the property does not exceed more than 50 lakhs. If you are taking the loan after 2019, but before 2022, until your preceding previous year, in that cases, you can claim a deduction of 1,50,000 over and above your HP. Where if your stamp duty value is not more than 45 lakhs. This is what the provisions are. Clear? Yes. Moving to the next one called as 80EB. This comes and says that if you have taken a loan for your electric vehicles, whatever interest you pay on this electrical vehicle loan will be allowed as a deduction up to a maximum of 1,50,000, provided you take the loan between 2019 to 2023. This came in your last attempt also. Electrical vehicle came in your last attempt. You simply had to take that, disallow it under PGBP and allow it under chapter 6. Moving to the next one, the biggest and the important one called as 80G. This talks about your donations. This talks about your donations. Income tax comes and says whenever you want to pay donations, please ensure that you pay the donations other than by way of cash. Other than by way of cash. If you want to pay it by cash, I don't have a problem as long as you pay up to 2000 rupees. Up to 2000 rupees. If you pay more than 2000 rupees, it will become ignored. It will become ignored. If you are ready to pay more than 2000 rupees and you're paying by permissible modes, you please have to ensure that you pay the money in cash. I say in cash, it should be monetary value. It should be monetary value. Don't go and give kind to them. Don't go and give kind to them. Only cash monetary items are permitted. Kinds are not permitted. With that understanding, we need to split our donations into 4 categories. Category A, Category B, Category C, and Category D. Income tax says, boss, Category A covers all your minister and nationals. All your minister and nationals. Anywhere in the exam, if you see that the donation is made to some person called as minister or made to some person called as national, take it and 100% allow without any qualifying limit. Without any qualifying limit. If you are into Category B, it comes and talks about Gandhi family. Talks about Gandhi and Nehru family. Talks about your Gandhi and Nehru family. If you are making any kind of donation to your Gandhi or Nehru family, you will be allowed 50% without any qualifying limits, with one exception. National Drought Relief Fund will move to 50. National Drought Relief Fund will move to 50. National Children's Relief Fund and all, or Disaster Relief Fund and all, will move to 100%. Move to 100%. National Drought Relief Fund is an exception which moves to 50. Which moves to 50. If you are not in Category B or Category A, you are in Category C, which talks about family planning or Olympics. Family planning or Olympics. If you're going to make a donation for family planning or you're going to make a donation for Olympics, you will be allowed 100% of the donation up subject to a qualifying limit. But if you are not into all those and you're making a payment to a charitable organizations, you will be allowed 50% with the qualifying limit. What do you mean by a qualifying limit? Income tax comes and says, boss, compute your whole total income. Compute your whole total income, ignoring whole chapter ATG. Ignoring the whole ATG, whether it is Category A, B, C or D, all ignored. All ignored. Compute your total income. That is called as your qualifying limit. That is called as your qualifying limit. But please to understand, this total income will also have your special incomes. So please ignore your special incomes also. Please ignore your special incomes also. You are anyway not eligible for deductions on your LTCG winnings or your unexplained. So that will also not be considered. So what I mean is, I mean your total income, ignoring your special rate incomes and ATG. And ATG, remove all these items, you will arrive at your qualifying limit. On this qualifying limit, 10% is what you can donate. 10% is what you can donate. Rahul, let's say for example, the qualifying limit comes as 60,000 rupees. Qualifying limit comes as 60,000 rupees and I contributed to charitable organizations 1 lakh. I contributed to charitable organizations 1 lakh. Qualifying limit is 60,000 rupees. 10% of 60,000 will become 6,000. You can donate 6,000. You can donate 6,000. You donated 1 lakh. You will be eligible for 6,000 into 50%, which is 3,000. Understand, people? 6,000 is not the deduction amount. 6,000 is the donation amount. 6,000 is the donation amount. Clear? Yes, these are what the provisions are when it comes to ATG. After you move ATG, you have something called as ATGG in middle. Exam purposes, ATG not eligible. Exam purposes, ATGG not eligible. Simple. No matter how you try, income tax will always, exam will always come and put it as not eligible. Yes, will always put it as not eligible. In a nutshell, what this provision is coming and saying is, if you are paying rent for your house, if you are paying rent for your house and you are not receiving HRA, you will get something called as ATGG. Don't worry, exam purposes it will always not be given. It will always not be given because there are some rules inside it. There are some rules inside it. The rules can never be satisfied. The rules can never be satisfied. What are the rules? Not relevant. Not relevant. From exam purposes, 2 items. One is your family planning, always disallowed. Next is your ATGG, always ignored. Yes, some small tips for you. Some small tips for you. Moving to the next item called as ATGGA. ATGGA talks about your scientific research donation. Talks about your scientific research donations. If you have done a scientific research donation which you could not claim under PGBP because you don't have PGBP, you can claim it under ATGGA. 100% of the amount is allowed as a deduction, provided you don't make the payment by cash more than 2,000. Next is your ATGGB and GGC. Both GGB and GGC come and say, if you are going to make a donation to your political parties, electoral trusts, or any kind of souvenirs and all for the political parties, all will be allowed as a deduction. 100% of the amount allowed as a deduction, provided none of the payment is made by cash. Even 1 rupee paid by cash, this allowed. Even one payment made by cash fully will be ignored. Fully will be clear. Yes, 80 GGB and GG. See, after you complete GGB and GG, see comes your 80 double J double A. Comes your 80 double J double A. Rules are like this. Are like this. You need to first verify whether you have a tax audit applicability or not. If you say you have a tax audit applicability, rule number 2, check if there is an increase in employees in the current year. Increase in employees in the current year. There should be an increase in headcount. If there is an increase in headcount, please move all those employees whose salary is more than 25,000 per month. Please remove all those employees whose salary is more than 25,000 per month. Then remove all those employees whose contributions to PF are happening by government, or there is no contribution to PF, or there is no contribution to PF. It's there in the step process. Yes, you start from the top. You first verify for your tax audit. Then you check whether there is any increase in employees. Then you come and remove all the employees whose salary is more than 25,000. Remove all those employees who are getting contribution from government or are not getting contribution. Then remove all those employees who are employed for less than 240 days in the current year. 240 days in the current year, or 150 days if you are into manufacturing of leather apparels. Manufacturing of leather and apparels, it will become 150 days. Remove all those employees and bring all those employees from last year's 240 and 150 here. Current year less than 240 and 150 will be removed. Last year's less than 240 and 150 will be added. Now you have the set of employees who are eligible. In this, if any employee you made the payment other than by permissible modes, ignore the salary. Any employee you made the payments by other than the permissible modes, ignore the salary. Now you have the eligible salary, you have the eligible employees. Eligible employees into eligible salary will give you the total additional employee cost. This total additional employee cost will be allowed for a deduction of 30% over the next 3 years. 30% year 1, 30% year 2, 30% year 1, year 2 and 3. This will arrive at your 80 double J. Doubts? Take the steps quickly. Done? Good to proceed? Yes. These are your provisions for your 80 double J double A. The rule for 80 double J double A is that if you want to claim 80 double J double A, you need to ensure that the return filing is done on time. Filing is done on time. If you don't do the return filing on time, also the reduction will be not for you. The reduction will be ignored for you. After you complete 80 double J double A, you will directly jump into 80 QQB and RRB. Both talk about royalty. Provisions come and say if you are receiving royalty, you can get a deduction of 3 lakhs. You can get a deduction of 3 lakhs for the year, provided if you are receiving the royalty from outside India. The money should be received in India within a period of 6 months. From the end of the financial year. And if you are receiving a recurring royalty, it is allowed. But if you are receiving a lump sum royalty, I will allow up to a maximum of 15%. Of what? Royalty books, revenue. 15% of your revenue. I will allow up to a maximum of 15% of your revenue. What will be allowed? Your royalty amount. If it is lump sum, it will be allowed 15% of your revenue. If you are claiming recurring royalty, no problem. You can claim the whole thing, provided you receive the money within a period of 6 months from the end of the financial year. Also, since this royalty is going to be taxed under PGBP, if you had claimed any expense as a deduction, that will also be reduced when you are claiming a deduction here. So for example, if the question comes and says that there is a 2 lakhs worth of royalty which you received and 40,000 is paid as an expense on it, in PGBP you would have taxed 1,60,000. CBP would have taxed 1,60,000. When you're bringing it here, here also you will tax only 1,60,000. You will only allow only 1,60,000. You cannot allow 3 lakh or 2 lakh rupees fully, because 40,000 you removed there, 40,000 will be removed here also. Right? Yes, if you're going to remove any kind of expense from your PGBP, that will also be removed from your deductions. Also, you cannot claim those kind of expenses under deductions, because what you offer in gross total income is what can be claimed as a deduction. Clear? Yes. After you come back from QQB and RRB, these two provisions are also not eligible for deduction if you don't file your returns on time. Moving to the last part of this chapter 6A, called as 80 ETA and 80 TTB. Provisions come and say that if at all there is any interest on deposits, ask yourself whether you are a senior citizen or a non-senior citizen. If you are a non-senior citizen, you can only claim savings interest. Up to a maximum of 10,000 rupees. Please understand, if you are doing this kind of deduction, you also have to take care of 3,500 of post office savings. First allow 3,500 under IFOS, then claim the 10,000 here. And also understand 3,500 is only for post office, not for normal savings. Only for post office and not for normal savings. If you end up saying, no, Rahul, I am a senior citizen. If you end up becoming a resident senior citizen, I will give you deduction for any kind of deposits, which is your FD, RD and savings. And the amount which I will give you as a deduction is 50,000. These are what your are when it comes to. Done. With us completing chapter 6A leaves us with the balance other deductions. The other deductions are your 10 AA. Income tax comes and says that, boss, if at all you have a SEZ unit, you had a special economic zone unit, in that cases I will also give you a special export profit benefit. Under the section 10 AA. What does this section come and says, boss? If you have any profits from an SEZ unit, it will anyway be taxed under PGBP. After you tax it under PGBP, you can come down to this and you can claim a 10 AA benefit. How do you claim this benefit? Check where are you. If the business started within 5 years, you will get 100% of the export profit. 100% of the export profits of the business of the unit. Even if you have done export from a non-SEZ unit, no deduction for it. You will only get 100% of the export profit of the SEZ unit. If you have crossed 5 years and are within 10 years, you will get 50% of the export profits. If you cross more than 10 years, then within 15 years, you will still get 50% of the export profit, subject to some more conditions. What is the conditions will not come in exam. So in simple terms, for the first 5 years, you will get 100% of the export profits. In the next 10 years, you will get 50% of the export profits. Export profits for the purpose of income tax means profits of the undertaking. Which undertaking? SEZ undertaking. Profits of the SEZ undertaking into export turnover divided by total turnover. With the condition that if you have an export turnover, what you bring to India is what is considered as export turnover. If you ended up paying some money outside India, like telecommunication, transport, this and all those numbers, if you end up making any kind of expense outside India, that will be reduced from your export turnover. And logically speaking, total turnover is nothing but export plus total domestic turnover. So therefore, it will also be reduced from your total turnover. Whenever you read this provision, the provision should be read like this. This profits of the undertaking into minus expenses paid outside India divided by turnover minus expense paid outside minus expense paid outside India. If you are within first 5 years, you will get this full number. If you are in the next 5 years, you will multiply by done. Chapter done with the chapter. What is next in line? முடிஞ்சிச்சு. With us completing what is 10AA, we have completed our majority chunk with some special cases left. Special cases left. Moving to the next special case called as AMT. Income tax comes and says, boss, government expects some money out of you. Government expects some money out of you in the form of tax. Please ensure that you pay him bare minimum of that money. Please ensure you pay him bare minimum of that money. If you end up paying more than that money, great. If you pay lesser than that, government will expect you bare minimum. What is that bare minimum number? It is called as AMT, alternate minimum tax. So if government is coming and saying that I am expecting 100 out of you and you are only ready to pay 80, government will collect from you. Government will collect from you 100. Do you think you'll happily pay 100? Means you will go to the government and come and say, today I've paid you 20 more. Today I've paid you 20 more. Next year, if my normal tax is 150, my normal tax is 150 and you are expecting out of me 100, I will not pay you 150 because I already paid you 20 extra. I already paid you 20 extra. I will reduce the 20 and pay you only 150. Only one. Now, my number which was there, the excess which I paid was 60. Number which I paid was 60. Next year I was going to pay 150. Government is expecting 100. Can I reduce it to 90? No. Government still expects out of you 100. So you will end up paying 100. Where you will come and say 50 I utilized. Balance 10 I will carry forward. Balance 10 I will carry forward. This is called as AMT credit. Called as AMT credit. Income tax is coming and saying, boss, if at all you have paid any excess in any year, you can carry forward this as AMT credit for a period of 15 years. For a period of 15 years and set off in the year in which your normal tax becomes more. Normal tax becomes more by ensuring that you bare minimum pay the minimum tax of AMT. By ensuring that you bare minimum pay the minimum tax of AMT. If you still have any deficiency, you can carry it forward for the next balance years. Balance 15. How do you compute your AMT tax, Rahul? They say, boss, it is 18.5% of your adjusted total income. This 18.5% of your adjusted total income. What do you mean by adjusted total income? Take your total income as is. Take your total income as is. Add back 10AA, 35AD, 80JJAA, QQB, RRB. Yes, add back what? You will add back your 10AA, 35AD, QQB, RRB, JJAA. When you are adding back 35AD, the assumption is that it has become a normal business. Assumption is that it has become a normal business, which means what you added back was a capital asset. So now it becomes a capital asset back for you. You can claim depreciation. Depreciation. So when you are adding back 35AD, take that asset and allow depreciation on it. Take that asset and allow depreciation on it. When you are arriving at your adjusted total income, on that you will multiply 18.5%. That you will multiply 18.5% to arrive at your AMT. Arrive at your AMT tax. If you are into 115 BAC, if you are into 115 BAC, AMT is not applicable. Is applicable. You will have to take this AMT only if it is old regime. If it is old regime, which means if you are like this, you are like this. Let's say your AMT is 100, your normal is 150, your 115 BAC is 120. You will pay. You will pay. You will pay. You will pay 120. Pay 120 because normal is 150 compared with 115 BAC, whichever is lower. If it is 100, 120, 150, you will pay 120. If it is 120, 100, 150. Will pay. Is AMT versus normal, whichever is higher, compared with your 115 BAC, whichever. But 115 BAC is lower, no? Yes. Yes. Going back to your golden rules, people, it is your normal versus AMT, whichever is higher, compared with your 115 BAC, whichever is. Which of these scenarios will you get AMT credit? Which of the scenarios will you get AMT credit? Third one, amount is. Third one, amount is. Here, sure. Marks the end of your. Now what is pending? Payment of taxes then. Payment of taxes then. I underestimated myself. 7 hours is 3. The problem is I was looking at YouTube and there was another faculty who did this in Delhi, I guess. That faculty took 9 hours to complete without TDS. I was like, if he's taking 9 hours to complete without TDS, na 7 hours, maybe I can try. The most. Good for us. Good for us. Anyway, what is the time? Is 12:30 good for lunch? 12:30 good for lunch? Go at 12:30. இதுக்கு மேல TDS இருக்குடா அதனால நான் கொஞ்சம் Let's go back and have a lunch and then come back and sleep off. Okay? TDS பொறுத்த வரைக்கும் nothing for me to explain, more for you to sleep only. We'll come back after lunch and maybe do TDS and then we will, after you sleep off, no, then I will do the most important amendment for the current attempt. Called as, discuss that, okay? This we will discuss in a little. We'll discuss in length. This will discuss in length. We'll discuss the updated return in length because some people are there who have not done it earlier. Yes, we'll discuss updated return in length so that you can have an understanding of that. And then we'll conclude the class. I am assuming 2 o'clock. I'm assuming 2 o'clock or 3 o'clock, max to max 3. Max to max 3. Max to max 3, we'll be done with it. Hey, 1:30 வந்ததுக்கு அப்புறம் எப்படி 2 முடிப்பேன்? DT மட்டும் எழுதுனா 1.5 hours தானே. Anyway, we clocked till 5, no? 3 o'clock ஆரம்பிச்சாலும் என்ன பிரச்சனை? Anyone interested for IDT also? All right. I'll give you the paper. All right. Yes, starting with the chapter called as payment of taxes. Starting with the chapter called as payment of taxes. We are into the chapter called as payment of taxes where we try to understand what kind of taxes will you pay. What kind of taxes will you pay? Income tax comes and says, boss, you pay taxes either during the previous year or during the assessment year or post the assessment year. If you are paying taxes during the previous year, it is called as TDS or advance tax. If you pay taxes during the assessment year, it is called as self-assessment tax. If you pay post that, it is called out of syllabus. Called out of syllabus. Yes, you are into the chapter called as payment of taxes. So I'm deferring TDS for you. We are moving into advance tax. Income tax comes and says, boss, if you want to pay your taxes in advance, it is called as advance taxes. Liability for you to pay your advance tax happens if your tax liability to be discharged is more than 10,000 rupees. Is more than 10,000 rupees. But yes, if you are a resident senior citizen not having PGBP income, you will be not required to pay advanced tax, you can move to self-assessment. You can move to self-assessment tax. Clear? Yes, this is what the provisions are. Provisions come and say your tax liability for the year should exceed 10,000 rupees and you should not be a resident senior citizen not having EGBP income, in which case you will be liable for advance tax. How do you compute your advance tax liability? You need to take your full tax liability minus your TDS, which is deducted. TDS which is deducted, you will arrive at your advance tax liability. On that, you need to pay it in 4 installments. You need to pay it in 4 installments starting from 15th June, 15th September, 15th December, 15th March. By 15th June, you need to discharge 15%. By 15th September, you need to discharge 45%. By 15th December, you need to discharge 75%. By 15th March, you need to discharge %. This is what you need to discharge for yourself. But it will be enough even if you discharge 12% in quarter 1 and 36% in quarter 2. If you satisfy these conditions also, I will have no problem because I will not levy something called as interest. If you are not able to discharge 12 or 36 also, I will take your shortfall right from 15 and 45 and levy something called as interest. Having said this, I will like to clarify that if you are opting for presumptive taxation under 44AD and 44ADA, meaning business and profession, you will have to take only the last installment. You have to take the last installment. But if you are opting for transport operators, you will have to take all the 4 installments. You have to take all the 4 installments. Yes or no? What the provisions are when it comes to advance tax. When it comes to self-assessment tax, income tax comes and says, boss, self-assessment tax is the tax which you pay in your assessment year. So which means you need to take your total tax, reduce your TDS, reduce your advance tax, arrive at your self-assessment tax. But whenever you are paying your self-assessment tax, there are certain rules. The rules come and say that, boss, if you have some interest to be paid, if you have some late filing fees to be paid, then those will be discharged first. Then only your tax will be paid. So even if you pay 1 lakh rupees of self-assessment tax, it will not be taken towards tax first. It will first be adjusted against your fees, then it will be adjusted against your interest, then it will be adjusted against your tax. If you are defaulting in doing your self-assessment or advance tax properly, we have something called as interest. Interest starts as 234C, 234B, 234. It starts in the reverse order. You start from 234C, go to B, go to A. 234C applies on your advance tax. 234B applies on your self-assessment tax. 234A applies on your return filing. Provisions are coming and saying, if quarter 1 you are discharging 15%, please ensure you discharge 15%. If you discharge 15%, great. If you discharge less than 15%, I will allow up to 12%. If you discharge less than 12% also, shortfall will be considered from 15. Let's say I paid only 7%. My shortfall is 8%. On this 8%, I will levy 1% interest into 3 months. No 3 by 12 and all. 3 months. Quarter 2, you need to discharge 45. Bare minimum discharge 36. You discharge less than 36. The shortfall will be multiplied by 1% into 3. Quarter 3, you need to discharge 75. You discharge less than 75. Shortfall will be taken into 1% into 3. Quarter 4, you are supposed to discharge 100%. You did not discharge 100%. Interest will be into 1. For the first 3 quarters, you will levy 3 months. For last quarter, you will levy 1 month. With an exception that if at all you have earned some special incomes, I do not expect you to pay advance tax on those right from first quarter. I will expect you to pay the advance tax from the quarter in which you earned the income. What are those cases? First case is your capital gains. Second case is your winnings. Third case is your dividend income. Fourth case is your PGBP which you have earned for the first time. PGBP which you have earned for the first time. 4 cases. In these 4 cases, I will expect you to pay the advance tax only from the quarter in which you start earning. Before quarters, no need to pay. 4 quarters. Okay. In the quarter in which you start earning, you will have to pay YTD. You will have to pay YTD 15% of quarter 1 also, balance 30 of quarter 2 also. 30 of quarter 2. Example. Here, yes, these are what the provisions are when it comes to 234. Moving to 234. The income tax comes and says 234 will start from assessment year. So income tax is coming and saying take whatever you have paid until 31st March. Take whatever you have paid until 31st March, remove it off, and then find out what is your tax liability. Find out what is your tax liability. Let's say, for example, my tax liability is 1 lakh. Tax liability is 1 lakh. I have discharged 80,000 rupees in the form of TDS or advance tax. The shortfall of 20,000 will be taxable at the rate of 1% into 1st April of the assessment year till date of payment of tax. Till the date of payment of tax. You will start from the 1st April of the assessment year and pay it up till the date on which the tax is to be paid. But date wise, but then the 1% is part thereof also. Yes, it is 1% in starting from the 1st April of the assessment year till the date on which you make your payment of taxes, with an exception that if this money, which is your advance tax, ends up being at least 90% of your total tax. In that case, I will not levy 234B. In my example, is it more than 90, less than 90? Less than 90. So shortfall will start from 100. Shortfall will start from the whole 1 lakh rupees. 20,000 is your shortfall. 20,000 is your shortfall. You will levy interest on the full shortfall. With these 2 golden rules to remember. Golden rule number 1, whenever you are computing interest, guys, focus. Whenever you are computing interest, tax will always be rounded down to 100. The tax will be rounded down to the nearest. 100 for the purpose of computing your interest. In case we did not discuss, when it comes to rates of taxes, total income should be rounded off to the nearest 10. This is round off. Tax liability should be round off to the nearest. Your total income should be rounded off to the nearest 10. Tax liability should be rounded off to the nearest 10. Each of them carry half of mark. One gone, answer gone. Same time when it comes to interest. You have to round it down the tax to the nearest 100. Compute your interest, add it to the tax liability. Final answer will be rounded off to the nearest. Final tax liability will be rounded off to the nearest. Clear? These are what the provisions are. Second provision, the 1% which you are looking at. Both in 234C and 234A is per month or part thereof. If you go forward for one more day in the next month also, full month interest applicable. If you go for even one day in the next month, full month interest is. And we are done with what is called as. You want to do return filing? 12 minutes, 12:30 will be over. Let's do return filing so that we come back and we do TDS and then revise the whole 115. Let's complete our return filing. Hey, updated return after TDS. I will need some time on that. Okay, so we'll do return filing excluding our updated return, then do our TDS, then go to updated return, then go to revising the whole book again along with 115. Done? Starting with the chapter called as. Return filing. Income tax comes and says, boss, if you are going to file your return, you are going to file your return, you need to check whether you are liable for filing return. Or how do you become liable for filing return? They are coming and saying check if you are into slab rates or non-slab rates. If you are into non-slab rates, return filing mandatory. If you are into slab rates, they are coming and saying check if your gross total income for the year, removing the exemptions which you claimed under capital gains. What? Gross total income for the year, removing the exemptions you claimed under capital gains. Removing the exemptions you claimed under capital gains should be more than the basic exemption limit. Should be more than your basic exemption limit. You satisfy that condition, return filing is mandatory. You don't satisfy the condition, return filing. Yes, so the provisions are, if you are into non-slab rates, mandatory return filing. If you are into slab rates, check for your gross total income, ignoring your capital gains. Ignoring your capital gains. But they have given certain exceptions to you. They have come and said that, boss, these scenarios, return filing becomes mandatory. These scenarios, return filing becomes mandatory. First scenario, they come and say, if you are into bank, if you deposit more than 1 crore into your current account, you deposit more than 1 crore into your current account, return filing mandatory. If you deposit more than 50 lakhs in savings account, return filing mandatory. If you are going for a foreign tour, more than 2 lakhs, return filing mandatory. If you are paying electricity expenses more than 1 lakh, return filing mandatory. If you are having business or profession, you are having business or profession, 60 lakhs of turnover, return filing mandatory. If you are having profession, 10 lakhs of gross receipts, return filing mandatory. If you have a TDS in your 26 years, if you have a TDS in your 26 years, if the TDS goes beyond 50,000 for a resident senior citizen and goes beyond 25,000 for a non-resident senior citizen, return filing becomes mandatory. Return filing becomes mandatory. Yes. The last case, they are coming and saying, if you are a resident and an ordinary resident and you have a foreign bank account, return filing is mandatory. If you have a foreign asset, also return filing is mandatory. But if the beneficiary ends up filing the return against the beneficial owner, then either one can file it. If the owner files it, beneficiary need not file it. If the owner is not filing it, beneficiary has to file it. Clear? The last thing they're coming and saying, if you are into composite income, then they come and say, boss, whenever you're checking your gross total income, that is anyway excluding your agriculture income. So whenever you're checking for your return filing conditions, you always need to check for your return filing conditions, keeping in mind the actual business income and not the agriculture income. Meaning, let's say, for example, if your total income in the current year is 5 lakhs, your income in the current year is 5 lakhs, which includes your T income also. Will you check keeping the 5 lakhs in mind, or will you multiply it by 40% and only check for 40? You will multiply it by 40, check for 40. So 5 lakhs into 40 will give you 2 lakhs. 2 lakhs is not more than basic exemption limit. Therefore, return filing. Here are what the provisions are when it comes to return filing of individuals. Remembering what is your due dates. Income tax comes and says, boss, if you are liable for audit, any audit, whether it is income tax or foreign tax, any tax, whether it is income tax or any other law, if you are liable for audit, you will be having a due date of 31st October. If you are not liable for audit, you will have a due date of 31st July. But if the firm is liable for an audit, the partner will also move to 31st October. The firm is liable for audit, the partner will also move to 31st October because the remuneration will only be known after you file, when you file the return. Yes, so therefore both will move to 31st October. Sleeping partner or working partner? Both partner. Whether you are sleeping partner or working partner, both partner will move to 31st October. Keep this in mind, people. 2 years back, this was an amendment, so it keep coming in MCQs. If they say that the sleeping partner is, you are a sleeping partner of a firm in which there is liable for audit, your due date becomes 31st October. You are opting for presumptive, due date is 31st. It becomes 31st July. Rahul, I filed my return properly. I filed my return properly. Good. Good. I forgot to file my return, Rahul. I have an option to now file belated return. I now have an option to file my belated return. Belated return can be filed up to 31st December of the assessment year. 31st December of the same assessment year. If you file it by 31st December, great. If you don't file it, after that you cannot file. Unless you are opting for updated return. Unless you're opting for updated return. Other than that, you cannot file it. Other than that, you cannot file it. Rahul, I filed a return. I filed a return, but I made some mistakes. I can file a revised return. I can file a revised return. Can you revise original return? Can you revise updated return? Can you revise updated return? Can you revise revised return? Can you revise belated return? You can revise. So you can revise original return. You can revise revised return. You can revise belated returns, but you cannot revise updated returns. You cannot revise updated returns. What is the due date for you to revise your returns? It is 31st December of the. How many times can you revise? No limits. No limits. You can revise it any number of times. Revise it any number of times as long as you do it within first. As long as you do it within 31st. Done. Done. Yeah. Who should file my return? In case of an individual, it should be filed by individual. If individual is disabled, guardian. If the individual is in foreign country, anyone holding the power of attorney. If I am a firm, non-minor partner. If I am a firm, non-minor partner. If I am an LLP, designated partner not available. Any partner, Karta. See, Karta. Karta not available. Any? Mail yaar sona. You don't have confidence on yourself. Na na pandrathu. Any adult member. Feel yourself confident, ma. Senior aitala. 18 mudicha. No 18 agliya. Do you call yourself adult kekra? போயிட்டு இருக்குன்னா எனக்கு புரியலமா. Yes, if you are a HUF, you will be done by Karta. If the Karta is not available, any adult member. If you are into company, managing director not available. Director, foreign company, anyone with the power of attorney. Company in liquidation. These are all the people who can file your. Returns. Rahul, I did not file my return on time. Income tax comes and says, boss, if you do not file your return on time, I will levy something called as 234A. Trust under 234A. Income tax comes and says, on the due date of filing of return, tell me what is your tax liability. On the due date of filing the return, tell me what is your tax liability. On the tax liability, I will multiply 1% per month or part thereof. 1% per month or part thereof up to the date on which you file your return. Whatever is the tax liability on the due date of filing my return into 1% into the number of months up to you file your return. Second, if you do not file your return on time, I will levy something called as late filing fee. The late filing fee will be 5,000 rupees. But if I find out that you are poor, poor meaning total income is less than 5 lakhs, I will levy 1,000 rupees. 1,000. Clear? With this getting done, you now have PAN provisions. You can read it on your own. There is nothing for me to explain. Some numbers are there here and there. And the last thing is your Aadhaar linking. Income tax comes and says, if you have an Aadhaar and a PAN number, you need to link your Aadhaar with PAN. Number. The due date for linking Aadhaar with PAN right now is 31st March 2020. Got extended. For your exam, it is 31st March 23. You choose to move to the next attempt. The answer will change. Okay. Next attempt, then next attempt date, November attempt itself, the due date is something different. Due date is something different. For your exam, the due date is 31st March 2023. 31st March 2023. But income tax comes and says, hello. But income tax comes and says, if you choose to link your Aadhaar with PAN after 31st March 22, March 22, you will have to pay a late filing fee. For the first quarter, you will pay 500. After first quarter, you will pay. For the first quarter, you will pay 500. After first quarter, you will pay 1000. அப்படின்னா என்ன அர்த்தம் ராகுல்? April, May, June link பண்ணா it is 500. July க்கு அப்புறம் link பண்ணா July க்கு அப்புறம் link பண்ணா clear? We are done with what is called as payment of. Leaves us with EDS 115 BSc. Let's go for a lunch break. We are exact at 12:30. பாத்தியா? டேய் நான் முடிக்கும் போது 12:30 தான்டா. Exactly at 12:30. Let's come back at 1:30. I give you time till 1:30. You'll sleep off. அவ்வளோ சாப்பிட்டு போறீங்க. Neither yours, neither mine. 1:15. 45 minutes. What? Uh, I have this. You get this clip champ, right? But in that, what is happening is the moment you export the video, it becomes 40 times the size. Give it to me also. I'll have to upload it in my channel as well. Correct. Okay. Okay. Yeah. All right, guys. Sorry for the delay. Looks like someone was cursing me on the backside. Nothing else. No matter how much fast you try, no, the restaurant guys are not very supportive to your own needs and wants, I guess. Anyway, maybe a good enough break. Let's start with the chapter called as. Start with the chapter called as TDS. Let's quickly understand what the chapter looks like. Great. Starting with the chapter called as TDS. Just to clarify, I think TDS comes for about 4 to 6 marks, maximum 4 to 6 marks. It's a choice. It's a choice whether you want to attempt it or not, because sometimes it becomes confusing. At the same time, since I'm doing the class, I have a thing about telling you what important sections are there. If you read those important sections, maybe out of 6 you can score at least or 4 or 5. If you can remember that much, at least great. If not, it's okay. Let it go. You have other subjects to, you have other chapters to complete, and you can answer with that. Yes, but at the same time, sometimes it so happens that they also put this as a part of the compulsory question, which means it becomes a part of your compulsory question and it becomes reduced of your tax liability. Again, you'll be losing one more mark there also, but it's okay. Yeah. So it's a make a choice. You decide whether you want to do TDS or not, but at the same time, kind of an easy provisions if you understand what the answer is. Okay. With that understanding, let's understand the chapter called as TDS. TDS basically comes and says that, boss, whenever there is a payment which is happening, please ensure that the tax on that payment is deducted first itself at source by the payer, and deposit to the government on behalf of the seller. That's the whole understanding of your TDS chapter. Yes, so the TDS basically is coming and saying that any kind of payments happening has to be deducted TDS at source and then deposited to the government on behalf of the seller, so that the seller can use it as a form of credit when he's filing his return of. Otherwise, he will have to pay in the form of advance tax, self-assessment tax, etc., etc. Yes, so TDS is that kind of concept. Does TDS apply to everyone? No. No. When it comes to non-residents, it applies only when the income is chargeable to tax. When it applies to resident, only if it is covered in the section. If it is not covered in the sections, you will not deduct TDS. Non-resident, you will only deduct if it is taxable. Rahul, what happens if I don't deduct TDS? They come and say, boss, the payment which you are going to make will be disallowed under TGBP at the rate of 30% for resident, 100% for non-resident. This is what the whole logic is behind TDS. Having started this provisions, we will understand some base ground rules of the chapter. So that when we go forward in the chapters, we will not be discussing about those anymore. Yes. The base ground rule, first of all, is that they come and say TDS should be deducted on payment or credit in the books of the payer books. Either the payment should show or the credit should show, whichever is earlier. If the credit is showing, then you'll deduct on credit basis. If the payment is showing, you'll deduct on payment basis. Now the credit can show either in the name of the deductor, it's either in the name of deductee directly, or it can show in the form of suspense account or payable accounts, anything. As long as there is a credit showing, TDS is applicable. Here, this is what the provisions are, but there are certain exceptions. Exception number 1 says that if you're going to make a salary payment, in that case, TDS will be happening on payment. Anything related to salaries also, like withdrawal of PF, will be payment basis. Dividends will also be payment basis. Cash withdrawals from the banks will be payment basis, and then earnings will be payment basis. These are what the provisions are from a payment basis along with the compulsory acquisition 194 LA. 194 LA compulsory acquisition by the government will be also payment. This is what the provisions are. Yes. Next they come and say, Rahul, when should on what should you do TDS? They are saying, boss, I will give you the rate. Will give you the rate. You will have to use that rate only without including any kind of surcharge and cess. Without including any kind of surcharge and cess. Whatever rate I give you, that is what you need to deduct TDS on. Except for two scenarios. One, if it is the payment to a salary case or a non-resident case. In those cases, you also need to deduct including surcharge and cess. Rahul, what happens to surcharge and cess? The obligation is on the other person to pay it in the form of advance tax or self-assessment. Obligation is on the other person to pay it in the form of advance tax or self-assessment. So in the exam, if they come and say there is a payment of 1 lakh rupees on which winnings are applicable, 1 lakh of, what will happen? 30,000 will be deducted by the lottery guy. By the lottery guy, he will deduct 30,000 rupees. Balance irukkudu surcharge or cess, if at all it is applicable, it will be paid by the deductee in the form of advance tax, provided it goes beyond 10,000. If not going beyond 10,000, he'll pay it in the form of self-assessment. Clear? Yes. Next thing they're coming and saying, Rahul, on what amount should I deduct TDS? They said, boss, I will give you a threshold limit. I'll give you a threshold limit. If the number goes beyond the threshold limit, you have to deduct TDS on everything. You have to deduct TDS on everything. But some cases they came and said, Rahul, if it goes beyond the threshold, you only need to deduct exceeding the threshold. What are those cases? 194N talks about cash withdrawals. Then 194Q talks about purchase of goods. These two cases they came and said, boss, you need to deduct TDS on exceeding amount. On exceeding amount. Then they came and said, Rahul, all should deduct TDS. They came and said, normally everyone is liable for TDS. See? Everyone is liable for TDS. But if you are an individual or a HUF, and I find out that your preceding previous year turnover, what turnover? Preceding previous year. Please understand, it is not your previous year, it is your preceding previous year turnover. The preceding previous turnover, if it goes beyond 1 crore in case of business and 50 lakhs in case of profession, then you need to deduct TDS. You need to deduct TDS. But if you are not going beyond 1 crore or 50 lakhs, they have given some cases like hijacker. It is R extra now. So H for commission, I for rent, J for professional pieces, A for interest, C for contract, R for benefits or perquisites. R for benefits or perquisites. Hijacker cases, TDS will only come if it is going beyond 1 crore or 50 lakhs. If it does not go beyond 1 crore or 50 lakhs, TDS will not apply. Well, right? In what cases? Hijacker, H-I-J-A-C-R. H-I-J-A-C-R. These are what the conditions are. Next, they are coming and saying, Rahul, whether TDS will apply on personal and official payments both. Apply on personal and official both except for C and J. Except for C and J. C and J will only apply on official cases. C and J will only apply on official cases, because if it is applying on personal cases, it will move to 194 M to 194. Next one, they are coming and saying, boss, what happens if you violate some conditions? They have given two conditions to you. One is that whenever you are giving a payment of TDS, you need to furnish the PAN number to the person. Furnish the PAN number to the person. If you forget to furnish your PAN number to the other person will now be liable to deduct TDS at the actual rate or 20%, whichever is higher. Actual rate or 20%, whichever is higher. If I also find out that you are defaulting in filing your returns, for the latest year, in question, and the year which is in question, you have a TDS more than 50,000. You have a TCS more than 50,000 rupees, and for the latest year, you have a not filed your return on time. I will give you a fresh TDS rate of twice the actual rate or 5%, whichever is higher. In this case, they're coming and saying, Rahul, this person did not give me the PAN also, did not furnish the return also. They said highest of the three. Highest of all the three will be deducted as either it is twice the rate, actual rate, 20% or 5%, whichever is higher. What cases it will not apply? It is said that it will not apply for your salary cases, withdrawal of PF cases, winnings. 194 IA is your sale of immovable property. IB talks about your rent of immovable property by individuals. M talks about all individual and HF payments. N talks about cash. Please note the amendment, people, for those who are writing from the last attempt. Your amendment is that it is only now applicable for the latest FY. Only now applicable for the latest FY. In the older books, it will be applicable for last two FYs. Now it is latest FY. Please have this in mind. Okay. So now the provisions come and say that you should have not filed a return for the latest financial year. latest financial year, and the TDS on that year should be exceeding 50,000 rupees. In that cases, you will now be liable for a TDS of twice the rate or 5%, whichever is. Clear till here? Clear till here? Can we go forward? Yes. Going forward to the TDS sections, we are starting with the first section called as salaries. Starting with the first section called as salaries, not relevant from exam perspective, just to understand that salaries will be deducted at average rate. Be deducted at average rate. If the question is coming and asking you are the employer, should you deduct TDS? You should say yes. Say yes on the salaries which are liable for tax. Salaries which are liable for tax, you will have to compute a surcharge, cess, rebate, everything in picture, and you will have to compute the taxes at the average rate. If the employee comes and furnishes you losses, the employee comes and furnishes you losses, you will only consider the loss from house property. You will only consider the loss from house property because that is the only loss which can be set off against your salaries. If he gives you any other losses, ignore. But if he gives you any other income, that you will consider. That is what the rules come and say. At the same time, they are also coming and clarifying that, boss, if at all the employee comes and asks you that he wants to opt for 115 BAC, you will give him the benefit, but he cannot keep doing monkey business. One day he will say 115 BAC, tomorrow he'll say normal. No. He tells you once in a year, that will be the final answer. That will be the final answer. You will continue to deduct TDS at that respective rate for the whole year. If employee wants to change, he can change it during his return filing. But from your salary perspective, you'll only do it once. Give him an option once, he will change it once, and then that's the final. Clear? This is what is the provisions from employee perspective. At the same time, you also need to remember that in MCQs, if they come and say that as an employee, should you verify the facts, you should say yes. In which case, they will have to come and ask you what facts to verify. You will remember the exemptions. Remember the exemptions. And at the Tamari, you will have to give the answer. Tamari, you will have to give the answer in simple terms. Let's say, for example, the question comes and says that employer has to verify HRA. Employer has to verify HRA. You will come and say, as to verify HRA, you need to look at the exemptions. First item is actual, nothing to verify. Next item is 50% of salary or 40% of salary. Do you have to verify? No. Next item is rent paid minus 10% of salary. So you need to check whether he has paid rent or not. So you will ask for rent receipt. You'll ask for rent receipt. Then you'll ask for rent agreement. Then you'll also ask for who is that other person to whom you are paying rent to. Yes or no? Yes. So you'll ask for the rent receipt. You'll ask for the rent agreement. You'll also ask for whom you are making the payment to. You will take all these conditions. If he gives you all these details, then great. You will allow him the exemption. If not, don't allow the. Here. Next item is your withdrawal of PF. Next item is your withdrawal of PF. Income tax comes and says that, boss, if at all you have deposited some money in the RPF account, and you have withdrawn the money within a period of 5 years. Within a period of 5 years, it becomes taxable. So no, it becomes taxable. So income tax comes and says if they are going to withdraw the money, then PF authorities will deduct TDS at the rate of 10% on whatever money you withdraw. Provided the limit is 50,000 or more. Provided the limit is 50,000 or more. If it is exactly 50,000, also TDS is applicable. Moving to the next section called as 193. This section comes and says that if you have taken any kind of securities, whatever interest you have on those securities, you will deduct TDS at the rate of 10%. You will deduct TDS at the rate of 10%, provided the number is not more than 10,000 rupees. If the number is beyond 10,000 rupees, TDS will happen on the whole number. If the amount is less than 10,000, no TDS will apply. In this exam, from exam perspective, look at what the securities. If you see a simple term like debentures and all those things, TDS will apply. They seem some fancy terms like 6.5% bonds, 7.5% bonds, 10% bonds, 12% bonds. TDS not applicable. It is not applicable because the income itself will become exempt. So therefore, the TDS will also become. After you complete 193 comes the most important thing from your hijacker perspective called as 194. Mark this as important if you want to remember it for TDS. If you're going to remember TDS, then you have to mark this as important. 194A comes into picture. 194A comes and says that if you are going to pay interest other than from securities, like what? On deposits. So income tax comes and says, boss, if at all anyone is going to receive interest from deposits, check what kind of interest it is. If it is an interest from savings account, no TDS. If it is interest from FDs or RDs, you will have to check whether you are a senior citizen or normal citizen. If you are a normal citizen, the threshold limit is given as 40,000 rupees. TDS rate is given as 10%. If you are a senior citizen, threshold limit is given as 50,000 rupees. TDS is given as 10%. But if you are in a company, if you are receiving the deposit from a company, TDS rate is 10%. Limit is 5,000. Yes. 5,000. This is what the provisions from exam perspective are. At the same time, you need to be careful that boss, you will not deduct TDS on interest on savings. You will not deduct TDS on interest from partnership firm. You will not deduct TDS on interest from income tax. You will not deduct TDS on interest paid to government. Any interest from government, any interest paid to government, all those are not applicable. But at the same time, this is the most important thing where income tax comes and says that boss, if at all you are going to deposit something in a bank, which is what FDs or RDs, I will need to check what kind of bank it is. I will need to check what kind of bank it is. If the bank is a bank where there is a CBS facility, core banking solution, if the bank has a CBS facility, I will check for this 40,000 and 50,000 limit for the whole bank. The whole bank. But if I find out that the bank does not have a CBS facility, this 40,000 or 50,000 is per branch. Please understand, the number of 10% is the TDS rate and not the tax rate. Tax rate is slab rate. Tax rate is slab rate and will apply from rupee 1. Apply from rupee 1, except if you are a senior citizen, in which case you can claim ATTTB. You can claim ATTTB. Otherwise, you are liable for tax at the slab. Yes. From 194A perspective, we need to remember that it is a 10% and the limit is 40,000, 50,000, 40,000 per branch in case of no CBS, 40,000 per bank in case of CBS. Clear? Yes. At the same time, please be remembering that it is interest on savings, no TDS. Yes, interest on savings, no TDS. Moving from A to B. A to B, we are into winnings. We are into winnings, 194B and 194BB. Income tax comes and says if you have a winnings, the tax rate will be same as the tax rate. The TDS will be same as the tax rate, meaning the tax rate will be 30%. Threshold limit is given as 10,000. Threshold limit is given as 10,000. Here they came and clarified that boss, if at all there is a winnings on which you are going to deduct TDS, I will need the TDS even on a kind payment. On a kind payment, meaning if you are going to give a lottery winnings in kind, then in that case, please collect the TDS from that other person, then only give the gift to him. Give the gift to him. Don't give the gift without collecting the TDS. If you collect the gift, you give the gift without collecting TDS, your mistake. I will still treat you as an assassin. As an assassin. With B getting over, we are now into C. Now into C. C talks about contracts. C talks about contracts. Next most important thing from exam perspective. The most important thing from exam perspective, we are into 194C, the second of hijacker. The second of hijacker, meaning this provisions only apply in case you are an individual or HUF exceeding the threshold limit in your previous year or preceding previous year. Preceding previous year, or it applies to any other person who is not an individual or HUF. You are covering what kind of payments? You are covering contract payments. You are covering contract payments. Income tax comes and says that whenever you are making a contract payment to someone, please deduct TDS at the rate of 1% if the other person is an individual or HUF, and 2% if the other person is which means now you will check for whom you are going to pay. You are going to pay. If you are going to pay to an individual or a HUF, the rate is 1%. If you are going to pay to someone else, the rate is %. Threshold limits are given as per payment 30,000, overall year payment 1 lakh. One payment also exceeds 30,000, for that payment mandatory TDS. But overall, if the year exceeds 1 lakh rupees, then everything will be liable for TDS. What you are going to cover in this is contract of work. Contract of work, meaning job work cases are covered here. Job work cases are covered here. You go to someone, you give him your raw materials, he manufactures the final products and give you. That is 194C. You go to him, you tell him that you itself take care of raw materials, you itself make the product. This is sale of goods. This will go into 194Q. Going to 194Q. Please understand the difference. 194C will apply when I give the raw materials and he makes the product. 194Q will apply when he itself breaks the raw materials, he itself makes the product. At the same time, this section also comes and clarifies that if at all you are engaging a transport operator, this transport operator comes and gives you a declaration saying, I am not having more than 10 vehicles at any time in the previous year, and here is my PAN number. TDS will not apply. Two conditions to satisfy. One condition is that he should give you a declaration saying that he has less than 10 vehicles, and he should give you his PAN number. Rahul, he gave me the declaration, did not give me PAN number. 20% TDS. He gave me the PAN number, did not give me declaration. Normal 1 or 2%. Rahul, he did not give me declaration also, did not give me PAN number also. 20%. Rahul, he did not give me declaration, did not give me PAN number, did not file return also. 20%, because Twice of 2 is also 4. 5 is also lower. 20 is the highest. So therefore, you will go to 20%. Clear? Yes. Yes. Great. Rahul, he gave me declaration. He gave me PAN number but did not give me return. 0. He gave you declaration and the PAN number. Conditions are satisfied. TDS itself does not apply. 0 twice is 0 da. Yes or no? That is what the answer will be. TDS will itself not apply. TDS will itself not apply. This is 194C. In exam, you need to remember 194C or a threshold limit, TDS rate, transport operator having less than 10 vehicles, declaration and a PAN number. And the fourth thing is to remember that you are going to give raw materials and he is going to make final product. You are going to give raw materials, he is going to make final product. Any doubts? Completing. But if the overall year goes more than 1 lakh, then that will also. Here, completing 194C, we are now into 194D. A. We are now into 194D. A. We are now into 194D. A 194D commission and all we'll discuss together with 194H. We are into 194D. A talks about maturity of life insurance. Maturity of life insurance. Income tax comes and says, boss, if I find out that a life insurance is matured and taxable, find out that the life insurance is matured and taxable. How does a life insurance become matured and taxable? You need to check whether ATC or conditions are satisfied or not satisfied. If the policy is within 20%, meaning the premium is within 20%, the premium is within 20%, the policy will become exempt. If the premium is within 10%, policy will become exempt. If the premium is more than 10% or more than 20%, policy becomes taxable. Policy becomes taxable. If the policy ends up becoming taxable, come and check whether what is the amount you are receiving. Come and check what is the amount you are receiving. If you are going to receive 1 lakh or more, then now I will come and say, boss, whatever is the income element on this insurance will become taxable. Income element will become taxable. Please understand, while checking the threshold limit, I will check for the money received. But while doing TDS, I will do TDS only on the income portion. Only on the income portion. Rahul, let's say for example, current year, I have a life insurance policy where the premium is more than 25%. Is the premium policy taxable? Now what happened is, in that policy, I got 3 lakh rupees. And I had paid a premium of 2 lakh rupees. Will TDS apply? Because 3 lakhs is more than 1 lakh and TDS will now apply at the rate of 5% on 1 lakh. This will apply at the rate of 5% on the income element, which is your 1 lakh. Not so relevant from exam perspective. It has come sometimes, it has mostly not come, so you can ignore it. And go. Coming to the next one, which is called as 194E. This is the next important thing from exam. We are into 194E. This provision comes and says that, boss, if at all you have a non-resident entertainer, or you have a non-resident sports person, you have a non-resident entertainer, or you have a non-resident sports person, or you have a non-resident sports association. In that cases, TDS will apply as per 194E. What cases it will apply? Non-resident entertainer should do entertainment. Non-resident sports person should come and play sports, or should come and contribute to an article, or do some advertisements. Non-resident sports organization should get some guarantee fees. If any of these conditions are satisfied, I find out that you are a non-resident and you are not a citizen of India. Your TDS rate will become 20 plus applicable surcharge and applicable cess. Why applicable surcharge and cess? Because it is a non-resident. Whatever non-resident income is there will be taxable at the rate of 20% plus applicable surcharges and applicable. Clear? Yes. What are the kind of payments we are covering? Non-resident sports person, it is playing sports, doing article writing, or doing advertisement. Non-resident entertainer, it is entertainment. Non-resident sports association, guarantee fees. With 194E getting over, we are into 194G. You can ignore EE and all. 194G we will discuss along with 194H. So now coming to H. Whenever you are discussing H, you will also take the same kind of provisions for G and D. G talks about lottery commission, D talks about insurance commission. It doesn't matter. The moment you see the word commission in exam, When you see the word commission in exam, ask yourself if the threshold limit is more than 15,000 or less than 15,000. If the threshold is more than 15,000, TDS will be applicable at 5%. Whether you go to D, whether you go to G, whether you go to H, all the same. All the same. The moment you see commission, commission is at the rate of 5% for the threshold limit of 15,000. But H is the most important from exam because this is a hijacker case. Hijacker case. Rahul, I don't remember section numbers. Don't quote it. Don't quote it. Commission portha varaikum, see the answer. Commission na 5%, 15,000. That's all is the answer. You don't know whether it is C, D, G or H. It doesn't matter. Ignore it and go. Ignore it and go. Just put the numbers. Just put the rates. Okay. So from exam perspective, you need to remember 194. H talks about commission. TDS rate is 5%. Threshold limit is 15,000. This is the next hijacker case. Next hijacker case. After H gets over is I. We are into I. Talking about rent. Next and the most important thing from exam. Talking about 194. I. Speaking of rent, income tax comes and says, boss, if you are going to pay rent to someone, please ensure that first of all, you should be a hijacker case. Yeah, hijacker case, meaning you should be an individual RHF beyond the threshold limits, or you should be any other person. Second, they are coming and saying, boss, the total rent which you are planning to pay in the current year should be more than 240,000 to that person. The total rent which you are planning to pay to that person during the year should be more than 240,000. It doesn't matter the rent is for what. The rent can be for machinery, it can be for plant, it can be for building, it doesn't matter. As long as you are paying a rent more than 240,000, you will deduct TDS. At what rate will you deduct, Rahul? If at all you are going to make the payment of plant and machinery or equipment, if you are going to make the payment of a plant and machinery or an equipment, the rate is 2%. If you are going to make the payment for any other case, it is 10%. Rahul, same person gave me laptop also, same person gave me building also. What will I do? I will check the 240,000 for both together. Check the 240,000 for both together. The moment I find out it is applicable, the laptop rent I will pay 2% and the building rent I will pay 10%. Please understand, it is not per asset, it is per recipient. Per recipient. My deductor can have 5 recipients also. Each person 240. Each person it is 2 lakh. Clear? Yes. After you complete 194I, we will take a diversion and we will move to 194IB. Move to 194IB. This provision comes and says that, boss, if at all you are not liable for TDS under 194I, why will you not be liable for TDS? Because you are an individual RHF not satisfying the limits. You are an individual RHF not satisfying the limits. You will move to something called as 194IB. 194IB. Income tax comes and says, boss, if at all you are planning to make a payment more than 50,000 per month, more than 50,000 per month, please ensure that you deduct TDS at the rate of 5%. TDS at the rate of 5%. Rahul, when do I have to deduct TDS? Please deduct only on the last day of the month. Sorry, last day of the year. Please deduct only on the last day of the year. What do I mean by last day of the year, Rahul? Let's say, for example, the person stayed in the property for the whole year. In that case, you will deduct it from the March payment. Deduct it from the March payment. If at all the person vacated during the year, you will deduct it from the day on which he vacated from the premises. Deducted from the day on which you vacated from the premises. So it is day of vacation or 31st March, whichever is later. Yeah. Whichever is earlier, man. Correct. Sorry. Whichever is earlier. If he vacated earlier, then you will deduct it from 31st March. If he did not vacate, then in that case it will be 31st March. Yes. Or let's say simple terms, whichever is applicable. If he left the premises, then on the last month in which he left the premises. If he did not leave the premises, it is on 31st March. But the checkpoint is here. Income tax comes in. Rahul, there could become a scenario where my TDS itself is more than the last month's payment. When will this happen? Is normally in cases when you don't furnish PAN numbers. Because in that case the TDS rate now becomes 20%. So in that case, income tax comes and says, let's say the last month's payment is 1 lakh rupees. But because you are going to deduct TDS for the whole year at the rate of 20%, the number comes to 5 lakhs. Will you go back to the tenant and will you go back to the landlord and ask him for the 4 lakh extra? You will come and say that, boss, if I had to deduct on 1 lakh rupees, 1 lakh fully I will take off. Income tax will give you the benefit of the balance 4. Provisions are coming and saying the whole year's TDS should deduct on the last month. But if it so happens that the TDS is not sufficient to cover the last month's rent, deduct the full last month's rent and keep it off and deposit to government. Balance will be ignored. In exam, they will ask these kind of questions only. They'll come and say you that the rent of this person is 50,000 and 55,000, but the person failed to furnish PAN number. In that case, you will come and say, boss, 55,000 per month for the whole year into 20%. That will become the TDS rate. But last month's rent is only 55,000. Therefore, the maximum TDS to be deducted is 5. Clear? After you complete IB, we will go back to IA. Go back to IA. IA comes and says that, boss, if at all you're going to sell a immovable property. Where did we learn this? Where did we learn this? IFOS chapter. We learned it in IFOS chapter. In IFOS chapter, we came and discussed that, boss, if at all you're going to sell any kind of immovable property, whenever the seller is going to sell an immovable property, whenever the seller is planning to sell an immovable property, the recipient will now have to deduct TDS at the rate of 1%. At the rate of 1%. On what, Rahul? On the SDV or the consideration, whichever is here. The next amendment for the current year. Next amendment for the current year, 50 lakhs is on stamp duty value or the actual consideration, whichever is here. 1% will also be deducted on whichever is. Even if you have not received consideration of 50 lakhs, but the stamp duty value is more than 50 lakhs, you will deduct 1% on that 50 lakhs. Deduct TDS at 1% on lakhs. The next amendment for the current year, my likelihood this is coming in exam. My likelihood this is coming in exam for MCQs. Okay, so careful on those. You will now deduct 1% on your consideration or stamp duty value, whichever is here, whichever is. For the purpose of checking your 50 lakhs, also you will check on consideration or stamp duty value, whichever is. Clear? Yes. And whenever you that's a gift. Does capital gains apply on gift? Capital gains like gift varaduma. The moment you give something as gift, capital gains tax itself does not come. When it does not come, this provision will never even apply. Clear? It only has the problem when it is inadequate consideration. Clear? Yes. Moving to the next one called as 194. IC and all is not coming for exam. Moving to 194J. To 194J. 194J is the next and the most important thing from exam perspective. We are into 194J, talks about fees for professional service, fees for technical service, royalty, and non-compete fee. Then director sitting fees. Director sitting fees. Income tax comes and says, boss, for your fees for professional separately, FTS separately, royalty non-compete separately, director no limit. Director no limit. For each item separately, there is a limit of 30,000. Each item separately, there is a limit of 30,000. One person, I paid 28,000 of FTS and 24,000 of royalty. Will I deduct TDS? No. No. Each nature of payment should go beyond 30,000. Each nature of payment should go beyond 30,000. If each nature of payment goes beyond 30,000 rupees, for that nature of payment, TDS will be as follows. If it is a fees for professional service, 10%. If it is fees for technical service, 2%. If it is royalty for cinema films, 2%. Royalty for normal cases, 10%. Director sitting fees, 10%. Non-compete fees, 10%. Call center services, 2%. Call center services, 2%. I'm repeating myself. If it is fees for professional service, 10%. Fees for technical service, 2%. Royalty for cinema films, 2%. Royalty normal cases, 10%. Call center services, 2%. Call center services, 2%. Director sitting fees. This is what the 10%. Royalty same. Yes, these are what the provisions are for 194J. From 194J, the most common thing to ask in exam is they will come and say the fees for technical service is 28,000 and the fees for professional service is 24,000. Will you deduct TDS? Not deduct. Same time, if at all the provisions come and say that there is an individual. There is an individual. Please understand, for an individual, the only sections which can apply is fees for professional, fees for technical. Individual Puerto Rico, he will never deduct TDS on royalty or director sitting fees. Or director sitting fees. He will never deduct royalty on never deduct TDS on those cases. For an individual, only TDS applicable on fees for professional, fees for professional, and fees for technical. This is what is enough from exam perspective. Beyond that, you don't have to remember from 194J. From 194J. After J comes L irka, L illa, LA irukku. We have something called as LA. Income tax comes and says, boss, if at all government is planning to compulsorily acquire your property, the government is planning to compulsorily acquire your property, government will now deduct TDS on you. Government will now deduct TDS at you at the rate of 10%, provided the consideration exceeds 2.5 lakhs per annum. 2.5 lakhs per annum. My vague memory, I think this came in last attempt. My vague memory, it came in last attempt. It is not coming in this exam. My vague memory, it came in last attempt, so it is not coming in this exam. Okay, these things and all, if it has already come once, it will not be tested again and again. They also need some variety, no? Yes, so most likely it is not coming for this exam. You can take it a choice. Take it a choice. It will come in capital gains. TDS mattum varadu. Capital gains it is coming. TDS alone it is not coming. It might be avoided. It might be avoided. Moving from LA, you go to M. You go to M. Income tax comes and says, boss, if you are under C, J, or H, you are under C, J, or H, and you are an individual or HF who is not liable to TDS in those cases. Not liable to TDS in those cases. Bring all those people, bring it to them in 194M. Bring those people into 194M. What cases? 194 C, J, H, meaning contract, fees for professional and technical service. These cases you will move to 194M. You will move to 194M. Income tax comes and says, boss, if at all an individual is not covered in those cases, we will move to 194M with the TDS rate of 5%. Threshold limit of 50 lakhs for all the three together. For all the three together for the whole year. For all the three together and for the whole year. What are the cases, Rahul, when TDS will not apply in those cases? If you are an individual or HUF below the limits, or if you are going to make a personal payment, in those cases you will move them to 194M. You will move them to 194M. Clear? Yes. Moving to the next one called as 194N. 194N comes and says you are into cash withdrawals. You are into cash withdrawals. Income tax comes and says if you go to your own bank and deduct your own money, you go to your own bank and withdraw your own money, income tax will come and say that the bank now has to deduct TDS at the rate of 2% if you withdraw more than 1 crore from the same bank. To withdraw more than 1 crore from the same bank, this 2% will be deducted above 1 crore. It will not be deducted from first rupee, it will be deducted above 1 crore. But if I find out that you are a defaulter in filing your returns, Rahul, this person has not filed his return for the last 3 years. In that case, income tax comes and says he will start deducting TDS. Who is he? Bank. Bank will start deducting TDS right from 20 lakhs. Bank will start deducting TDS right from 20 lakhs. From 20 lakhs to 1 crore, he will deduct at 2%. Beyond 1 crore, he will deduct at 5%. On 1 crore, he will deduct at 5%. These are the only two things you have to remember from 194N, and yes, important for exam. Now, what do you need to remember? Check whether you are filing your returns properly, not filing your returns properly. If you are filing your returns properly beyond 1 crore, 2%. Not filing your returns properly beyond 20 lakhs, 2%. Beyond 1 crore, 5%. Now, if I go beyond 1 crore, will 5% happen from 20 lakhs? No. 20 lakhs to 1 crore will be 2%. Beyond 1 crore, it will be 5%. Clear? Yes. Moving to 194. 194 talks about your e-commerce operator. Income tax comes and says that, boss, if you are an e-commerce operator like Flipkart, Amazon, eBay, etc. If you are an e-commerce operator who is helping someone else to sell his products on your portal, you will go to the seller. And come and say, boss, going forward, whatever products you sell in my portal will be liable for TDS at the rate of 1%. Meaning, whenever the buyer pays the money, this money will first go to the e-commerce operator. E-commerce operator will deduct 1% paid to government, balance he will give it off to the seller. Now, this payment directly happened from the buyer to seller, doesn't matter. E-commerce operator will still come into picture and he'll come and say, boss, in that case also 1% is applicable. Either you give me the money and I will pay it to the government, or I will pay the money right now and adjust it tomorrow. Anyways will happen. And the provisions come and say that, boss, if at all e-commerce operator is in picture, no other section will apply. Even if you do a royalty payment from an e-commerce platform or a fees for technical service from an e-commerce platform, you will still go to 194. This is the superior section. superior section. At the same time, they are coming and clarifying that boss TDS will not apply under this section if you are an individual. You are an individual not having more than 5 lakhs worth of revenue from the e-commerce platform. Not having revenue more than 5 lakhs from the e-commerce platform. Meaning you should go to Flipkart and you should not sell more than 5 lakhs. You should not sell more than 5 lakhs. In that case, Flipkart will not deduct TDS on you. Flipkart will not deduct TDS on you. Will enough Flipkart will deduct TDS from rupee 1. Yes or no? This ends your O. Ends your O. Now coming to P. Now coming to P. Income tax comes and says that boss, you are a person who is a senior citizen. You are a person who is a senior citizen with an age more than 75 years. Age more than 75 years. 3/4 of your life. 3/4 of your life. You are an age more than 75 years. If you have something called as pension income, you have something called as pension income, which you deposit in a bank. The bank is giving on that interest. The bank is giving on that interest. Then now the bank has been given an obligation. The bank has now been given an obligation where the bank will now compute your taxes for the whole year. Bank will compute your taxes for the whole year and he will deposit the differential TDS to the government. He will deposit the differential TDS to the government. If this person ends up depositing the differential TDS on your behalf to the government, you will not be required to file a return of. Not be required to file a return of income. Now, I am a bank. I am a senior citizen who goes to two banks. Goes to two banks. One bank I am giving pension, the other bank is giving me FD. In that case, will the section apply? No. Section will not apply. In that case, the respective sections will start applying. This section will not apply. This section will only apply in case you are having one bank account and pension goes to the same bank account. Have one bank account and the pension goes to the same bank account. Interest should also come from the same bank account. Interest should also come from the same bank account. Clear? Yes. Dropping Q right now. We'll discuss it after TCS. We are into 194R. This is your amendment for the current attempt. This is your amendment for the current attempt. Income tax comes and says that boss, you should be a hijacker. You should be a hijacker, meaning individual HUF beyond the threshold limit. Beyond the threshold limit. If at all you are going to give someone a benefit or a perk. What are you going to give? A benefit or a perk, which should be a business benefit or a perk. Yeah? Benefit or a perk. What? Don't give him gifts which are taxable under IFOS. Don't give him gifts which are taxable under IFOS. I am talking about gifts which are taxable under PGBP. Talking about gifts which are taxable under PGBP. If it was a gift under salaries, it would be 192. I am talking about gifts taxable under PGBP. If you are going to give any such benefit or perquisite to someone, income tax comes and says that boss, if the benefit or a perk which you calculated goes beyond 10,000 rupees, goes beyond 20,000, goes beyond 20,000 rupees, TDS rate will be 10%. TDS rate will be 10%. If it goes beyond 20,000 per annum, TDS will be at the rate of 10%. Which means now we need to understand what do you mean by a benefit or a perk. What do you mean by benefit or a perk? In simple terms, let's say for example, you go to a person and you come and say, boss, if you sell my products properly, I will give you a Hawaii ticket tomorrow. I'll give you a Hawaii ticket tomorrow. This is a benefit or a perk given to him. In this case, Rahul, I gave him a Hawaii ticket. What to do? Same as your winnings. Same as your winnings. What will you do? You will ask him to pay the TDS first and then only give him the Hawaii ticket. You'll ask him to pay the TDS first or then only give him the Hawaii ticket. Option number 2, you can gross up. You can gross up, you can come and say, boss, the total benefit I'm giving it to you is including this number. Is including this number, your choice. Your choice. Second, I'm coming and saying, Rahul, I sold the product to someone. Sold a product to someone. The product value is 1 lakh rupees. I sold it to him for 98,000. I sold it to him for 98,000. Will TDS apply? TDS apply? No. Please understand, people, I am trying to give him a benefit or a perk, not a discount. Not a discount. Selling a product of 1 lakh rupees at 98,000 is me giving him a discount. Me giving him a discount. This will not be liable for TDS. What will be liable for TDS is me directly giving him a benefit or a perk. Directly giving him a benefit or a perk. Clear? Next item, they're coming and saying, boss, you engage some social media influencers. You engage social media influencers. You gave them some products to try. Give them some products to try. Will TDS apply? They came and said, very simple, boss. If the social media influencers keep the product with themselves, TDS will apply. They use the product and give it back to you, TDS will not apply. Yes, social media influencers give a product, take it back, no TDS. Don't give it, take it back, TDS will apply. I called some people for a conference. I called some people for a conference. The conference is from 5th April to 7th April. Conference is from 5th April to 7th April. I called these people and I came and said, your travel expenses I will take care. Your travel expenses I will take care. Your accommodation expenses also I will take care. TDS applicable, not applicable? Not applicable. Because this is a business requirement. This is a business requirement. But if that other person comes and says, Rahul, if you want me to come on 5th April, I will come on 4th April. I will come on 4th April. That 4th April order extra date or expenses also you need to take care. 4th April order extra expenses also you need to take care. Now you are giving him a benefit or a perk. That one day expenses will become liable for TDS. Become liable for, clear? Last thing and the most important thing from this section which is coming in exam is that this is only applicable from 1st July. This is only applicable from 1st July. If you give a benefit or a perk which is after 1st July only, it is applicable for TDS under 194R. If you give a benefit or a perk before 1st July, it will not be liable for TDS under 194R. But please do understand the fact that even if you are taking the TDS from 1st July, the threshold limit of 20,000 should be checked from 1st April. Be checked from 1st April. Appadina enna artham Rahul? Let's say for example in April and May you gave him 10,000 rupees benefit. You gave him a benefit of 10,000 in April, 10,000 in May. May. Then suddenly in July you gave him 5,000 rupees. Suddenly in July you gave him 5,000 rupees. Will TDS apply on the 5,000? Yes. Because 20,000 limit already crossed. 20,000 limit already crossed. Rahul, why are you not deducting TDS on 25,000? Because 20,000 was before 1st July. Because the 20,000 was before 1st July. Rahul, the example is like this. Let's say for example in the month of April I gave him 7,000. In the month of May, I gave him 7,000. In the month of July. In the month of July, I gave him 7,000. Gave him 7,000. In this case, will TDS apply on what number? 10,000. Please understand, people, that the overall threshold has crossed 20,000, which means TDS will now apply from rupee 1. But the problem is April and May, you cannot do TDS. You cannot do TDS. So therefore, you will only do TDS on July. Only do TDS on, right? Clear? Be extra careful about these provisions, people. If at all 194R comes in exam, they will play around with April and May. They will play around with April, May, June. First quarter will be played around for you. You have to be extra careful on the fact that TDS will only start applying from July, but the threshold will start being checked from April itself. Will start being checked from April itself. If you find out that the threshold is getting exceeding, then everything after July will be liable for. Everything after July will be liable for. Clear? With 194R getting over, you are now done with your TDS provisions, except for one which is there in dividends chapter. Which talks about dividends. It talks about section 194. Income tax comes and says, if at all a dividend is going to be given by the shareholder to the employee, given by the company to the shareholders. If at all a dividend is going to be given to a company, the shareholders, dividend will be liable for a TDS at the rate of 10%. Will be liable for a TDS at the rate of 10%, only on the date on payment. TDS will not apply in case the payment is happening to an individual. This individual, you should have made the dividend other than by cash. And the dividend amount should not exceed 5,000 in the year. The dividend should not exceed 5,000 in the year. 3 conditions to be checked. Condition number 1. Condition number 1. Individual. Condition number 2, payment should happen other than by cash. Condition number 3, dividend should not exceed 5,000. All the 3 satisfied, no TDS. Do not satisfy, 10% TDS. Do not satisfy, 10%. Clear? Yes. Moving out of TDS, we are now into TCS. Income tax comes and says, boss, we are now into TCS. Income tax comes and says, boss, TCS works on the reverse scenario. In TDS, deduction was happening by the payer. To the recipient. TCS is a scenario where whoever is selling the product will now collect extra money from this person. Which means the payer now has to pay more than 100 in the form of This is what the provisions come. Okay. TDS, what will happen? Payer will deduct TDS for the seller and deposit to government. TCS portavarico, seller will collect more money from the payer. Seller will collect more money from the payer and deposit on behalf of the payer to the government. This is the expenditure for payer. Expenditure for a payer. On the expenditure is paying extra money as TCS. Paying extra money as yes. The provisions are pretty much the same. Before that, let's understand what happens in a PAN case. What happens in a PAN case? Income tax comes and says, if at all there is a TCS to be obligated, and the person forgot to give the PAN number. There it was actual rate or 20%, whichever is higher. Here it is twice the rate or 5%, whichever is twice the rate or 5%, whichever is higher. This is what the provisions are. And then the same provisions as return filing, which means if you have not filed your return on time for the latest assessment year and the TDS and TCS including is exceeding 50,000 rupees, you will deduct TDS at twice the rate or 5%, whichever is twice the rate or 5%, whichever is higher. With that understanding, let's understand what are the TCS provisions. Just to clarify, TCS not so relevant from exam. Not so relevant for exam. This somewhere here and there comes in your compulsory questions. Somewhere here and there, they'll just suddenly put one number and they'll come and say what to do with this. If you recall TCS, say TCS. Don't recall, it's okay. Tax liability alone will change, nothing else will change. Okay. Yes, the provisions are like this. They come and say that, boss, if you are planning to sell any kind of alcoholic liquor, from the person to whom you are selling this, you will have to collect TCS at the rate of 1%. What alcoholic liquor am I talking about, Rahul? This should be for home consumption. It should not be for further manufacturing. Should not be for further manufacturing. It should be for home consumption. In that case, I will deduct TDS at the rate. I will collect TCS at the rate of 1%. Next, I'm coming and saying, boss, I'm selling any kind of tendu leaves. Tendu leaves are something which I use for cigarettes. TCS will be at the rate of 5%. Next, they are saying, boss, I'm going to sell any kind of timber. This will be at the rate of 2.5. Remember this and this. Alcohol and all is not come in exam. Timber and all has come in exam. Okay. So next item is your scrap. Scrap will also be at the TCS rate of 1%. Scrap will also be at the TCS rate of 1%. Beyond that, they're coming and saying if you're into coal and all, coal will also be at 1%. If you're doing any kind of toll parking, toll parking will be at the rate of 2%. And if you're planning to sell any kind of motor vehicles, each motor vehicle should exceed more than 10 lakhs. TCS will be collected at the rate of 1%. Rahul, what is this each motor vehicle? Very simple. They are coming and saying, boss, each motor vehicle value should exceed 10 lakh rupees. In that case, TCS will apply. This will only apply if you are selling it from retailer to the final consumer. It will only apply if you are selling the retailer to final consumer. From manufacturer to retailer, not applicable. At the same time, they are coming and clarifying that, boss, all these will only apply in case the seller's order turnover exceeds 1 crore rupees in case of business, 50 lakh rupees in case of profession. Where did we learn this? Hijacker. Same hijacker provisions will also apply. And the next thing they're coming and saying, boss, if you are able to prove that all these products are going to be used for further manufacturing, TCS will. Yeah. From exam perspective, remember the scrap, remember the forest timber, remember the motor vehicles. Motor vehicles keep coming very often, where you need to remember that motor vehicles having a value more than 10 lakh rupees will be liable for TCS. Rahul, my motor vehicle does not exceed 10 lakh rupees. What will happen? While TCS will not apply, 194Q can apply. 194Q can apply if the product overall exceeds more than lakhs. 50 lakhs. With you getting over with these kind of provisions, we now have something called as a foreign case. They're coming and saying, boss, if you are planning to go for a foreign tour, TCS will be collected at the rate of 5%. You say, no, Rahul, I'm not planning to go for a foreign tour. I'm just planning to send money outside India. They said, boss, I will start applying TCS on you if you send money more than 7 lakhs. TCS will be at the rate of 5%. What is this more than 7 lakhs? It should exceed 7 lakhs, not from rupee 1. It is beyond 7 lakhs. Beyond 7 lakhs, you will apply TCS at the rate of 5%. This is the rate of 5%. But I came and said, no, Rahul, I'm actually sending this money for an education loan. Sending this money for an education loan. The 5% will become 0.5%. 0.5% will become 0.5%. Rahul, I'm sending this money to someone outside for a foreign tour. Yes, TCS will apply at 5% on the full money. On the full money. The moment you see the word overseas travel, it is full 5%, full, no number, with no limits. Full 5% with no limits. If you send this money for anything else, it is 5% above 7 lakh rupees. If you're sending this money for education loan, it is 0.5% above 7 lakh. Above 7 lakh rupees. Coming to the last thing in your whole chapter is your 194Q along with 206C1H. 94Q along with 206C1H. The provisions are like this. The provisions are like this. The provisions come and say, when you sell your products, until now we have been discussing services, now we are into goods. If you are planning to sell any kind of goods, and I find out that the consideration for this goods exceed 50 lakh rupees in the year, exceeds 50 lakh rupees in the year, whatever is the amount beyond 50 lakhs, whatever is the amount beyond 50 lakh rupees, TDS will happen at the rate of 0.1% above 50 lakhs. TCS will happen at the rate of 0.1% above 50 lakhs. TDS is also at 0.1 above 50 lakhs. TCS is also at 0.1 above 50 lakhs. Rahul, how do you understand which one to apply? Check who the buyer is and who the seller is. Check who the buyer is and who the seller is. The person who is under an obligation should have a turnover more than 10 crores. The person who's under an obligation should have a turnover more than. In TDS, who's having the obligation? Having the obligation, buyer has the obligation. In TCS, who has the obligation? Seller has the obligation. So which means if the seller turnover is more than 10 crores but buyer turnover is less than 10 crores, you will do TCS. If the buyer turnover is more than 10 crores, seller turnover is less than 10 crores, you will do TDS. Buyer turnover is also more than 10 crores, seller turnover is also more than 10 crores, you will do TDS. Now buyer is also less than 10 crores, seller is also less than 10 crores. Nothing will. Clear? Yes. So the provisions are like this. You have to sell goods consideration more than 50 lakhs. If you sell consideration more than 50 lakhs, 0.1% beyond 50 lakhs will be TDS or TCS. TDS will apply if buyer has more than 10 crores. Seller, if TCS will apply if seller has more than. Now, if I do not furnish PAN, what will happen? In TDS cases, you will be liable for 5%. In TCS cases, you will be liable for 1%. The 20 in TDS will become 5. The 5 in TCS will become 1. 20 in TDS will become 5. The 5 in TCS will become 1. So which means if at all the buyer is liable for deducting TDS and the seller does not give a PAN number, you will do at the rate of 5% exceeding 50 lakhs. If the seller is more than 10 crores, but buyer did not give that PAN number, you will do 1% more than 50 lakhs. Now both the persons are properly giving PAN, both the people are there 0.1% above 50 lakhs. Oh, any doubts? Any doubts? No. Ending this chapter with the administrative part of the provisions. The provisions come and say, if at all you have deducted TDS, on payment or credit, whichever is earlier, you will have to deposit the TDS by the 7th of the next month. 7th of the next month, except for the month of March. Except for the month of March, where you can deposit by 30 April. You can deposit by 30 April. You can deposit the month of March by 30 April. Balance months you have to deposit by 7th of next. Rahul, I forgot to deduct TDS. I forgot to deduct TDS. Income tax comes and says, if you forgot to deduct TDS for the period you did not deduct TDS, you will be liable for interest at the rate of 1% into TDS amount into number of months you forgot to deduct. Number of months you forgot to deduct or part thereof. 1 day also will be considered as a full month. Day will be considered as a full month. Now I deducted TDS. I forgot to deposit the TDS. I deducted TDS and forgot to deposit TDS. It is 1.5% into TDS into number of months. When do you start? When do you end? You start from your due date. You start from your due date of payment. You start from your due date of payment till date of payment. Here what it is. Due date of deduction. due date of deduction to the date of deduction. The date of clear? Yes. Let's say for example that you were supposed to deduct TDS on 28th April. You were supposed to deduct TDS on 20th April. You forgot to deduct the TDS on 20th April. You ended up deducting the TDS on 9th of July. You deducted the TDS on 9th of July and you deposited the money on 10th of December. Deposit the money on 10th of December. Your interest at the rate of 1% will start from April, May, June, July. These 4 months will be liable at the rate of 1%. Since you deducted in the month of July, you need to deposit by 7th of August. Did you deposit on 7th August? No. So which means you will be liable for interest of August, September, October, November, December at the rate of 0.5%. Clear? Clear? Great. This marks the end of your TDS. This interest provision will come for MCQs. This interest provision will come for MCQs, and 99% the number will be the same. I don't remember the number properly. I think it's 1690 something, 1690 or 1490. That's the number varum. Same provision, same date, same numbers, everything will be the same. Abbe copy paste panni thandan irupanga. Okay, that same fees for professional services, you started with 40,000 rupees, then later on you deducted 90,000 fully, and then you deposited the whole number. Same provision. Answer also will not change. Something similar to that will come. I think it's some 1690 nanikra. My vague memory 1690 the number nanikra. Same number comes in inter also, same number comes in final also. Inter level na final vandrum. Okay. Remember this provision also. Summarizing your whole TDS provisions, you need to remember 194A, then 194C, 194J, 194H, 194I, IA, IB, and then 194M, 194Q, 194N, 194R, along with 206C1H. And then you need to remember that motor vehicles thing. Winnings and all you should know, that's not something to remember. You should know that the tax rate is 30%. TDS will also be at. Clear? Any doubts? MMR na? Enna artham? Appadina enna? 192A has something called as MMR. Last attempt, next attempt is changed. Anyway, for the benefit of the everyone, MMR basically means the maximum tax rate applicable in India for the resident individual. The maximum tax rate which is applicable in India for a resident individual, meaning 30 plus 37 plus 4 number is 75. MMR means the highest tax rate applicable on your resident individual, meaning it is 30 plus 37 plus 4, which is nothing but 42.744. 75 ella varadu. Surcharge is on basic tax, cess is on both number. You will have to add each item. Okay. In 192A, they will come and say that if you don't furnish the PAN number, it will be deducted at MMR, correct? And the provision varadu exam. 192A. Clear? Yes. Only one thing left for your exam called as updated return. Before that, we have something called as 115. BSc. Now start your time. We are going to look into the whole book, and I'm going to tell you which ones are liable for 115 BSc, which ones are not liable for 115 BSc. Chapter number 1 was about basics. Or chapter number 2 is about rates of taxes. In 115 BSc, the rates of taxes are 0 to 2.5, 0, 2.5 to 5, 5, 5 to 7.5, 10, 10 to 12.5, 15, 12. Correct? Start over again. 0 to 2.5, 0, 2.5 to 5, 5, 5 to 7.5, 10, 10 to 7.5 to 10, 7.5 to 10, 15, 10 to 12.5, 20, 12.5 to 15, 25, beyond 30%. Beyond is 30%. On these, you will be liable for rebate. You will also be liable for surcharge. You'll also be liable for surcharge. But please do understand that any kind of special tax rates will continue to apply. Any kind of special tax rates will continue to apply. Capital gains will be taxable at their respective rates, and earnings will be taxable at their respective rates, and unexplained income will be taxable at their respective rates. These are your 115 BAC rates of taxes. Next chapter was your residential status, scope of total income. Does it change for regimes? No. Ignore. Next. You are into salaries. You are into salary. First item we remember is basic. Ignore. DA. Ignore. Commission. Ignore. Bonus. Ignore. Next item. Allowances. First item. Leave encashment. Is it during employment, post-retirement? Post-retirement. Ignore. Next. House rent allowance. During employment, post-retirement. Not eligible. House rent allowance. Not eligible. Next item. Special allowances. Child education. Not eligible. Child hostel. Not eligible. Any other allowances? Not eligible. Only two allowances eligible. First item is your transport allowance for handicap and your daily allowance. Next item was your other allowances. Anyway taxable, so ignore. Next. Retirement benefits, starting with gratuity. Gratuity during employment, post-retirement. Allowed. Next. Allowed. Next. After gratuity, it is pension. During employment, post-retirement. Post-retirement. Allowed. Next. PRS, not there for exam. Not there for exam. Eligible. Contribution to funds. Eligible. Next. Perquisites. In perquisites, first item was leave travel allowance. During employment, post-retirement. During employment, not eligible. Not eligible. Next item. Other perquisites, starting with medical. Eligible. RFA. Eligible. Hotel accommodation. Eligible. Food coupons. Not eligible. Food coupons. Not eligible. Office le kuduthu saapadu eligible. You give food in office, eligible. You give food coupons, not eligible. Next item. ESOPs, eligible. Transfer of mobile assets, eligible. Use of mobile assets, eligible. Then transport facilities, eligible. Education facilities, eligible. Balance, everything was anyway taxable. Then you got gross salary. In that gross salary, you deducted standard deduction, not eligible. Entertainment allowance, not eligible. Professional tax, not eligible. Arrive at your income from salaries. Arrive at your income from salaries. Good. Chapter was your income from house property. In income from house property, we had three kinds of property: SOP, LOP, DLOP. LOP, eligible. DLOP, eligible. SOP, not eligible. Any interest on loan taken for your SOP property will be ignored. Therefore, going forward, there cannot be a loss from SOP. There cannot be a loss from SOP. Second thing, they are coming and saying, if you are planning to set off your HP loss, now you cannot set off your HP loss against any head of income. You can only carry forward and set off against HP income. The inter-head set off, not allowed. The inter-head set off is not allowed. Earlier, you can inter-head set off up to 2 lakhs. Not allowed. Not allowed. Clear? This is your HP. Coming to your next chapter called as TGBP. We started with section 3031, rents and rates of taxes, no problem. Depreciation, no problem except for additional depreciation. Additional depreciation, not eligible. Additional depreciation, not eligible. Coming to scientific research, they said in-house expenses allowed, donations not allowed. In-house expenses allowed, donation of scientific research not allowed. Donation of scientific research will be disallowed for you. After you completed scientific research, you had 35 AD. 35 AD, not eligible. 35 AD, not eligible. You will move them to normal business. Claim depreciation. After you completed that, you had preliminary expenses allowed. Then PF expenses allowed. Then interest on expenses allowed. Apart from that, everything in the chapter allowed. So the only thing which is not allowed is your additional depreciation, scientific research donation, investment allowances, specified businesses. Moving to capital gains as is, no change. Capital gains is as is, no change. Moving to your IFOS, they come and say, boss, that family pension case not allowed. Family pension case not allowed. One third of your pension received or 15,000, whichever is lower, will be ignored. You will move to next chapter called as clubbing. Move to the next chapter called as clubbing. You have one exemption in clubbing called as income of minor child, 1,500 per month, not allowed. 1,500 per month, not allowed. After that you have set off. You have set off. Income tax comes and says, boss, if it is a HP loss, you can only set off against HP income. If you have any other losses, if the loss pertains to the items which we did not allow, you can remove them. It will not be eligible. Appadina enna artham, Rahul? If you carried forward loss of SOP from earlier years, we'll come and say, boss, SOP itself not eligible, so loss of earlier year also ignored. Loss of earlier years also. Clear? Yes, so this is what the provisions are from set off and carry forward. After set off and carry forward, we did full chapter 6A not allowed. Full chapter 6A not allowed except for two items. 80 JJAA and 80 CCD2. Employer contribution to NPS. 80 JJAA allowed and employer contribution to NPS allowed. Balance everything not allowed. After chapter 6A, we did 10AA. 10AA also not allowed. Then we did AMT. I told you AMT provisions not applicable if you are opting for 115 BSc. Next. Payment of taxes, same provisions. Next. Return filing provisions. Income tax comes and says, boss, whenever you're filing your returns, if you choose to opt for 115 BSc as a business guy, you will forever be in 115 BSc. If you choose to come out, you can come out, but you can never get inside again. Choose to come out, you can come out, but you will never get inside again. Appadina enna artham, Rahul? One time option to exit, but if you exit, you can never get inside. But yes, if you are a salary guy, you can keep doing monkey business. Today you can opt, tomorrow you can remove off. Every assessment year you can make a choice. Rahul, I am a business guy. What to do? You can stop doing business. You will be eligible for every year. The moment you stop doing business, you will now be eligible for every year. What the provisions are when it comes to return filing. After return filing, we did yes, same provisions. This marks the end of your 115. BSc. Second time revision also done. Rahul, provisions is solli tarla nee nyamam vechikkanum. The moment I was telling leave encashment, it should come least of the list of 4 only if you are a non-government employee. List of the 4 only if you are a non-government employee. Tell me those cases where transport operators come into picture. 35,000 cash payment, 44 AE. Very good. 194 C. Yes or no? Yes. Tell me all those cases where you talk about specified mode of payment. One by one. Cost of the asset, PGBP, depreciation provisions. Next. Specified business. Next. Every specified payment. SDV on the date of agreement or registration. Very good. For the 6% and 8% presumptive. One more. Let's see who gets it. Hold down. Next. One more. See who gets it. Give up. Huh? Into Dharnama. Very good. 80 double J double A. Double J double A. Salary payments cannot be done other than by permissible. Other than by permissible modes. Clear? Yes? Yes. What are those cases where number is 2 crores? Presumptive business 2 crores. SCP 2 crores. Very good. Surcharge cases. Very good. Beautiful. 54 exemption. Any other cases? Guys, நான் சொல்லும் போது இங்க focus பண்ணுங்க. What are the cases we discussed? We discussed SCP, surcharge, presumptive, 54 exemption. 54 exemption. Where are the cases we have learned about 50 lakhs? Surcharge, profession, 194Q, 194Q. One second. நானே மறந்துட்டேன். இருடா. What is the question? First one, surcharge. Second one, presumptives. 194Q, 2061H. Beautiful. 54 EC, NHAI bonds and REC bonds. 194 IA. Okay, 194 IA, 50 lakhs. Then, anything else? Anything else? Tax audit. Tax audit, 50 lakhs. Tax audit, 50 lakhs. Where are the cases you have learned? 2 lakhs. Interest on SOP loan. HP set off. I remember one more place. I'm not able to get it now. Any more places? 2 lakhs. No. Hey, yeah, sorry. What else? What are the cases where you have to file return on time? What are the cases where you need to? What are the cases where you need to check for the return filing due date? Filing due date. Loss cases where if you don't file the return on due date, you will not get the losses. Next. Very good. For all payments, 43B. Next. Next. Presumptive income. You should get the money within due date of filing of return for you to be eligible for 6%. Next. Huh? Next. Next. வராது. Very good. If you don't file your returns on time, whether you will have a twice the rate or 5%, whichever is higher. If you go to 194 and it becomes 20 lakhs or 1 crore, then one more. Last missing. Very good. For return filing, that is for employer. That's 43B. That is 43B. One more. If you don't file a return on time, 80 double J double A, QQB, RRB not eligible. QQB and RRB not eligible. If you don't file a return on time, you can file belated return, revised returns. Belated return, revised return. For the benefit of her, what are the cases where you have learned 50,000? Standard deduction. IFOS give 50,000. Premature withdrawal of PFs. Very good. If you are into 80D, you are senior citizen. You will get 50,000. One more. EDB. 80 TTB. நீ DDB சொன்ன TTB மாது எனக்கு DDB கேட்டுச்சுமா 80 TTB நான் சொல்லட்டுமா 80 DDB you will 80 TTB you will have 50,000 for senior citizens. 194 IB 50,000 per month. Then 194A FD oda TDS rate. Then CCD NPS employee contribution. Where are the cases where you have learned 5 lakhs? Debate, basic exemption limit. Then debate, basic exemption limit. $50. Next, where else have we learned 5 lakhs? Have we learned 5 lakhs anywhere else? Have we learned 5 lakhs anywhere else? PRSL exam lo varadu. Have we learned 5 lakhs anywhere else? No, right? No. Where and all have we learned about interest? Start from the start. First is salary, concessional interest. Next one is HP, interest on SOP, interest on LOP. Same in HP, pre-construction interest. Then PGBP, interest on loan taken for capital assets. Then capital gains, interest on enhanced compensation. Interest on RPF 12%. Then capital gains, IFOS, you have something? Interest on post office savings 3,500. Soliton. Then very good. For dividends, you will only be eligible for interest at the rate of 20% of the dividend income. Correcta solittu maathiye. Next, after you complete clubbing set off, you have chapter 6A. In chapter 6A, you have interest on education loan, interest on housing loan, interest on electric vehicle, interest on deposits. Then we have payment of taxes, interest under 234C at the rate of 1% for 3 months, for 3 quarters, 1 month for 1 quarter. 234B, 1% from the 1st April to the due date. 234A from due date of return filing to the final date. Then we had interest under TDS interest at the rate of 1% for not deducting, 1.5 for not submitting, 0.5 for not. Yes. What are the cases where only residents are given benefits? Rebate, basic exemption limit, unexhausted basic exemption limit. Nothing in salaries, nothing in HP. Move to PGBP, nothing in PGBP. Move to capital gains, set off of basic exemption limit. Then sequence up. IFOS. Very good. IFOS, any kind of premium given for resident shareholders. Then you move to closely held company deemed dividend. Then Clubbing, nothing is there. Set off, nothing is there. Move to chapter 6A. In chapter 6A, you have 80D. 80D, you'll get a limit of 50,000. Then 80 DDB, 4 lakh, 40,000 will become 1 lakh. 40,000 will become 1 lakh. Medical expenses, 80 DDB. Then 80 TTB, 80 TTB, resident senior citizen. Interest will become 50,000. Then PGBP, 30% for TDS and 100% for non-resident. Then going to TDS chapter, if you are going to TDS chapter 194A, 194A says 40,000 or 50,000 for resident senior citizen. Then 194P, resident senior citizen having age more than 75 years. Then that's all. Hey, whole TDS itself is resident only, ma. The whole TDS itself works only on resident model, except for 194E. Except for 194E. After TDS, you had return. If you are going into advanced tax, resident senior citizen, not having PGBP income, no liable to pay advanced tax. Then return filing also over one AMT varadu. Return PAN Aadhaar linking only applicable for residents. Applicable for residents, not applicable for. Done with income tax. Done with income tax. Pending only one topic called as updated return. We are at 3:14. We'll done at 3:30. After that, you can take some break and we can start with mocks. I will give you two options. If you want to write only direct tax, you only have 1 hour. Yeah, 1 hour, 50 minutes. 50 minutes, no, 60 marks, 60 marks paper. 60 marks into 180 minutes will give you how much? 54 minutes. You have 54 to 55 minutes. 5 minutes for your reading time, 54 minutes for your writing time. 1 hour you will complete DT. Want to write both DT and IDT, 3 hours paper for you. Your choice. Okay. Those kind of people, I would recommend you take it home because 4 to 7 it becomes late for you here. Take your papers home. I will share it on the groups. Share it on the groups. You can write your paper. You can correct your papers and you can confirm it to me. Confirm it to me what your marks are. Clear? Yes. Starting with the last topic called as. Updated return. Starting with the last topic called as updated return. Pay special focus, people. Pay special focus. Pay special focus. Important amendment for the current year. Important amendment for the current year. You have a question in your paper also. MCQ question. MCQ question. Careful about it. Okay. Yes. Provisions are like this. Income tax basically came and said that, boss, you have an option to file original return, belated return, revised return. Original return, belated return, and revised return. But if it so happens that you are not having that kind of scenarios, but you have to pay more tax to government. Government has now opened up a new window for you called as updated return. This updated return can only benefit department. Cannot benefit assessees. Meaning, income tax has come and said that, boss, if you want to file an updated return, the updated return should end up in more tax to me. Only if it ends up in more tax to me, can you file an updated return? Rahul, I am having a refund. My refund will lower. Can I file updated return? No. Rahul, I have a loss. Can I file my updated return? No. Rahul, my loss has become income. Can I file updated return? Yes. Rahul, I already have an income. I want to increase my income, pay more tax. Can I file updated return? Yes. Right? Income tax comes and says that this kind of scenarios will only come into picture when you are ending up paying more tax to me. Clear? Yes. With this provision, second thing they're coming and saying, boss, I am giving this window only once to you for a year. Revised return, mari tiruppi maride irukadu. Once you have filed an updated return, you cannot again revise that updated return. You filed an updated return, that will become the final return. How do you file an updated return? They came and said, Rahul, this is your previous year. That's from 1st April. '22 ends on 31st March 23. You will file your return for 31st March on 31st October or 31st July 2023. 2023. Income tax comes and says, boss, after this, your revised return is up to 31st December 23. Go back to the last of the year. Go back to the last of the year, 31st March 24. This is your last day of the assessment year. This is the last day of your assessment year. From this last day of the assessment year, I am giving you 2 more years. Giving you 2 more years, meaning up to 31st March 2020. 31st March 2026. From your 31st December to your 31st March 26, you can file something called as updated. Updated return. If you plan to file an updated return, you will obviously end up paying more tax. But apart from that, you will also end up paying more interest. So paying more. So income tax comes and says, boss, if you are filing an updated return, tell me whether did you file an original return or did you not file an original return. You file an original return or not file an original return. I have an option to say, boss, I did not file a original return, or I have an option to say I filed a original return. I filed a income tax comes and says, boss, if you did not file an original return earlier, but later on now you are coming and going to file a new return. You are going to come and file a new return. Are you going to pay tax? Not pay tax. Are you going to pay tax? Not pay tax. You are going to pay tax, which means had you filed an original return and you had filed it late, I would have levied something called as 234A. 234A. Income tax comes and says, if you do not end up filing a return, first you have to compute what is the tax payable. First compute what is your tax payable. Add your 234A. 234A. From what to what? From the due date of original return till the due date of till the date of updated return. Till the date of updated return. You are doing this because you did not file a return earlier, but you were supposed to file a return. Next will be 234B. Next will be 234B from 1st April to date of return. Add 234C from 1st April to 31st March. These two are previous years. 1st April of the previous year to 31st March of the previous year. 234C stops on the previous year itself. 234C stops on 31st March. No, advance tax only, no? Right? Add 234F. Add 234F. You did not file a return. So I will also levy 234F. This is my total tax. But fortunately, someone already deposited TDS on my behalf. So minus TDS already deposited. If you paid advance tax and all, unlikely to happen because you have not paid return. You have not filed a return, so unlikely to happen. In this scenario, this will become your tax payable under updated return. This becomes your tax payable under updated return. Yes or no? Come to the right side. Now, you had already filed an original return. Now you are planning to update it. What will you do first? Tax payable as per new return. This is what the actual tax, no? This is your tax payable as per new return plus 234B. Hey, you have already filed an original return. You just forgot to file right numbers. That does not mean that you filed a late return, which means 234A will not apply. Coming to 234B. Now 234B will be on the extra tax. Yes or no? Yes or no? How do you do this? You can simply come and do 234B on the full number. 234B on the full tax. But you will do this from what period? You will do this from what period? Same. 1st April to date of payment, date of return. 1st April to date of return. Then you will add 234C on full tax. On full tax from 1st April of PY to 31st March of PY. To 31st March of PY. Yes or no? Yes or no? This is what you will get as a number. Will you take 234F? No. Now, this is what is your new tax, which you should have paid, but you have already paid some numbers. So what will you reduce? Minus tax already paid. Tax already paid minus 234B already paid. Original return you would have paid some 234B, no? Minus 234B already paid minus 234C already paid. Why are we doing this? If you remember on the top, I told you you should pay 234B on the extra tax. Instead of you directly computing extra tax, you compute it on the full tax and then you're reducing the difference so that you get it on the extra tax. Try panni paru. Because the problem is, I told you self-assessment tax pay pannamodu, it first adjusted against the salary, first against interest. So if you do the extra tax, you will not be able to properly compute. Therefore, you do 234B on the full tax and then you reduce the 234B on the already paid minus 234C already paid minus any tax you paid after you file the return. Yes, no, you can pay tax after you file the return also. That also you reduce. That also you reduce. This will become your tax payable as per updated return. As per updated return. Clear till here? Yes, this is what is a tax payable under cases when you don't file a return and when you file a return. But income tax says, boss, I will not let you go with just this. I will not let you go with just this. Since you did not pay your taxes on time properly, you did not pay taxes on time properly and you waited for an updated return, you now have to pay me extra tax. You now have to pay me extra tax. What is that extra tax? They're coming and saying, boss, in this chart, if you file your updated return up to 31st March of 25, meaning within 1 year from the end of the assessment year, then 1 year from the end of the assessment year, meaning first year if you paid from your assessment year till your 31st March of the assessment, 31st March of the 2025, 31st March of 2025, whatever tax you found below, on that you need to pay 125%. That you need to pay 125%, meaning irukadha number mala into 1.25, and the number irukadha mala 1.25. Rahul, I filed my updated return between 25 to 26. Between 25 to 26, number will become 150%. So basically, find out your taxes on the bottom. Check when you have filed the return. If you are filing the return, the 2 years gap I gave you, within the first year, if you file the return, it will become 125%. If you file the return after the first year, it will become 150%. Most likely in exam, it is going to be tested as an MCQ only because it's too lengthy and too difficult to understand. Plus, ICA has not given any examples in your book also. So most likely it is going to be tested as an MCQ. So you need to understand when the return is being filed. If the return is being filed up to first year after the assessment year, it is 125%. If it is filed after first year from the assessment year, it is 150. Okay? Clear? Any doubts on this? No? Original return not possible. No? You would not be able to file your returns. I'm saying if at all it is applicable. If your original return was filed pakka, you did not have any 234B and C, then in that case the full 234B tax, that's all. The full 234B tax. If you are going to pay anything extra, then that is the problem. Then there is the problem. Clear? Yes, these are what your provisions are when it comes to updated return. Any doubts? For those who did not understand, in case you want some examples, fast track last class. Fast track last class, the very last leg of the provisions, we have done 2 examples. We have done 2 examples. Go through those 2 examples, you'll get the answer. Yes, fast track, Sankara, you can check the Sankara YouTube channel. You can check my personal YouTube channel. 7th last video, last half an hour or 1 hour. Last half an hour or 1 hour, you will find examples on this. You can go through those examples and you'll understand. Clear? Yes. This marks the end of your income tax. Calculating it properly, we started on 7:30, went up to 9:30, then we started on 10 o'clock, went up to 12:30, 12:45, started up to 12:30, then we came back at 1:45, came back, completed at exactly 3:30. I can see it. Coming back at exactly 3:30. We are actually, in fact, 1 minute lesser. 3:29. Calculate the number of hours. 2.5. 1.75, yeah. Nama 75. 1.75. Total it up. We have completed the marathon with 6.25. We have completed the marathon with 6.25. I generally used to tell in my classes that it takes 6 hours to complete. But somehow, somewhere, last 2 batches, it was able to complete only at 7 hours. We're able to complete only by 7 hours. Hey, 1 hour 45 minutes is 1.75 hours. Ra. You want 6.25? 6.25 means 6 hours and 15 minutes. Yeah. Yes. Every time we came for the last batch. Yes. Every time we used to come for the batches. I think I've taken 3 marathons now. First marathon, which I took in another academy, we did some 7 hours. When I did it in another academy, I did it for 7 hours, and unfortunately, I missed out TDS in that. Then I did it in this academy. I completed for 7 hours. We started at 7 o'clock last batch. 7 o'clock we started last batch, and we completed at 5 o'clock at that time. This time we broke our own records. We have come back to 6 hours. All that people who came outside, someone called me, all those things including, we completed at. That's not boasting about people. My point is very simple. 6 hours was also in the consideration that I was telling and you were repeating. 6 hours was also in the consideration that I was telling and you were repeating. Either somewhere we did summaries also. For 5-10 minutes. And then we had some breaks also. We were discussing if there is any doubts and all those things. Ignoring all those items, you effectively can do the whole income tax within 5.5 hours. And effectively complete the whole income tax within 5.5 hours. And when I say the whole income tax, I literally mean the whole income tax act. And that is for your first reading. Today we did our first reading. In the first reading, we completed in 5.5 hours. When you obviously go for your second reading, you know clubbing and all you're not going to read, set off you're not going to read, AMT you're not going to read, 115 BSc you're not going to read. Things which you're not going to read, if you exclude those off, that becomes 4. 3. That becomes 3 because now you only have to remember salaries, PGBP, capital gains, and the moon matada padipinga. Second reading, that is what will happen. You will only read salaries, PGBP, and capital gains. Someone who's interested will also read TDS. Third time when you read, you will not even read salaries. You will now get back to only capital gains. PGBP also somewhere you know now. So you now only read capital gains, which means now you only have one chapter to read. That is only half an hour. That is only half an hour. Yes. So imagine, no, 5.5 hours for first time reading, 3 hours for second time reading, half an hour for third time reading. Total, how much did you spend? 9.5 hours. You totally spent 9.5 hours, completed 3 revisions. Completed 3 revisions, and now everything in your head. Now everything in your head ready for your exams. Ready for your exams. The only thing which is missing out is the practice. The only thing which is missing out is the practice. And like I told you, the practice happens on the day of exam or before the day of exam or before preparations. During your preparations. Happens during your preparations. With your completion of 9.5 hours, this 9.5 hours, what we discussed today is your target for your day of exam. The day you come back for your exam, 5 o'clock, you will complete your exam, come back home, become around 7 o'clock. Come around 7 o'clock, go take a walk, enjoy life. 8 o'clock start. 8 o'clock start. 4 hours. Midnight you will be done. Midnight you will be done. Maybe 1 o'clock, 2 o'clock, max to max 1 o'clock, 2 o'clock. Sleep off. Morning start with IDT. Morning start with IDT. First half full IDT. First half full IDT. Second half, what will you do? Again brush through DT. Again brush through DT. This time is your second revision. This time is your second revision. Next, what will happen? Second half, you will need only half the day for doing your DT. Next half, what will you do? Same IDT again. Same IDT again. In your 1.5 days, you are done with 2 revisions. Done with 2 revisions. Early morning, again start with first amendments. Early morning start with first amendments, whether it is DT or IDT. That is the most important thing. That is the most important thing. Once you are gone through the amendments or you have a track of what the amendments are, now do a quick revision check. Now do a quick revision check. This time you will not read. You will not read. You will open your book. You will scroll the pages. You will scroll the pages, and in your head will come the imagination as to what is there in the page. What is there in the page? Somewhere, if you don't understand what is there in the page, either it is out of syllabus or you have not learnt it. Or you have not learnt it. Or if you feel like you have not learnt it but you forgot, you will take back that page once again and you will read that page one more time. That's all. You read that page one more time. If it registers in your head, great. If it doesn't register in your head, exempt. No leave and go. No leave and go. Please understand, people, the mistake of people. You go to the exam hall, you don't know something, either you will sit and bug about it that you don't know, or you will leave the whole question itself. No. If you have chosen to take that question, answer the full question. Answer the full question. It is okay if one adjustment is going wrong. It's okay if one adjustment is going wrong. Step marks 4th varaikum, you will at least get the balance items. At least get the balance items. And the over adjustment nala motta question uttitina, balance items will go for a toss. Yes. Which is why you need to also be careful on how to read the question paper when you get the time for it. Time for it. If you have the time for it, don't sit and waste time on doing the MCQs first. Edutone 15 minutes ukandite MCQ paattiralama? No. All is for saying, Mainika, I know what happens. You are honest enough to not open it, that's good for you. Yes, MCQ papers don't touch. Don't touch. That 15 minutes is effectively for you to do only one activity. Understand which question to leave in both DT and IDT, which means you will never come and look at question number 1 because it's compulsory. You know you don't have a choice. No, you don't have a choice. Open your question paper, start from question number 2, go till question number 5, understand which one you don't understand. One you don't understand. If you don't understand more than one question, decide which of the options you don't understand. If you are effectively able to answer some question better, take that up. Take that up, both in DT and IDT. At this point of time itself, you will also come and confidently tell yourself, this question I know 100%. No, and this question will be the first question to be answered in your book. Be the first question to be answered in your book. When you start answering, please, for God's sake, no scribblings. Scribblings. First paper, first side is your magic side. Your magic side that can change the mood of the examiner either to a good side or to a bad side. Get on his bad side, you know what is going to happen. Yes, always try to be on the good side until you're clearing at least. After that, you can go and scold ICA like I am doing. It doesn't matter. One is going to ask you. Membership kaila vechittu na solren ICA motte irukku. First only this institute is not an option. Yes, but the point is until you're clearing, you don't have an option. You are to satisfy someone's ego. You are to satisfy someone's ego. So please keep your first side legible as possible. If you are not able to understand what to write, no scribbling, scratch it fully. Scribbling, scratch it fully, start in the next page, but your first answer will decide your fate. If your first answer scores you that 8 marks or 10 marks, examiner will now have an understanding that no matter how pathetic his handwriting is, he knows how to write. He or she knows how to write, which means I don't have to look at the balance answers. Maybe it will be correct only. In which cases, he will only look at your final answers. He look at your final answers. If the final answer does not matches, is when he will look at the steps. But most likely, if he says the final answer, he will give a full mark and he'll go ahead. Yes, but if the first question ends up in a mess where you scribble everything, you don't know what you're writing, you're merging on two things. One is becoming 2, 2 is becoming 4. He will understand that you're confident, you have lost confidence in the exam. The moment he knows that you have lost confidence in the exam, now he's testing whether you are going to pass or not. Means now every question is going to be checked. The moment every question is going to be checked, you know how you have written the paper. Yes or no? Have you written good or bad? Have written good. Have written good. Ivlo preparation பண்ணதுக்கு அப்புறம் கூட bad இருக்குனா second floor இருக்காங்கல அப்படியே. That's what I would say. Ivlo preparation பண்ணதுக்கு அப்புறம் கூட bad னா தெரியல எனக்கு. Yes, after this level of preparation also, if things are going bad, then yeah, find yourself some door and go knock your head off. Yes, point is very simple. Your first paper will create, your first side will create an impression on the examiner, and this first side has to make the magic. To make the magic, how does this question make a magic is that what you think in the head is what is there on the paper. Everything you think on the head is there in the paper. Smallest of the items. Smallest of the items. If you think Rahul basic exemption limit should not be 2.5 but should be 3 lakhs. Why? Important. Why is important? Rahul, I think examiner will know that it's a resident senior citizen, so you should opt for 3 lakhs. No. You need to tell him that it's a resident senior citizen. That's why you're opting for 3 lakhs. Why did you change from 2.5 to 3 is what you know in your head. But did you put it on the paper? That's where you lost the mark. Where you lost the mark. The smallest of the items can make the impact. Smallest of the items can make the impact. It will take time, people. I know. I know that extra writing will take the time. That is why the practice. That is why the practice. Try to complete your paper as many mocks as possible so that everything you think comes onto the paper. At the same time, you're able to complete the paper also. You're able to complete the paper also. That is the kind of thought which you should go. And it's not for DT, it is not for IDT, it is for every paper you're planning to pass. For every single paper where you're planning to pass, whether it is law also, whether it is accounts also, whatever paper it is. Never start with this useless compulsory question. Never start with MCQs. You will not pass. Not pass. If you start and sit and understand the case study, open the case study. Someone is going for honeymoon, someone is going and enjoying life, someone is going a party, this person is having 2 houses. இவ்வளோ பெரிய ரிச்சா இருக்காரு 4 crores income இருக்கு, waste of time. You come and you get engulfed into the story will take away your attempt. Story will take away your attempt because that's how ICI is. They will prepare all fancy stories for you and the story itself will go for 2 sides. Story itself will go for 2 sides. You will sit and understand the story for the next 2 hours and then balance 1 hour you will be sitting and fretting about let's prepare for the next attempt. ஏன்னா அது வேற, this is 4 paper number 4 group 1 முடிக்கல கரெக்டா இல்லைன்னா கண்டிப்பா group 2 கரெக்டா தான் போகாது சொல்லுவீங்க. Already group 1 is not going good, group 2 also will not go good, let's skip the group 2 and let's start with a new attempt. No, start understanding your paper, people. Writing of paper is also a skill. Writing of paper is also a skill. People might come and tell you CA, if you understand the concept everything will answer. No, CA is all about you being smart, not about you being hard. Not about you being hard. Intelligent people will score ranks, that's all. Beyond that, you will pass. That is no second thought. People who are not intelligent is what we are right now. And me are all not intelligent people. We are trying to somehow score this out. We are trying to somehow score this out because this is important. Had you been the first attempt people, I would have told you things are very different. But you know where you have gone wrong. I'm not telling you people are not deserving. I'm telling you, you made some mistakes in your first attempt. Made some mistakes in your first attempt. That's why you have landed up here. Yes. And so that is the kind of mistake you need to modify yourself. So no, it's all about getting up after you fall down. It's all about getting up after you fall down and not making the same mistake again, because first time it's a mistake, second time it's a sin, third time it's hanged to death only. Third time it's hanged to death only. Cases also will not, judge will also not come and say third murder and all, I'll give you benefits. No, out straight out hanged to death only, because they will say, boss, something is wrong with your head, chemical locha only problem. Clear? Yes. Do you want to try the third attempt? Do you want to try your third attempt? This is your first and the last inter attempt. Your first and the last inter attempt. Let's make it count. Let's make it count with that kind of understanding. You are still right now 9th April with effectively 21 days in your pocket. Effectively 21 days in your pocket. Stop today preparing, practicing. Stop today preparing, practicing. Start today revising and solving. Start today revising and solving. Rahul, I don't even know the subject. What will I solve? It doesn't matter. Sometimes what happens is these kind of papers, these questions will keep repeating itself. These questions will keep repeating itself. You do 3 papers, now you'll automatically understand what ICA pattern is. Do 3 papers, you will 100% understand what ICA pattern is. 4th time, you will still come and say, I know that this chapter will not come. Which means you're already ready for that 1.5 days where you know what chapter to read and what chapter to. Not it. Aduvay pass iding. So no. Stop preparing, people. Not the time for it. Not the time for it. You have already lost the bus. If you have done it till now, great, wonderful. If you have not done it, it's okay. Use this 21 days like there is no end of tomorrow. I can tell you this for all the confidence which I have because I know my inter preparations happened in 5 days. My inter preparations happened in 5 days. I was in an academy back in my times in 2016 where one of the famous academies here completed batch itself on April 25th. Imagine completing your batch on April 25th. And you think Rahul would have been studying daily? No. Not that kind of person. எனக்கு புக் பார்த்தாலே காண்டா இருக்கும். டாக்ஸ் மட்டும் நீ சொல்லி தந்துட்டா நான் பார்த்துருவேன் அந்த மாதிரி கேஸ். எஸ் பேலன்ஸ் ஆனால் புக்ஸ் ஆனால் ஆடிட் ஆனால் டெஃபினெட்லி இஐஎஸ் எல்லாம் தொடவே மாட்டேன் நான். அந்த மாதிரி ஆளு நான். Okay, in that 5 days I scored my paper and I got clear. I didn't no exemptions and all. 5 days la onnu kilikku podudilla but I passed. Yes, I was the only person to pass in my whole group. Right? Every one of my friends failed either group 2 or both. Either group 2 or both because of that one mistake which they did. Start practicing over again in the last 5 days. 5 நாள் கையில வச்சிட்டு if you sit and start solving the whole accounts paper over again, telling that next 5 days later I have accounts paper, let me start with my study material once again, take my whole practice manual out and start and solve every question in my accounts. என்ன பண்ண போறீங்க? accounts மட்டும் தரச்சா போறோமா? மத்த பேப்பர் யாரும் பார்க்க மாட்டாங்களா? The problem. Yes, that 5 days is for you to understand. In your case, you are now still in a boon because most of you have already completed your syllabus. I've already completed your syllabus. I've been studying for so much time right now. No one is right now taking your classes right now, correct? Anyone still going through your classes? Right? You're already in a good position right now, better than what I was at least. Yes, if you're in that kind of position, feel that kind of privilege first of all for yourself and start utilizing that kind of privilege. This also does not mean that Rahul cleared in 5 days, so therefore I will start on the 5th day and I will clear. My strategies work very different from your strategies. You might be the person who will cry over a failed paper. I will be the person who will laugh over a fried paper. I'm that kind of a person. Okay, I literally went into the exam hall and I was like, "Dey paattirlanda." But the difference what happened is because everyone saw my sad, smiling face, they became sad and they failed. You win battles by 2 ways. Either you do good or you end up making others bad. That is how I passed. So I passed. I went into the exam hall. See, the problem is only with 2 people. One who study too much and one who don't study and worry about it. I'm that kind of person who did not study and did not worry also. I went to the exam hall and I was like, anyway, I did not study. I know I'm going to fail. What is the problem? So I went and I wrote my exam. In that chilled off mood, I wrote and everything scored 50-55. Pass I no. I know definitely I got cleared in moderation only. And pass, some God only was sitting there and he was like, in the moonji pass agnale poronda. So he passed me out in inter. Finals, I did my part. I scored 5 exemptions also. Yes, so finals, I did my part. Yes, so the point is very simple. It is all about what your strategy is and how you look at yourself. If you feel like you're that kind of person who gets fretted about things and you start worrying about your papers, start studying. Start studying right away. If you feel like you're carefree and all, you're ready to fail, your choice. Your choice. But if you are already at this position with 21 days in hand, 21 days can make magics for you. And I'm seriously telling you it can make magics because you only have 7 papers or 8 papers. 8 papers. In 8 papers, the logic is very simple. You have 21 days. 51 days. In this one paper today itself, you're going to solve about tax. Means one paper gone. Balance you have 7 papers. Oh no, 7 papers. 3 papers I told you to write. 3 papers I told you to write. Don't sit on that understanding, Rahul. One day fully I will read and write. I will write the paper. To sit and read for the whole day and then write a paper in the night, then you have used one day for each paper. Your strategy should come to what I told you. You should complete every subject within 6 hours, which means morning you read, afternoon you write a paper. Complete that paper, read again the next subject, write a paper. Now you're doing 2 papers a day. Doing 2 papers a day. Imagine 7 into 2. How many days do you need? 14 days. The balance 7 days is for you to rectify your mistake. Balance 7 days is for you to rectify your mistakes and understand where you're going wrong, which chapter you need to read again. And that kind of time you can use for your YouTube videos, checking which subject is nice, which topic I did not understand, and all those things. No. Again, I'm clarifying that is only for your revision and understanding your concept, not for preparing. But plan your things. Things can happen. You think, Rahul, one day how can I write 2 papers? You try, you will know. Try, you will know. Sleepless, that's all. Sleepless. I'm not saying don't sleep for 2-3 hours. No. It's enough if you cover 5 hours a day. Enough if you cover 5 hours a day. 5 hours is enough. Adhika mela thevilla. Start in the morning. Read your provisions. You can definitely complete it by 11:30. 12 o'clock start. Complete within 2.5 hours. Complete within 2.5 hours. Take the paper, keep it away. Then again start with the next paper after your lunch. Read the whole paper. At around 7 or 8 o'clock, you can again start writing. Complete it by 11:30. 12 o'clock, sit with both the papers. Take your answer key, correct the whole thing, understand where the mistakes are. Done with the papers. How many papers over? 2 papers over. The moment you see that any paper you're starting to score exemption, stop writing that paper. The moment you start scoring exemptions in some paper, stop writing that paper, because now you're confident. You will have to read this only next time after your exam days. Start working on the balance paper. Wherever you're failing, start again until you pass. The day you pass, next paper you will definitely score an exemption. Take it from me. I've never seen a person who's come and told me, Rahul, I got 15 one paper, and the next paper I came back to 13. No, never happens. If you have scored 50, you're only on a learning curve. You will again get to 60 only. You will get to 60. The day you get to 60 is the paper stops. You start working on. Plan your structures, people. You will actually realize that you can complete the whole 8 papers within a matter of 10 days. You'll have 11 more days to go watch movies and go party with friends. How should I do all that? Please do. Please. Keep yourself occupied, people. Don't sit at home and watch the walls. Wall is also watching you. Okay? Tomorrow suddenly you will go to the exam hall and come and say, and the white wall correct and the white wall illa. No, don't start sitting and focusing on only one wall. Your life will become miserable. Depression angada arambichirum. No. I'm not telling you start partying so much that you don't stop reading itself. Party to the extent which is required. When I say party, I'm not simply meaning going to the clubs and enjoying and all. Maybe if that's a choice which you have, that's a great choice. Otherwise, when I say party, it simply means go out for a walk, half an hour walk, call your friends, talk some time. You have some companions along with you, please feel free to reach out to them also. If they are also reading CA, please don't disturb. This is the kind of mistake which you do. Because now only things will start, If you are going to fail, I will also fail. No. If you have a companion doing CA, put a hard pause to the relationship until you clear. Tell very simply, boss, I am not that kind of person who will fail just because you are failing. You fail or pass, I don't care. I will pass. Yes or no? My mental abilities are like that only. Suddenly you start making rash decisions. That woman will suddenly come and say, I am not ready to pass. I think things are going bad. Either she would have read already for 15 hours. You would have already read for 15-16 hours, and she'll come and say, Rahul. And then you will be like, Day, you did not study, so I will also not study. You are very honest, so you will not study. And then suddenly exam paper will come and she'll be like, Day, I passed. Exemption where. And you are here like टुकरा के मेरा प्यार मेरा इंतकाम देखेगी मारी टाइप्स அந்த லெவலுக்கு போயிட்டேன். புரியலையா? விட்டுரு. பேசிக்கலி ஹார்ட் பிரேக் ஆஃப் ட்ரஸ்ட், பிரீச் ஆஃப் ட்ரஸ்ட் ஆச்சு. ஆனா பெனால்ட்டி ஒன்றும் போட முடியல, அதான் பிரச்சனை. Now tomorrow what will happen? She'll be like, you are not earning more than me, you are not doing life properly, I think it's time that we வேற ஆரம்பிச்சிரும். Yes or no? It is not happening between us, I think we should part, it is not you, it is me. நாம ஆரம்பிச்சிரும். Yes, people doing CA, no companions until you clear at least. Till you clear, never have companions with CAs and all, very risky. Yes, other than that, if you have some people, those people will be enjoying, go enjoy with them also. At the same time, be focused on your classes and exams also, because that is also equally important. I'm telling you right now, stop reading, start practicing. Effectively utilize your time, people, because this is the time where you will make the impact. Yes, no matter how you would have studied. Super. Try 5 papers. If you are planning for one group, I would recommend start second group also, because you don't know when you will clear. Important that you start your second group preparations also parallelly. That is what my recommendation would be, because effectively the problem what happens is, if you start preparing your group 2 after you clear group 1, if you don't clear group 1, you keep doing group 1 only, and then you never come to group 2, and then by the time you clear group 1, what will happen? You'll only have 2 months to clear group 2, not be able to prepare group 2, so again group 2 will start attempts. Start preparing your group 2 is what my recommendation. Have time, please do definitely start after you have completed group 1 preparations. What my yes, that's all I have to surrender from my side. I don't have anything further to discuss. I will hand over the question papers for whoever wishes to write right now. For those who do not want to, I will send it on the broadcast channel. The paper is basically your last attempt's second mock test paper is your last attempt's second mock test paper, which is basically, I think, your October 22 paper. Basically your October 22 paper with some slight modifications from my side. I would have included some 1 or 2 extra MCQs for me to cover the amendments. Other than everything will pretty much be the same. The reason why I took the paper is I understood this paper is a little challenging. Paper pathale konjo complex aindadu, so I personally took this paper other than the balance papers. Balance papers were a little simple and all. I've taken this paper. This paper effectively will try to cover everything which is important. Everything which is important. Please have a look of the paper and the feel of the paper. Realize that you are in an exam hall and start preparing on the clear. Yes, this paper alone I'll give from my side. Second paper you will answer ICI's second mock. If you have not attempted the first mock, you will also answer the first mock. 3 paper panna porum. 3 paper kulla exemption detail ஆச்சு வந்துரும். IDT நீங்க பாத்துக்கோங்க. IDT anyway is not changing so much, so if you want you can take up previous year papers also and you can try it out. DT matto don't touch any earlier year papers unless I recommend it, because assessment year will change and your amendments will change. Things are very complicated. I will give you the paper for the current year. Next 2 papers you will do ICI mock 2 and ICI mock 1. With that you should be done. Stop practicing all your practice manuals, all your study materials, all your concept books today. Clear? Any doubts? Ready to pass? Let's meet you all after passing. I'm expecting something called as mark vanda porum. I will be expecting that mark coming out of you after you clear. You drop me a message on that same page saying that Rahul have cleared. That is the biggest excitement which I will have, nothing else. Beyond that, I'm not expecting anything out. Yeah, come with that kind of thought. Anyway, I'm having different strategies. I want to ready for finals, so I'm expecting you for அந்த மாதிரி. அது வேற notion altogether. That's hidden adjustments. I will not discuss about it. Okay, இப்போதைக்கு inter clear பண்ணிட்டு you come back and you tell me how you have done. That is enough for me. You come with that kind of happiness face saying that Rahul, I've cleared this paper. I say clear this paper, group or both the groups together, whatever it is. Yes, you will definitely be able to do it if you follow the strategy, is what my recommendation is. I've never seen a paper fail because you have not attempted. After you have attempted this strategy, so let's work on the strategy. If you have not done the strategy earlier, start working on the strategy right now. If you have already been doing such kind of strategy and still is not working, maybe there is a problem in your presentation. Focus on the answer keys. Be a little strict on yourself. Don't start giving you leverage marks saying that Rahul, this looks right, so hold 8 marks. No. Be a little strict and then prepare your papers. If you be a little strict is when you will realize what the examiner will do for you. Okay, so be that kind of strictness for yourself. Imagine that you are the examiner correcting someone else's paper looking at your handwriting. Or no, you will understand what aggression you need to go forward. Yeah. Yes, keeping that in mind is when correct your papers and fail people. Fail. I am telling you honestly, fail. But only in marks, never fail in your year. Do not contribute to ICS Welfare Society. Do not contribute to ICS Welfare Society. Let the members do the job. We will do it together after you qualify. After you qualify, you are as good as a member to me. Yes, we both are partners to each other. So you can call me Rahul. I can call you by your name. We will both contribute to member society, and then we'll come and blame that nothing we are paying for, nothing. That we will do after we. Right? Until now, you are bound to the institute. So let's work with the institute, but at the same time, don't give them the kind of luxuries to earn from you. Yes or no? Here. Thank you, people. Have a wonderful day ahead. So happy weekend. If you have any kind of enjoyment in life, take today's day and enjoy life. Take today's day and enjoy life. Write the paper, go enjoy life, and then start fresh from. Yeah. Yes. This video is a little. This video is a little broken. I do understand there is a lot of challenges in the video. Please don't worry about it. I have told my team we will be amending the whole video. We'll be editing the whole video, and our consolidated video, which only covers the 6 hours, would most likely be updated by the day after tomorrow morning. By the day after tomorrow morning, it will be available both on Sankara channel or on my channel, either of the places. Either of the places you will be having this video. If you want to do a second revision, you can start doing from that chapter. Clear? Yes. Thank you, people. Have a great day ahead.